My name is Herb Taylor. I am the Vice President and Corporate Secretary here at the Federal Reserve Bank of Philadelphia, and I want to welcome you all here this morning. Today's conference is the 31st Annual Monetary and Trade Conference arranged by the Global Interdependence Center and the LeBeau College of Business. Traditionally, this conference has been held on the Drexel campus. We're very pleased to have it here at the Fed this year, and we're particularly pleased because we recognize the importance of this year's topic, fixing the banking system for good. As you all know, I'm sure, the Fed serves as the central bank for the United States, and in that capacity, we supervise and regulate banks. We serve as a payments processor for banks, and it is through the banking system that we execute our monetary policy. So we appreciate the contribution that a good banking system makes to people's economic well-being by providing trustworthy intermediation between borrowers and lenders, by providing a reliable means of transacting the day-to-day business of buying and selling, and by providing a stabilizing flow of money and credit overall. And so we are very much interested in fixing the banking system for good. Again, today's conference is co-sponsored by the Global Interdependence Center and by Drexel's LeBeau College of Business. And so there is no more appropriate person to formally open today's conference than the chairman of the Global Interdependence Center and the Dean Emeritus and George Francis Professor of Finance at the LeBeau College of Business, Dr. George Tsichakos. George.
I appreciate the introduction, and first of all, I'm George Tsichakos, of course, chairman of the GIC. I'm very privileged to be in that spot, and I can tell you that we have a wonderful organization with so many interesting conferences and forums and discussions, and I urge programs. Our mission, of course, focuses on expanding the global dialogue to improve cooperation and understanding among citizens and nations. In the process, we have been around the world organizing conferences. Most recently, we participated in a very well-organized conference in Abu Dhabi, talking about global issues from that part of the world. And of course, we plan to continue our efforts not only here in Philadelphia, but also around the country. I can tell you that GIC has a very good membership. We try to expand also our membership, and I urge you, your colleagues, to become members of our organization, but also urge you to consider sponsoring of some of the events that we conduct. We are very pleased to have LeBeau College of Business to be the major sponsor today, and of course we are very happy that the Philadelphia Fed has provided the necessary facilities for us to have this well-organized conference. It's a very good topic, as Herb indicated, and I look forward to the discussions today. With this, once again, welcome, and I would like to turn to David Kodak, Chairman of and Chief Investment Officer of Cumberland Advisors and a GIC Chair of the Banking Series. Thank you.
I need to get into business here. Can you hear me? Can you hear me? Thank you. Now I need some slides. This was put together by the lowest bidder. You know he has to film this and stream it at the same time? And we talked earlier over coffee, and I said, I'm going to put on a lavalier and move around the room. And he said, don't do that. So anyway, we lost the argument. I'm going to talk about central banks from the point of view of an investment advisor or money manager. That's what we do in our firm. For the last dozen years at the Global Interdependence Center, we've had an organizational component called the Central Banking Series. And the Central Banking Series has become a lot of fun these days. We have, as you'll see in a slide in a minute or two, the size of the central bank's balance sheets in the world is of unprecedented magnitude. And I know of no period in history that we've had anything like this. Now, to create a metaphor of the size of the central bank balance sheets, I want to tell a little story. The story starts in the Middle East over 100 years ago. The British built the first rail line, a narrow gauge rail, from Istanbul to Cairo, actually to Alexandria. And as they were building the line across the desert in what now would be the Negev in Israel or the Sinai Peninsula in Egypt, on the first completion of the line, on the first run of the maiden run of the train to Egypt, the engineer was taking that train across the desert, and while he was doing so, there was a Bedouin tribesman who was walking across the desert, and the Bedouin, for the first time in his life, saw a rail line, and he saw the ties and the metal parallel going as far as he could see, and he never had seen that in his life. So he quickly realized, George, that if he could walk in the direction he was going on the railroad ties instead of on the sand, it was much easier. And he began to walk in the direction of Egypt on the ties, and of course the train is coming down the tracks. And the engineer looks out and he sees the Bedouin walking on the rail line. So he says, my gosh, he blows his warning whistle, a steam whistle. Whoo! The Bedouin's never heard a steam whistle. He's never seen a railroad. Okay? He keeps walking. The train gets closer. The Bedouin doesn't change his pace. The engineer blows the whistle again. Whoo! Nothing. Finally, the train is very close. And the engineer has no other choice. He's either going to hit him, kill him. He leans on the whistle. Whoo! And he puts the wheels on the old train in reverse to try to stop it. There's this clanking of metal, all these engines. The Bedouin turns around, hearing the whistle, looks at the train, it hits him, and it knocks him unconscious. He wakes up. That afternoon, he's in a 2-story British hospital about 50 miles away. He's in a room. He's never been in a room. The room is entirely white. He's bathed. He's in white robes. He's in a room at the end of the hall. He doesn't know what happened, but he figures, I must be in heaven now. It's 4 o'clock in the afternoon when he awakens in the British hospital. In the room next to him is a kitchenette. What happens in a British hospital 100 years ago in a kitchenette at 4 o'clock in the afternoon? Anybody tell me? Gee. The teapot comes to a boil, and the tea kettle starts to whistle. Ooh. The Bedouin jumps out of his bed, runs next door, grabs the teapot, starts to smash it, beat it all over. And the orderlies and the doctor come in, they grab him, hold him, restrain him. And they say, Muhammad, what are you doing? He says, you have to kill these things when they're small. The central bank balance sheets of the world are no longer a teapot or tea kettle. Let's look at them. This is the Federal Reserve. We all see this all the time. We call this rainbow chart, something we put on our website at Cumberland Advisors. You're all welcome to come look at it. We now have 20,000, 30,000 visitors a week from that look at the series of central bank. But why they come to us, I don't know. The data is available to anybody, but I guess we make it convenient for them. All right, where are we? We were here, 900 billion in size, most of it treasuries. Then we had a little excitement called Lehman, AIG, a few other things. We had this big rainbow of Fed programs. They're running off. And now we're about 3 trillion and climbing every month. And a big pot of it is mortgage-backed securities, and the rest of it is in treasuries. And the treasuries are now long, intermediate, short. They're no longer just short. We all know this, so I'm going to go quickly. Here's the liability side of the Federal Reserve's balance sheet. We're familiar with this one, too. Essentially, here's what matters. Currency in circulation, we're a little over $1 trillion. Pictures of George and Ben and others. Roughly 2/3 of it circulates outside of the United States. Gives us $1 trillion worth of a free lunch in seniorage. And the Fed now has figured out, right or wrong, that it can have long duration assets because as a practical matter, this is a long, permanent, infinite duration liability, and it can match them and is doing so. Whether it's right or wrong is a subject of debate. It will be debated at this conference all day. At the end of the day, we'll conclude that we don't know. Now everybody can go home. What's this? This is all the excess reserves that get created when you print money out of thin air, go into the market on a Tuesday at 11 o'clock out of the New York Fed, buy a $100 million Treasury bill, put it in your portfolio, pay your primary dealer. It goes into his bank account. 2 o'clock that afternoon, I knew it, there was a spot. 2 o'clock that afternoon, it's back on deposit at the Fed. 1:59 that day, it got into George's bank. He had to make a decision. Do I hold it and earn 0? Or do I earn 25 basis points and put excess reserves at the Fed? He makes a business decision. So for 3 hours, the Fed has created $100 million, added a security to its assets, and that was the transaction. That's happening $85 billion a month gross. Some of that is replacing roll-off securities, and that's the current policy of the Federal Reserve. Now, the big question that will be discussed today is how's this going to be resolved? Is there an exit strategy? When does it end? And once it ends, does it plateau? And after that, does it decline? And the answer is we don't know. But there's a paper out for erudite authors. Wrote it. One of them was Rick Mishkin, who was a governor of the Federal Reserve. And essentially what they did is make some assumptions, all of which are wrong, but they're close, maybe. And they said, this is what it's going to look like if we have the following. We extend the policy. We peak up here somewhere. There's a distribution of the treasuries, which I'm ignoring. I lumped them all together in the slide. And then we're going to start to taper down. And in 2020, the size of the assets of the balance sheet will be somewhere about $1.7 trillion. Now, in our view, in our firm, in our work today, we don't have a clue what the size of the balance sheet will be then. It might be $1.7 trillion. It might be $2 trillion. It's not likely to be much smaller than $1.7 trillion. Okay, that's the asset side projected in the Mishkin paper. There's the liability side. And the liability side would have said, well, okay, by then, under certain growth assumptions, certain inflation assumptions, certain worldwide economic assumptions, currency will be somewhere around the $1.7 trillion. That'll be the liability of the Fed. And the Fed will either roll off the balances or they'll sell. Will they sell? Or will they not? Well, in the most recent Bernanke speech, essentially Bernanke said it's not likely. He implied that it's not likely we're going to sell. Now, think about selling from a central bank. Cyprus, a little speck the size of Camden, hears from the European finance ministers that you've got a little gold and you may have to sell some of it. Was there a market reaction? Markets are traders. They front-run every piece of information. There's 30 people I work with every day, and they spend every single day, at least part of it, I hope, figuring out how to be ahead of the market. The Federal Reserve announces they're going to sell $100 billion worth of securities. What do you think the market's going to do? Calmly sit by and do nothing, or change pricing in anticipation of a large seller? So I believe the folks who make these decisions at the Federal Reserve, and I cannot speak for the Federal Reserve. All the opinions that are given here are my own, not the Global Interdependence Center, not the Federal Reserve. In some cases, not fully my firm, although there is an influence there. So you think about selling. It's not likely to happen. And Bernanke has implied that in his recent statement. So what we're saying is if you go by the Michigan paper, we're going to roll it off. And if everything goes perfectly, we will benignly reach some equilibrium in another 5, 6, 7, 8 years. Okay? What is the goal? Well, the stated goal today is 6.5% unemployment, the Evans rule, after the president of the Chicago Fed. You see statements saying that's too high. There's talk from different FOMC members that talk about 5.5 and 6. You don't hear anybody talking about 6.5 or 7. So we have a bias towards lower. But 6.5 is a number. And the requirement is that 6.5 be reached in the unemployment rate as long as the inflation rate remains 2.5 or lower. And that's a more general term, but it's assumed that inflation is directed at the personal consumption expenditure deflator, PCE. So that's more or less now a stated goal or target. Well, we did a table which you can't read, but there's a way to get to look at it in the handout. There's a handout and guide to the slides, and I'll email anybody who wants the slides, and if you want to take a look at them, we'll send them to you. But what we did is just use a table to create a model to say how many jobs do we have to create at a certain growth rate, that sort of thing. And we tried to depict this in this slide. About the only thing I know about the slide is it's an estimate, and it's subject to a wide band of confidence. Bob Eisenbeis, my partner, helped put it together. Essentially what we did here is said, okay, what GDP growth rate do we need to create enough jobs to get the traditional unemployment rate to 6.5%? And the answer is something like this. When will we hit it? Something between 2015 and 2017 if you use this model. It's a model. Again, the only thing we know about models when we make assumptions and forecasts is that we're wrong. It's the only thing we know. Okay, here's another model. Different way to attack the problem. What kind of job growth do we need to hit 6.5% unemployment? Well, this is a simple case. If we get more job growth every month, we get there sooner. If we have 88,000 new non-farm payroll jobs, it would take a long time. And this is a monthly indicator that everybody watches. Makes a lot of hype on television. And more importantly is the revisions of the previous 2 months, because they really tell you something. But television can't work with a 12-month or 2-month or 1-month lag. It is limited to a 12-second lag. So we have to deal with this. But it's another model. If this model's right, we get there in a year or two. Now, I have issues, these are mine, with this whole notion of a 6.5% unemployment rate and using the U3 traditional calculation. There are people who think it's the right way to count, and there are others who feel differently. I'm in the differently category. So what we did is I put together a slide of the Beveridge curve, which takes job openings and the unemployment rate, and tried to depict the regime change that took place pre- and post-financial crisis. So this is how we attacked it. Here was the expansion. Here are the years and the dates. We had this recession, which was not only a down, tough, cyclical recession, but we also had a financial crisis, restricted credit, changed behaviors. We are still doing that. And we didn't come back from here. We came back from over here, and here's the expansion. So what this says to me is a question. Is the U3 6.5 the right target? I'm not so sure. Let's look at it. If you use a Phillips curve model, and I learned this from Harvey Rosenblum at the Dallas Fed, who did wonderful work on the Phillips curve, taking the issue of the unemployment rate, taking the issue of the inflation rate, trying to measure the trade-off between the two. And when you do that, if you try to do that with some linear construction, what Harvey showed in his work is the slope of the Phillips curve is a changing vehicle. So what I thought we might do is look at an engineering approach to this question. And so we created a Phillips curve, and here's that pre-crisis period that we had in blue. If you were to draw the slope of the Phillips curve then, it would have looked just like this horizontal line. Now we have this crisis, and now we're here, and we begin the recovery process, and now we're here. The structure here is called an underdamped oscillatory system, so my engineering friends tell me. Underdamped because the slopes change, which means the whole notion of a 6.5 and 2.5 Phillips curve model as a way to set a policy decision would assume damping so that the oscillations that are reflected in that data can be consistently observed, obtained, and depended on. In our view, the answer is you cannot do that. So the title of this conference, Can We Fix the Banking System for Good? The answer is no. Now we can all go home. Look, underdamped oscillatory system. Now, in an engineering construction, this is a very large gap. The Fed wants to close this gap. Says it wants to hit 6.5% unemployment on the U3, and it wants to do it within a 2.5% inflation rate construction. Okay, let's dissect the U3. So here's what we did. We put a slide together. We have the U3, 4, 5, and 6. We have this action. They run parallel because each successive measure has, in fact, all the component parts of the earlier one. And what do we see? When we disaggregate it, we see that the difference between the U6, which is not the Fed target, in my view, should be, if they're going to target at all, which is a separate question to be debated here today. They're looking at the wrong measure. So if you say, I want to use the U6, what's the gap now between the U6 and the U3? 5, 6 million people in the labor force. 3.5 points. So we then constructed an implied underdamped oscillatory system showing the crisis with the Phillips curve and taking the 3.5 point difference from history to look at the gap. It's a monster. Maybe by the year 2046, the Fed could close it because the Fed's tools are not designed to close an employment gap to start with. They have marginal impact in our view. Okay. This is another way to get into job creation estimates. Bob Eisenbeis helped do this. What we're trying to look at is weekly unemployment claims, jobs versus the covered labor force. What do we need to hit some equilibrium rate? Okay, our estimate, or Bob's estimate, is 273,000 non-farm a month on average. at the present size of the labor force. That's our estimate. By the way, it's wrong. We hope it's close. All right. What's happening with the central banks, the railroad across the desert, and killing things when they're small? Well, what you see on this slide is the G4 central banks. We've got 4 currencies here, the US dollar, the pound, the euro, the yen. And there's a reason why we added the Swiss National Bank, because Switzerland is now pegging its currency on a floor to the euro. So there are times when the Swiss National Bank grows rapidly in size because of inflows to Switzerland, and it's managing against a peg on one side. 1.2 to 1 is the current official number. Well, we started the collective G4, these 4 currencies, which, by the way, if you take them and you add to them all of those countries' central banks, economic entities, which peg their own currency to one of them, for example, Bermuda runs against the US dollar, Hong Kong, US dollar, Switzerland partially against the euro. Chile manages against the US dollar. So when you take the world and say, okay, I'm going to total up the 4 currencies and everything that connects to them, you have defined about 85% of the capital markets of the world in those 4 currencies. Now, all the rest are very important. I don't want to disparage Norway, Singapore, Sweden. Marvelous places to visit. But when it comes to the policy impact globally, these 4 count. One of them is going through some very unusual behavior. That's called Japan. We're going to talk about that in a minute. But the total is what counts. And that was $3.5 trillion before the shooting started. It's $10 trillion now, and these are our estimates of present policy as currently announced, converted to US dollars 1 year from now. And I don't know which month of 2014. But essentially, we guess that the total size of the G4, plus a little bit of Switzerland, will be $11.5 trillion. In other words, the growth rate of the size of the central bank's balance sheets is accelerating. Think about that. If we had this meeting 6 years ago, and somebody were to stand here and say, 6 years from now, we're going to come together at the conference, we're going to have the central bank's balance sheets of the world go triple the size, accelerate the growth rate, and when we do it, we'll have a large negative output, high unemployment worldwide, next to zero inflation. The short-term interest rate will be near zero. The long-term interest rate of high-grade sovereign debt throughout the world will be somewhere between 1% and 2%. Everybody in this room would have said, he's a nut. We should lock him up. And that's exactly where we are today. So let's take a look at this. There's the central bank that we know so well. Right now, the European Central Bank is lagging the horse race because of some internal constructions. There's a big debate in the ECB. Are they going to do another round? They actually did a $200 billion withdrawal early of liquidity, and there's now zero growth in the Eurozone for the entire year, arguably zero growth in the entire European Union for the entire year. That's 27 countries. And arguably zero growth in the European Economic Community. That's 31 countries. And if I miss somebody, I apologize. Zero growth, austerity, budgets, out of balance with debt ratios to GDP, subject now to a debate, depending on how you view Vince Reinhart's study. Reinhart Rogoff now has controversy about it because of some questionable data in one space. So those who have nothing to do late at night can read those emails and look at those and form your own conclusions. I have no opinion on the criticism. We expect in our shop that the ECB will use the only tool it has to construct additional liquidity input. And if it doesn't, the euro will just get stronger and stronger and stronger in spite of all the activity that we see, because this is now a relative value game. There's the other side of this balance sheet. Remember, on the bottom of these balance sheets, you see currency in circulation, paper. In the case of the ECB, lots of the euro circulate outside of the eurozone. It's not just us. The point of these slides is it's not just us. England speaks for itself. The other side of the balance sheet. Currency in circulation gradually growing all the time. Here's Switzerland. Same story. Now, let me get to Japan. That's the asset side of the Japanese balance sheet, and I marked a key date there in 2006. The only instance of a major central bank withdrawing from QE in any significant way is in 2006 in Japan. There was a regime change. They didn't know. They were managing against a zero interest rate. They didn't know how much excess liquidity they had created. They'd been doing it for years. The policy shift then was to take the equilibrium interest rate that was at zero. When you're at zero, you don't know what equilibrium is, because equilibrium is something lower than zero. So the idea was, we'll involve ourselves in transactions. We'll sell Japanese short-term government bonds. We'll absorb liquidity and excess reserves from our system. And we'll do it until we see an equilibrium rate clearing the market above zero. In this transaction, it took about 6 weeks. It was very ordered. It was unique to only one country, one government. The policy was announced in January and then reversed because of a quirk in the way the Japanese central bank has to make a decision, where the finance minister can ask the governance of the central bank out of tradition to delay the decision. So the markets expected something in January, then they didn't get it. Then they got what they thought was a surprise in March when they did get it. And the reason is this unusual political construction in the Bank of Japan. But the policy was put in place. How much was withdrawn? In U.S. dollar terms, about $90 billion, $88 billion was an estimate I saw at the time. And this is what it looked like on the asset side of the Japanese balance sheet. Essentially what they did is they took their equivalent of our treasury bills, sold them, and soaked up excess reserves. Now, on the liability side, there's the other side of the transaction. What happened in the markets in 2006 when one country made an adjustment out of QE for about $90 billion and took about $90 billion of excess reserves? If you go back and look at the transactions of that period of time, it was a stormy session of the markets. You wouldn't have liked the volatilities in the first half of 2006 if you were in the investment side, and you would have been worried about secondary effects. That passed. There were no other actions. $90 billion of withdrawal. Ladies and gentlemen, the excess reserves in the world are now $6 trillion. 5.5, 6 trillion. All the central banks are in one direction only, They are either stable or enlarging QE. They have not even reached a level of stabilization globally, let alone talk about the other side. All the short-term interest rates in the world now center somewhere a little way between 0 and 1%. All of them. When you take short-term interest rates and define the cost of short-term money at 0 or half of 1% or 1/4 of 1%, regardless of the currency, you do two things. You have to move the volatility and adjustment process among and between those currencies to something other than interest rates. In the old days, if you wanted to do a transaction in yen and you were based in euro, you could go into the market and make a decision. You could make a decision to buy or sell yen versus euro today and make the payment tomorrow, and you could place your funds in either currency at a rate of interest, and the rate of interest would arbitrage the difference between the currencies in terms of future price. When you take interest rates down to 0, you remove interest rates as the mechanism which has been that arbitrage for the last half century. So what do? You are shifting volatility to the currencies, to the foreign exchange markets. And we see it every day. Japan changes policy. Markets take off like a rocket. If Japan continues on the policy it says it's going to do with the new government, which is in office and very strongly supported by the populace, and the new central bank, which is a product of the new government, which has made its position very clear, in our view, it won't be long, maybe it'll be a year or two. We may look at a yen at 130 or 140. Now, in the old days, if you really believed the yen was going to be 130 and it's 100 today, you would go into the markets and arbitrage that difference in a trade. And a lot of folks did. But in the new days, you can't do it in interest rates. You can do it other ways, but you can't do it in interest rates. So what do? Is there anybody in this room who thinks in the next 12 months the yen will strengthen against the U.S. dollar? Raise your hand. Is there anybody in this room who thinks in the next 12 months the yen will weaken against the U.S. dollar? Raise your hand. Is there anybody in this room who doesn't care what happens? So if you're in the investment community, one of the G4 central banks has broken ranks with the tradition and essentially says, don't tell us what to do. And furthermore, who are you to tell us what to do? Look at those balance sheets. We're the ones who behaved for the last 5 years, and look at the price we had to pay in terms of deflation, no growth. Now, will Japan have structural reforms? That's a whole separate question. Will they alter their tax system and open up their economy? It's a whole separate question. But in terms of this conference, the issue is banking and central banking. And in this conference, the yen is on a tear. The only question is, what price? The G4 central bank has changed the regime. If the G4 central bank of Japan is in this new regime and it is acquiring assets through monetary creation with no short-run inflation impact. Long run's a whole different story. Short-run inflation impact. That creates an upward bias on every asset class in Japan. But because of the linkages and zero interest on every asset class in the world, and at the same time, The United States is doing it too. The UK is doing it too. The Europeans are taking a break. It takes them a while to make decisions. They need a lot of meetings to make a decision. And my view is, by the time we gather here a year from now, the ECB balance sheet will be up a couple $100 billion, euro or larger. It'll have to be. Second issue. We have something going on in the world called bail-in. That's the difference. That's the new technique of resolving troubled banks. We used to have something called bail-out. Now what happens, what's the difference between the two simply? Bail-out means when we have trouble, financial institution needs resolution, we use the taxpayer or the sovereign's credit to settle things down. In the United States, we had a financial crisis, then we blew up a money market fund, we had bank failures, we had a mess. What happened? We bailed out to the extreme. We took the federal government's credit through the FDIC and said we will now insure without limits the transactional demand deposit, zero interest rate deposit, in every bank in the United States without limits. You do not have to take your money from your operating business and try to hide it in 40 different banks. And we've driven the interest rate to zero so that the collateral is now trading at a negative interest rate if you try to park your money somewhere using repo. So we'll create a system. We will have the maximum bailout in the United States. You had an insured deposit in the United States. Everybody in the United States, 350 million of it, or 325 million of us, plus all the foreigners, trust the insurance of the FDIC. How many people in this room believe that if they put $250,000 in a bank, insured by the FDIC, and the bank fails, you will get your $250,000? Everywhere in the United States, all the hands go up. Now you think about that. The FDIC is headquartered in a town called Washington, D.C. It doesn't have enough money to meet the liabilities if they all came at once. It's an insurance operation that flirted with being broke. And we all believe it. It's a good thing, by the way. So, the notion of the insured deposit is sacrosanct. It's one notch below the deity until the finance ministers in the Eurozone attack it in Cyprus. Or Cyprus invited them to attack it, depending on which side of the story you get. Fortunately, there was a barrier between protection of the insured depositor and the attack, which would have confiscated a piece of an insured deposit in a Eurozone bank that had passed a stress test 18 months earlier. And that was a political system in a country where people vote. The barrier about insured deposits in the world was held by the Parliament of Cyprus. God bless them. And the shock taught the Eurozone finance ministers a lesson they had not paid attention to when they all voted. 16 of the 17 in a meeting voted to attack the insured deposit. Now, they all are running for cover now, but they're all politicians. And they're saying, well, they asked us to do it. Now, this is a finger-pointing game. We do it in our country, too. Anyway, it seems to me that when it comes to the insured deposit in the world now, it's become safer because of these events. What about the uninsured deposit? Well, in a paper in December, the FDIC and the Bank of England had a discussion about resolving troubled financial institutions using bail-in and said, implied in the language, the uninsured deposit is a liability of the bank, just like its debt, depending on its structure and priorities. In New Zealand, the governor of the central bank says, we can't price deposit insurance accurately. And if we have to resolve one of our 23 banks in New Zealand, we will use bail-in, which means depositors are in a different place than they were. In the Eurozone, in Cyprus, the uninsured depositors took a hit, and that final hit in one of those banks will be somewhere between 40 and 60% of their deposit. We're about to see this test in a country called Slovenia. In Canada, on page 154, 144, if I don't get it right, email me and I'll send you the link. I've got a piece I haven't published yet, but I'm writing about it. In their master economic plan, there is a discussion about using bail-in techniques and the uninsured depositor. Remember, an uninsured depositor is claimant on a bank, just like a bondholder or a note holder, depending on the structure. Depending on which governance you use, that uninsured depositor is ahead of a shareholder, ahead of a preferred shareholder, ahead of a bondholder, behind a bondholder. Now here's my point for the central banking question at a conference like this where you'll have diverse views. If you take a structure which is bail-out, meaning sovereigns and taxpayers are supporting the backbone of the credit and safety of a banking system. There's a question about the strength of the sovereign, but the pledge is to have the sovereign and the taxpayer support the backbone of the banking system. And you switch to a regime in which you have bail-in instead of bail-out, and therefore part of the deposit structure of the banking system. The insured part is believed, but the uninsured part, which is commercial enterprises, large organizations, transactional deposits, worldwide trade, the insured part, the uninsured part, is now subject to bail-in. Have you changed the credit multipliers, the money multipliers of the entire system? If the answer is no, we will have huge long-term impacts from these larger central bank balance sheets. But if the answer is yes, and you have been shrinking those multipliers, and the multipliers are multiples of those reserves, so that if you raise the reserve by $1 trillion worldwide and you shrink the monetary credit expansion, which is tenfold on that $1 trillion, you may not be creating enough reserves. In fact, monetary policy may be too tight. We do not know. We do not know what multipliers are in a bail-in regime. We do not know how deep the bail-in regime is being impacted in decisions and reflected in transactional decisions. And the only thing we know is we have some other phenomenon going on. We have this huge mass of rising currency. Think about that. We have this huge mass of rising currency in circulation and all these regimes being created by these central banks who are forecasting a continuing rise in currency so that way down the road their liabilities and assets will close at some big number out in the future. The day of electronic money growing rapidly, currencies rising. Bill Dunkelberg said, I want you to be provocative. I hope I did it. Thank you very much. I I have 7 minutes for questions. I see Bill Poole. I was waiting for him.
David, I have two observations and then a question. One observation, this is a room full of economists. I think that's right. Second observation, from the literature, the best model for predicting exchange rates is the random walk model. So my question is, why all those hands up there when you ask the question about the direction of the yen?
Why all the hands up about the direction of the yen? Well, I'm a markets guy, Bill, and I think there's a momentum trade in the yen, and I wanted to get a sense of the room, and it looks like I'm on the right side of the trade today. And my task now is to sell one day before everybody else does. Thank you. Comments, questions? Sir.
I'm not an economist. I'm just a northern guy. When you start talking about, when you say, I don't know, it gives you a lot of credibility. I talk to experts. They know everything. They're never wrong. So it's good to hear that. The question is, when I hear all of this, and believe me, I'm clueless on this. This is way, way over my head. But I'm hearing that I want hard assets. I have some land in Texas, and I'm feeling better and better about that because it's land in an area that's growing. When I look at the cash that I have invested with Merrill Lynch, I think, well, that's nice. That'll be okay. But I hear that flittering away. I hear the land and assets being real. And I wonder if you could comment what somebody, an ordinary investor, does.
The question is whether assets, land in Texas particularly, have an upward bias in price. Is that good? I have no idea where the land is in Texas. I hope there's no radioactive waste buried underneath it. If you print an extra $1 trillion out of thin air in the next year and you do it in 4 currencies, and those 4 currencies drive capital markets of the world, and we have now created a situation in which markets want central banks to keep doing it. Markets, in our view, we manage a few $1 billion of other people's money, and we own no land in Texas, sir, so we have no bias. Markets want central banks to keep doing it. And as long as central banks keep doing it and say they're going to keep doing it, asset prices, art, collectibles, real estate, stocks, Bordeaux futures will rise in price because the stuff that you pay for them with is being cheapened. It can be created without limits. Now, do you get inflation in consumption elements? Does the CPI start to rise? That's a much harder question. You need a transmission mechanism. And I don't understand a transmission mechanism. You're going to hear this afternoon from Bill Poole, who, in my view, is an authority, Professor Poole, and a good friend who has examined that transmission mechanism all of his adult life. It's not working now. Does it work later? Maybe. Maybe we have enough economic recovery in the United States. We employ 10 million more people. We go back to an equilibrium rate, and we have rising labor income, and the credit system heals, and we have a credit multiplier. Yeah, we'll get inflation. When's that going to happen? I don't know. So good luck with the land in Texas. And the only thing I would add to the land in Texas, if it doesn't appreciate in price in Texas, pick it up and move it to Nevada. Yes, ma'am.
One of the value propositions that the banking community provides its depositor is an assurance that the money will be protected and available upon demand. And having been in Africa and witnessed people paying banks for that service because it was viewed as a service that warranted investment, I am reminded of witnessing a new kind of industry, an informal industry, taking shape in the United States, where money is transacting through the internet without a bank, without anything except a transaction. There's a service that's taken shape in Oregon, another one that I know of in Colorado, where people are simply relaying exchanges of money, deposits paid. I have not yet seen a credit card company accept such payments, but I expect that within a year or so, we'll start to see that they will accept it. So you're having relays of dollars without stock, as a service, without the value proposition of real money behind it. Where do you see that going in light of the issues that have arisen with the Cyprus predicament?
The question is electronic transfer rapidly among parties. And what isn't clear to me, are you talking about the Bitcoin phenomenon, or are you talking about dollar to dollar within a currency transfer?
I'm talking frankly about both.
Okay. Electronic transfer is accelerating. And there's a real question about how it's even accounted for. I don't think we even know the volume. I have in my pocket money, looks like this. We all know what it looks like. And I have in my pocket money that looks like this.
You could have a smart chip that
Yeah.
you can put into your smartphone and take a payment from me for advice you gave me.
Well, that's right. And if it cleared in an instant. Now, here's a question for you. Let's assume you're right. It's a growing trend. There's no question about it. So it continues. Why is currency also growing? And by the way, the most popular bill is a $100 bill, and 2/3 of them are outside of the United States, which has a separate message about underground economics or things that are below the radar screen. So it's a fascinating question. I don't have an answer. I do have an answer about Bitcoin. I don't know what Bitcoin's going to be. If Bitcoin, all I do know is Bitcoin is a new version of a tulip. And we'll find out what Bitcoin amounts to. It's kind of hard for me to visualize it. So I don't know that I could say any more. Fascinating question. 5 years from now, we'll know a lot more about it. Do I have time for one more, Bill?
Sure.
One more. Last question.
From your perspective, should we as depositors be concerned about FDIC?
I don't believe so. I think the FDIC in the United States is one of the premier federal agencies, and it will. The United States doesn't default. We flirt with it politically, but we don't default. And the FDIC, in a pinch, could get as much money from the Treasury as it needed. So, a practical matter, insured deposits in the United States, I believe, are very, very safe. The Eurozone, I do a little work in Europe and do some discussion with central banks there, and I will tell you that the bankers did not want to do this in Cyprus. This was a political decision driven by finance ministers who didn't listen to their bankers and central bankers who said, don't do this. You will create a monster. Well, they did. Now they go back to the bankers and say, fix it. Now, and you have strange politics. You have the finance minister of France who voted yes, saying, I didn't want to do it. Okay? And you have the governor of the central bank, Christian Noyer, who, by the way, is a global citizen and a member of the Global Interdependence Center, who will endorse protecting the insured deposit and will say we have to get to a model like the FDIC. We have to do it our way. It has to have our supervision. We have to have our rules. We've got to amend treaties. But that's where we need to get to. Why does his finance minister vote yes? So the politics are not totally clear yet. I'm not worried about the FDIC. I think there's a different question for an uninsured depositor. In my firm, we're a little firm, 30 people. We run our firm with a single-digit million balances. And my CFO says, I'm going to take money and distribute it 250,000 limits among banks because electronically I can govern our payroll and payments and safety, and I'm worried because I've been listening to your speeches too much. What do you think? And I said, do it. And excess liquidity in our firm is now in securities, in safekeeping and hedged, not in an uninsured deposit. Now, there are two reasons for that. Number one, I can get a higher interest rate than I can get from a bank, and I feel safer. And so we're doing that for more and more institutional clients. That says something about shifts in uninsured deposits. Be interested in see what other speakers say about the cessation of protection of uninsured deposits in the United States, which took effect on December 31st when the law expired. I got real quick, last one. Huge number of changes in the labor force and the composition of the labor force. I agree with you. Absolutely. Where it will lead, we don't know. And the only thing I can say about all the forecasts is that they come with a guarantee. The guarantee is this. We assemble here a year from now. You bring back the forecast. If it's mine, give it back to me, and I guarantee I'll give you a new one. Thank you very much.
My slides, but it's very important. This comes with the IMF disclaimer. None of what I present today represents official IMF policy, not even close, right? It's research. So what I'm going to structure my talk along these lines here. First, a very brief introduction. Then I'm going to go into how we should be thinking about banks in our models, and not just that would seem like a geeky question, but it's actually really, really important for how we think about banks in the real world. There's a very close relationship. There's a lot of very misleading statements being made, including in the media, about how banks work. And I first of all want to set that straight, because it is actually fundamental to the Chicago Plan. The insights that I'm going to discuss there were insights that Irving Fisher and others had in the 1930s that have been almost completely lost today. Then I'm going to talk about the advantages of the Chicago Plan. That's the bulk of the paper. Then there are a lot of questions that I have received since publishing this paper in August 2012, and I'm going to address the most important of them. Then I'm going to go through a little application of what I would call a mini Chicago Plan, namely another way to resolve bad debt problems in the banking system through a central bank purchase of NPL, non-performing loans, then summary and discussion. Okay, so this slide states a few obvious things, but let's start with that. The Great Recession obviously revealed very serious weaknesses in the financial system. The financial system is where everything started. It triggered significant financial system reform, monetary reform. But what I've been doing, and I've been doing this for about 8 years, is I've been doing reading about monetary history and the history of monetary thought. And I discovered that at the time of the Great Depression, the level of the debate was actually, in many ways, more profound, far more profound than what we have today. And I will explain why that is. And that debate culminated eventually in the 1933 and 1935 Banking Acts. But in competition with that was the Chicago Plan. And part of the reason why the Banking Acts were passed is that the banking lobby was even more strongly opposed to the Chicago Plan. And so the Chicago Plan was actually supported at that time by a majority of the leading macroeconomists. It was actually created by Frederick Soddy, who was the Nobel Prize winner in chemistry from the UK. That tells you that sometimes non-economists have much more profound thoughts about economics than economists. Then Irving Fisher, Henry Simons, and Frank Knight, both of whom were teachers of Milton Friedman, and Milton Friedman also supported the Chicago Plan a little bit later. What the Chicago Plan proposes is the separation of the monetary and credit functions of the banking system, i.e. for the deposit or liability side of the banking system, that those deposits have to be backed 100% by public reserves. And secondly, on the credit side, on the asset side of the banking system, credit cannot be financed by the creation ex nihilo, out of nothing, of bank deposits. Because we had just had a talk which said that a central bank can create money out of nothing. Banks can do that too. And on a far greater scale if they wish to do so. And I will explain how that works. And so today's talk amounts to comparing the characteristics of the Chicago Plan world and the world that we have today, and transitioning between the two, and what good that would do and what the problems would be. So, some key insights on banks. The key function of banks is money creation, not intermediation. And if you tell that to a mainstream economist, that's already provocative, but it is 100% correct. Okay? What banks do, and I was a banker at Barclays Bank for 5 years, I made loans, I know exactly what the entries are that you need to create when you make a loan. You create a new loan on the asset side of the balance sheet, and when you do that, you create a new deposit of exactly the same amount that is credited to the guy who has just borrowed from you. Okay? So this is the only time I'm going to use this little board here. When the bank makes a loan, its balance sheet is like this. When it creates a loan, it creates an additional loan entry here, and the customer, let's call him X, that's the customer X, and it creates an additional deposit entry here, change in deposits, delta D. It's also in the name of X. The bank, at that moment, creates new money out of thin air, and I will go into more detail about that now. Now, how about intermediation? A common definition of intermediation is that the banks, or the banking system as a whole, and it's important to make that distinction, accepts non-bank deposits of savings, somebody's savings, and then lends those savings out to somebody else who needs them. Okay? Under this definition, banks are not intermediaries. They never, ever do that. Okay? Because what they do is this. And this is not intermediation because this guy, X, is the same. So in terms of causation, the critical issue here is that loans come before deposits. Loans create deposits, and not vice versa. What the intermediation story misses completely is the monetary nature of financing. So let's go into more detail now. What story would I have to tell the intermediation story? Well, let's have a scenario where A wants to buy goods or assets, doesn't matter, and B wants to sell goods. Now B dumps the goods at the bank, and a deposit is recorded. And then the bank gives the goods to A, and a loan is recorded. That story is, of course, complete nonsense, because that never happens, right? But that's how you have to argue if you say that banks intermediate funds, intermediate savings from some guy to some other guy, because that implies that deposits come before loans. What you have to ignore for this is, of course, if somebody comes into Bank A and brings in a check that's drawn on Bank B. That's a micro-phenomenon. That doesn't change the overall amount of loans and deposits in the economy. It just reshuffles them between different banks. That's not relevant for this argument. And cash deposits are also not relevant. First of all, cash is a tiny item in terms of the overall bank business. And banks never lend out cash directly. You only draw out cash against an existing deposit. So the intermediation story is a completely impossible story, yet it dominates in today's debate. It is also known as the loanable funds story. The money creation story, we start with the exact same scenario. A wants to buy goods, B wants to sell goods. Now, A goes to the bank to get financing, and B stays at home. He has nothing at all to do with this. Okay? A gets a new loan of $1 million and a new deposit of $1 million. What the bank has done here is to create its own funds, deposits, in the act of lending. It has not had to wait for anybody to deposit something first in order to make the loan. It created its own funding. That's, of course, an absolutely extraordinary privilege that's not enjoyed by any other kind of business. Then what happens is that A uses this new deposit to pay B to get the goods or the asset. So then it looks like intermediation has happened, because then it's going to be somebody else here on the liability side of the balance sheet. But the bank at that point does nothing active. The bank just provides check clearing services so that people can exchange the money that has been created among themselves for their business needs. The actual purposeful activity of the bank has been the creation of new money. And of course, it can also destroy money. This story happens every single time a bank makes a loan. And it is completely different from the loanable fund story. The implications is that new loans involve no intermediation, no funds are being withdrawn from previous users as savings. And that means, and that is absolutely critical, and for Irving Fisher it was front and center, is that banks can easily start a lending boom. Because if they can do this, they can simply grow their balance sheet by expanding the money supply, the broad money supply, that is, of course, not the narrow money supply. Okay? They do not have to attract deposits of pre-existing money. And it makes no difference, I already mentioned the next point, that it makes no difference if the deposit is transferred to another bank, because if the deposit goes to another bank, this bank will have to reborrow it in the interbank market, but for the overall banking system, once this deposit has been created, it remains in the banking system. Okay? Prior to either a default on or repayment of the loan, the underlying loan. I will briefly explain next, so hang on there, that reserves or cash balances impose no limits on this process. That's the deposit multiplier story. The deposit multiplier story is wrong. The only constraints on banks in this process are solvency and profitability. The bank will ask itself, if I make this loan, am I going to get a high enough interest rate given how much capital I have to put into it? And is there a too high a risk that this loan will default completely and wipe me out? That depends entirely on the bank's sentiment of how the economy is going. And this kind of optimism can be extremely volatile. And so our regulation of the money supply, the broad money supply, the liability side of the banking system, depends on this sentiment of the banking system about how the economy is doing. On very little else, there is one thing, there's the policy rate. I'll get to that towards the end. But it is a relatively weak influence. So this is, I have various quotations from various people here to back up the statements I just made. Most of them are brief, but this one I want to list in full because it is so beautiful, it is so insightful. It comes from Schumpeter, 1954. So let me read this out to you. But this makes it highly inadvisable to construe bank credit on the model of existing funds being withdrawn from previous uses by an entirely imaginary act of saving. Imaginary. And then lent out by their owners. It is much more realistic to say that the banks create deposits in their act of lending than to say that they lend the deposits that have been entrusted to them. The theory to which economists clung, remember he writes in 1954, so tenaciously makes depositors out to be savers when they neither save nor intend to do so. It attributes to them an influence on the supply of credit which they do not have. And now we go into a very interesting bit of history which is relevant to where we are today. Nevertheless, it proved extraordinarily difficult for economists to recognize that bank loans and bank investments do create deposits. In fact, throughout the period under review, they refused with practical unanimity to do so. And even in 1930, when a large majority had been converted, etc., etc. So where we are today, if you look around the academic literature, for example, is in some sense prior to World War I. The loanable funds model dominates again. We have lost a lot of the lessons that Fisher, Knight, Simons had learned by the 1930s, painfully learned, because for many decades in the interim, banks have been almost completely off the radar screen of macroeconomists. So we're starting again at a point that's almost pre-World War I. For Fisher and all the people who supported the Chicago Plan, this insight was key. And it will be incorporated in our own work. Here are some statements from central banks. I'm going to be very quick here. The first one is from the Federal Reserve Bank of New York working paper, which basically tells exactly this story here that I have on the board. Graham Towers, former governor of the Central Bank of Canada, each and every time a bank makes a loan, new bank credit is created, new deposits, brand new money. Then there's a statement from the Bank of England and from the Bundesbank, which essentially says the same thing. They're all contained in the paper, or most of them anyway. This is a little corollary to what I just told you. It's relevant, and I included it here because Jeffrey Sachs is going to talk later, and this is relevant to development economics especially, but not only. Bank finance investment does not require prior saving. So very often among macroeconomists, you hear the story that, oh, this country needs to have more investment, so we need to generate more savings so that there is enough saving available to finance the investment. This is not correct. What happens if you finance investment, at least to the extent that investment can be financed by a banking system, before any saving or investment comes a new loan and a new deposit. This new deposit is obviously not yet saving because the net of these two things is zero, right? X has not net saving of zero. But by providing new purchasing power to X, it allows investment to go ahead. He can use this now and buy a machine. And then the seller of the machine acquires the deposit, and then it becomes saving. Then this guy has exchanged that machine against some financial asset that he's saving. And saving is equal to investment in the macroeconomy, in the closed economy at least, and the investment has actually happened, right? That was the buying of the machine. But this saving is a consequence of lending, the creation of money and investment. So for economic development, this is an absolutely fundamental insight. Saving is not always a precondition for investment. Rather, it is a byproduct of efficient investment finance. Okay, I'll leave it there. The deposit multiplier is a myth, is my next point. This goes back to the point earlier that reserves do not impose a constraint on banks' money creation. The deposit multiplier story is, you can always calculate that number, broad money versus narrow money. You can calculate that number, but that number is not a transmission mechanism. That's all I'm saying. So the deposit multiplier story is that the central bank fixes narrow monetary aggregates first, and broad monetary aggregates are the endogenous results as banks on-lend this money in multiple stages. You've all seen it in the undergraduate textbook. Killen and Prescott Nobel Prize winners refer to this as a myth. Why? Because it actually turns the monetary transmission mechanism on its head. It's upside down. Now, what they showed for the monetarist era is that broad monetary aggregates lead the cycle, and broad monetary aggregates are created by banks, and narrow monetary aggregates lag the cycle, and they are under the control of the central bank. In other words, the banks decide first, and narrow money follows. These numbers there of the leads and lags are not from Killen and Prescott, they're from Steve Keen for more recent data. In the inflation targeting era, it's even more fundamental. If you control a price, in this case the interest rate, you have to let the quantities adjust, and the quantities is reserves, meaning the central bank has a duty, if it sets the interest rate at a certain level, to ensure the stability of the payment system, to supply the payment system with the reserves that it needs at that interest rate. The evidence for this statement is completely overwhelming, both in institutional and empirical terms, and here are some supporting statements from first Vice President of the New York Fed, 1969. At the time, from what I know, he was arguing against the introduction of monetarism under a fractional reserve banking system. His key sentence, it's a very interesting statement altogether, but I just picked the key sentence. In the real world, banks extend credit, creating deposits in the process, and look for the reserves later. That is exactly the story that I just told you. Carpenter and Demirel, a Federal Reserve Board working paper. So this was cleared for publication at the Federal Reserve Board. The relationships implied by the money multiplier do not exist in the data. the textbook treatment of money in the transmission mechanism can be rejected. ECB monthly bulletin, less than a year old. The euro system, however, always provides the banking system with the liquidity required to meet the aggregate reserve requirement. Always. No questions asked. There are exceptions, but only at extreme times. I come to that right now. So the conclusions. When banks ask for reserves, the central bank obliges. The transmission, therefore, starts with loan creation, which equals deposit creation, and it ends with reserve creation. In normal times, of course, now we have QE, we have a lot of special things going on. I'm actually, this is important to emphasize, also in light of the previous talk, I'm talking about banking in normal times. There's a lot of special considerations right now. Banks are, because of what I just said, banks are almost fully in control of the money creation process. The only tool the Fed has for affecting the money supply is a very blunt tool, the policy rate. And how do you affect the money supply? Well, you have to keep banks from lending, the broad money supply. You have to keep banks from lending. And the only way you can do that is by making their borrowers not creditworthy or borderline not creditworthy, so that banks are too scared to do this, or the borrowers don't want it themselves. You have to drive them into bankruptcy, literally. Now, when I presented this paper at the Fed 2 weeks ago, there were some people in the audience who, by the way, nobody disagreed with me on any of this, but they basically said there was a very short period during Volcker's tenure, right at the beginning, when he was willing to use the policy rate for this very blunt purpose. But those are extreme times. Okay? All right, so having set the stage, now the 6 advantages of the Chicago Plan. Fisher identified 4 advantages. We found 2 more, and this summarizes them. Dramatic reduction of public and private debts, complete elimination of bank runs, much better control of credit cycles, output gains, and elimination of liquidity traps, and therefore the possibility of zero steady-state inflation. By the way, Fisher's book from 1936, I'm talking about the short one, 100% money in the public debt, about 25 pages, the most exciting piece of monetary economics I've ever read. And there's not one equation in there and not one bit of econometrics. It's just super deep thinking. Highly recommended. So the 6 advantages of the Chicago Plan. Detail. First, dramatic reduction of public and private debt. And we have to start going through the balance sheets here. And I tried my best to lay this out as clearly as possible, starting with this banking system balance sheet. I say current, what I actually mean is 2006. So we calibrated this roughly to 2006 prior to the crisis, because again, many things subsequent to that are very special. And this is from the flow of funds and various other data sources. All numbers are, this is all for the US, and all numbers are in % of GDP. So we have banks holding some government debt, but most of it is actually held outside the banking system and in fact outside the country. Then we have 80% of GDP investment loans. That is both for corporate investment and also for housing. Then we have 100% of GDP other types of loans, which we have mortgages against land. I make a distinction between housing, construction, and land. And then short-term working capital loans for firms and short-term consumer loans for households. So we have 4 different loan classes here, and all of them are carefully calibrated. We did a really intensive job to try to map the financial system to a modern business cycle model. On the liability side, we have deposits, and notice there I go into less detail. This is a very broad category of deposits. Some of them are transactions balances with 0 interest. Some of them are much less liquid, but still liquid balances. Money is a spectrum. Money is just not one thing, not just one thing that is cash in your wallet. Money is much broader. Everything that can be used for transactions, and some things are used more and some things are used less, and therefore some things pay a lower interest rate and some things pay a higher interest rate. We lump all that together. And then we have bank equity, and this is a model, state-of-the-art model that manages to map the Basel III regulations into a modern banking system where there are penalties on having too little equity. Okay? Now, what does the Chicago Plan amount to? The Chicago Plan basically says the government now goes to these banks and says, look, you have these deposits, 184% of GDP. from now on, you have to back these deposits with reserves of public money, 100% reserve cover. So you need 184% of GDP of that, which at this point simply does not exist. Right? And so the way you get it to come into existence is by borrowing it from the government, the central bank, the treasury, what have you. And so how do I get these reserves? I basically, as the banking system, I issue an IOU to the government. I borrow these reserves from the government by paying a little interest rate on it. Okay? So the balance sheet still balances. And now we can rearrange this. This is all the elements here are exactly the same. They're just in different places. We rearrange this into what I call money banks at the bottom and credit investment trusts at the top. And the money banks are basically just a warehouse for reserves of public money. You can think of this reserve of public money as the cash in your wallet, but in the real world it will mostly take the form of electronic cash. But in legal and functional terms, that's almost the same. Right? And I'm abstracting from banks needing equity for this kind of activity. It's just managing a payment system, providing ATMs, providing sophisticated SWIFT facilities, etc., etc. The credit investment trusts now still have the same bank equity, they still have the same loans, but they're now entirely funded by government. So that's not the end of the story. In case that makes you nervous, there'll be more. Okay, so right now it looks like credit is financed 100% by government. That's by no means necessary, and I'll show you the next steps. So what the government now has at this point is a debt of the gross debt outstanding of 80% minus the 184% that it has lent to the banking system. So the government has a very negative debt position. I'll show you the government balance sheet later. What it can do with this windfall, and this windfall, by the way, is essentially the government reappropriating the seigniorage for money creation that banks have been taking in over the decades by creating deposits out of thin air. The government is reappropriating that seigniorage in one step. Okay? For the benefit of everyone, as I will show you. What it can do with that is, first of all, retire government debt that is held by banks as it comes due, or prepay it. That's a question of detail. In the model, it happens immediately. In the model, everything happens immediately because it's much easier to see what's going on. Okay, so then the credit investment trusts become a little smaller in terms of their balance sheet. Now the next step is that this treasury credit is essentially the government having a huge bank account in the banking system, being a huge depositor in the banking system. And the next step of the Chicago plan would be a citizen's dividend, where the government just says to every citizen, you get something like your annual income as a one-off citizen's dividend. I redistribute this seigniorage to you, every citizen. And in fact, the way I do it here is exactly 100% of GDP, so that would be an equal per capita would match up with the way I've done it quantitatively here. So the government has a smaller account now in the banking system, and the citizens have a larger account. And the way this would be done, and the way I conceptualize it in the paper, is that these citizens' accounts cannot be freely used for transactions, but the first thing they have to be used for is to repay any outstanding debt that's out there in the banking system, in the financial system more broadly speaking. And this is somewhat arbitrary, but I do it this way. I assume that this is exactly enough to repay everything except investment loans. Investment loans meaning the loans for housing construction and for plant and machinery. So, in this fashion, a huge chunk of credit is going to be repaid inside these credit investment trusts. And we end up with this balance sheet. The government still looks like it finances all remaining credit, but that's still not the end of the story. First, we need an intermediate step. If you have a Basel III regulation and suddenly the size of the balance sheet shrinks so much, then the banks need less capital in order to support their activities, so they're going to pay out a one-off dividend to their shareholders, and the government is going to inject some more treasury credit to make up the difference. Nothing changes with the size of the balance sheet. Finally, the government in this economy still has 60%, this is the US government, 80% of GDP debt roughly in 2006 is what we calibrated. 20% has been already repaid here. 60% is outstanding outside the financial system. This is not part of the model simulations, but the government could essentially repay that too and pay agents with these treasury credit balances, and we would end up with a situation like this. And the only reason why I'm showing that is that people get nervous when they see that all private credit is financed by government. And that means, oh, the government is going to dictate the terms of credit. First of all, even if the government were to be a major funder, it wouldn't necessarily imply that at all. The government could just set a price and let the banks get on with the business. But as you see here, you could also end up with a situation where there's just a very small slice of treasury credit outstanding, and everything else is financed either by private equity of the banking system, in the banking system, or by non-monetary private deposits. And by the way, this could also be, the government could also, instead of making this debt finance credit investment trust, the government could also convert its claims into equity and then distribute them to private agents. And then you would be in a world that's closer to Larry Kotlikoff's limited purpose banking, where all the credit investment trusts have to be financed by non-debt liabilities, i.e. by equity. Okay? Now, changes in the government balance sheet. Prior to the Chicago Plan, on the left, we have government bonds of 80% of GDP outstanding and some unspecified other assets. I don't care what they are, I just wanted this to be a balanced balance sheet. In the middle, then, is the first step of the Chicago Plan, 100% reserve backing. And so on the asset side, the government now has this claim on the banking system, and on the liability side, it has these reserves of public money. Now comes a very important very important argument here. These reserves of public money are not debt. What you have on the liability side of a balance sheet always is debt and equity, your own funds. Now, if you think about this, this is the current central bank issued money in the United States, and this is debt-based money. We saw that in the first presentation. This is on the liability side, and it's backed on the other side by government debt. So it's something very similar to a checking account in the bank. It's backed by debt on the other side of the balance sheet. But this doesn't seem to like coins or something. I don't know. This is a coin issued by the Treasury. And this is treated in official U.S. accounting conventions as equity in the commonwealth of the nation. It is treated as a one-off revenue when it is created. Of course, that revenue is probably negative because it costs more to make these things than it brings in. But anyway, the principle matters. This is treated as equity of the government as a one-off revenue. And what the Chicago Plan essentially amounts to is to say that all money in existence should have that same status as that coin that I've just shown you. Okay? And finally, on the right-hand side, we have the final government balance sheet. Net government debt becomes negative at the end of the day because not just, well, the counterpart to this equity position that the government gets is this high treasury credit, but then some of it is written off through the citizens' dividend, and at the end of the day, the government has less equity and a smaller claim on the banking system, but it still has a net positive claim on the banking system. So the government ends up with negative debt and a positive equity position. Complete elimination of bank runs is the third advantage of the Chicago Plan. That's, of course, pretty obvious. Once the money is basically public reserves, there's no reason why you should run on your bank, because you know the money is there. It's literally there. The government has provided the means of payment. The means of payment is provided by the government debt-free, as opposed to being dependent on the performance of a private debt liability on the other side of a balance sheet. Okay? Also, credit assets must be funded by non-monetary liabilities, and this is important. So this could be treasury credit, this could be bank equity, as in Larry Kotlikov's scheme and also in Henry Simon's Financial Good Society. Or it could be private debt, and I'm listing here various provisions that could be adopted to make sure that that private debt would not lead to money substitutes. And that's one of the important points that also occupied Henry Simon's a lot. I think I don't have enough time to talk about those provisions, but there are some effective provisions that would easily rule this out, I think. Next, output gains approaching 10%. Why do we find that? Now, this goes for the first time to our model simulations. But first I want to tell you the story. Why do we get such large output gains? Well, first of all, interest rates would be very much lower in a world where debt levels are very much lower. It's very clear. Any good model has, when the debt to equity ratio is higher, you have a higher real interest rate. And if you have a higher real interest rate, you have lower investment. So if you do a huge debt to equity swap, with the equity being the money, the equity in the Commonwealth, you get lower interest rates, higher investment, higher capital stock, higher output. You also get lower tax rates in this world because the government has a money stock of 180% of GDP that has to grow at the rate of real growth of the economy, and I'm assuming it's 2% in this economy, real growth. So you need to grow your nominal money supply at 2% just to keep the economy supplied with sufficient money. That gives you completely non-inflationary seigniorage of between 3 and 4% of GDP. That can be used to lower distortionary taxes, including taxes on capital, which we all know has stimulative effects on the economy. Third, lower monitoring costs. In the current economy, a lot of intelligent people have to sit there and monitor loans to make sure that the banks can get their money back. But not all of these loans, but a good chunk of those loans is there so that the economy can have an adequate money stock, because that's just the only way in which we can provide in this economy right now the broad money supply, through banks getting people into debt so that on the other side of the balance sheet there can be money. When people can have money in a debt-free way provided by government, that part of lending is no longer necessary, and the people who are deployed in the banking system to monitor loans for that purpose can be redeployed somewhere else and switch their job from Citibank to GE and make some real product. Okay? And we quantified the resource savings from that as well. And here are some impulse responses. So this is a model simulation. On the horizontal axis you have 60 quarters. On the vertical axis you have percentage point or percent differences. The dashed red line in each case is where the economy jumps in the very, very long run, whereas the blue line tells you how it transitions to that very, very long run. And essentially you have to start looking on the right-hand side. What we have here is the lending rate dropping by over 200 basis points because of this huge debt equity swap over time. The labor tax rate, and there's also the capital tax rate, is the same picture, dropping by 4 or 5 percentage points. This gives a big stimulus to the economy, especially to investment to the extent actually that it initially crowds out consumption a little bit. But that's specific to this simulation. And that leads to a GDP gain in this simulation of 10%. Now, all of these are very specific numbers, and they can be debated. But that's why we laid out the calibration of our model in great detail so that we can be criticized for that detail and not for the broad story here, because the broad story does hold together. Right? The details we can talk about. Finally, inflation in this simulation goes from 3% steady state to 0% steady state over that period. And here are the fiscal accounts. The only thing I want you to notice here, apart from the big drop in government debt and government deficit, is that here on the right-hand side, seigniorage, i.e. the revenue from money creation, increases by 3.6% of GDP, and we have assumed that this seigniorage is mostly used to lower various distortionary taxes by 3.6% and thereby stimulate the economy. Okay? Much better control of bank lending-driven business cycles under the Chicago Plan. Bank money creation becomes impossible. Now banks become the true intermediaries of our textbooks. They are no longer money creators. That makes it much easier to prevent credit cycles. What we show in our simulation is if you combine that with the policy of quantitative lending guidance, which is allowed for under Basel III in the form of countercyclical capital buffers, then you can actually really lower the amplitude of business cycle fluctuations. So here the black line is a simulation of a business cycle where banks for 3 years get more optimistic about the creditworthiness of their customers, then suddenly change course after 3 years. Their sentiment changes dramatically, and that leads to an initial boom followed by a very deep recession. You can see that in GDP. There's a drop of almost 6% in GDP at the end of the boom. What you can see here is that these banks create their own deposits in the act of lending. This is in the simulation. And then when the cycle crashes, both loans and deposits crash by enormous amounts. In this particular simulation, over 50% of GDP. Now, in the existing mainstream model of loanable funds, this is impossible. You could never have this. If banks were intermediators of savings rather than creators of money, you could not have this. Okay? Now, the blue dashed line is a simulation where instead we have the Chicago Plan economy, and what happens there is that these banks accumulate additional capital here. The Basel ratio is the ratio of capital to overall assets. They have to put aside, if they want to lend more capital in order to back their additional loans, so that when their change in sentiment, which is the same, when their change in sentiment happens after 3 years, they have a very comfortable buffer, and there is a very gradual reduction in loans, but the amplitude of fluctuations in GDP is very, very much reduced. Finally, no liquidity traps. The main tools of monetary policy under the Chicago Plan are nominal money growth rule a la Friedman and an interest rate rule that controls the price of Treasury credit to banks and the Basel capital adequacy ratio as well. So those are tools that are, except for the second one perhaps, that are known from the literature. With these rules, however, in this economy there can be no liquidity trap. A liquidity trap is when the central bank loses its ability to stimulate the economy either by creating more money or by lowering interest rates further. In this economy, and this is something that came out in the first talk, right now we have the pushing on a string problem, that the central bank can create as many reserves as it wishes. It's still pushing on a string because it wants banks to do this in order to create broad money, which is what people actually use in order to spend on goods and services and assets. And if the banks don't feel like it, or if their customers don't feel like it, then good luck. It's not going to happen, right? And whereas in this economy, in a Chicago Plan economy, the central bank would directly control the broad quantity of money by spending it into circulation or by lending it into circulation through investment trusts. And that would directly end up in people's pockets, quantitative easing for the people, if you like. Some people have called it that, and would stimulate spending. Okay? Also, there is no zero interest rate floor in this economy because the interest rate that the central bank controls, or the government more generally controls, is the interest rate on Treasury credit, which is the rate at which it lends to banks, and that can temporarily become negative. So that, of course, if you don't have a zero interest rate floor, then you can have much lower steady-state inflation, including zero steady-state inflation, and so you could have a much less inflationary economy here. Okay, now, in the interest of time, I have a lot of answers to common questions, and perhaps we can come back to those this afternoon when we have question time. But I want to get to one of them, which is the question of inflation. Will government control over money cause inflation? Inflation is determined by the relative quantities of money in private hands and the supply of goods. The quantity of money in private hands remains virtually unchanged when transitioning from today's economy to a Chicago Plan economy, and therefore it cannot be inflation. This cannot be inflationary. What changes is what money represents. And somebody at the ECB called that, in the current economy, what money represents is destructible money because it represents loans on the asset side of banks' balance sheet, and banks can either call in those loans or the loans can default, and therefore the money is destructible. The money under the Chicago Plan is permanently issued by the government is indestructible money. That is what changes during a transition to a Chicago Plan, not inflation. And here is an illustration of what happens, and what I'm highlighting here in red in each case is what is the quantity of money in people's bank accounts at each stage of the transition to the Chicago Plan. It never changes. What changes is what happens on the asset side of the balance sheets. Money takes on a different nature. The quantity of money does not increase, therefore no inflation. There's also a very long historical section in this paper that talks about what has been the historical experience with periods of private versus public money issuance. And contrary to what many will want to tell you, it's exactly the opposite of what they will want to tell you. Mostly the periods, in some cases that's hundreds of years ago, the periods of public money issuance have exhibited much more stability than periods of private money issuance. There's a very interesting section on the German hyperinflation. I'm German myself. It's completely misrepresented in much of the literature. If you read Schacht's own book, and Schacht was the Reichsbank president in 1923, he will tell you that this was an episode of hyperinflation caused by excessive private money creation, aided and abetted by, at that time, private central bank. Okay? And when he asserted the public prerogative, reasserted it in late 1923, he killed speculators and he stabilized the currency. Okay. A very brief application, because I believe I talked to Adair Turner yesterday, and he's going to talk a little bit about this, so I want to talk about it also. A mini Chicago plan. So we now have this spectacle out there in the policy debate where, various national banking systems have problems with potential insolvency of individual institutions. What if the central bank were to just purchase those non-performing loans? This has been done successfully in at least two historical episodes. The United Kingdom in 1914, which had made large loans to continental powers that were obviously not recoverable at that time, and also Japan in 1945, when basically everything was gone on the asset side of the balance sheet. And the central bank just bought those non-performing loans and exchanged them for reserves. What this does, and very successfully in each case, it simultaneously improves the balance sheet of the government, the banks, and private borrowers. It's a win-win-win situation. And understood correctly, this policy amounts to a small-scale version of the Chicago Plan, as I will show you. And it is, of course, it's an almost completely painless alternative to policies that resolve bank solvency issues through the destruction of part of the private money supply. The destruction of part of this. I'm not going to mention where that, but it's already been mentioned this morning where that is being tried. All the Chicago School economists would have been absolutely horrified by a policy that destroys your money supply or parts of your money supply and makes people nervous about the remainder of the money supply. Okay? So here's a brief simulation. The central bank starts off with some balance sheet. Banks have non-performing loans that far exceed their equity. Essentially, this institution would be insolvent. Right? Now the central bank purchases these non-performing loans by adding them to the asset side of its balance sheet and issuing reserves issuing reserves against that, and putting those reserves into the banking system. And we're assuming that these non-performing loans are going to pay off 40% of their face value. The banks are now in perfect shape. The borrowers are also, well, that depends what the government now does with its claims against the borrowers. But the banks are in shape now. Now, what you do is you raise the bank's reserve requirement to make sure that these reserves become a permanent feature of their balance sheet. You just say you have to keep those reserves from now on, for example, against all your checking deposits, something like that. Fourth, the banks remain the same, but the central bank now writes off the non-performing loan against the equity. And contrary to what you might think, the taxpayer has not lost anything here. The taxpayer had actually gained something, because the government has issued new money equal to 30% of GDP, which is a one-off seigniorage gain. And then it has leveled a charge against that equity of 18%, which is the non-performing portion of loans. The rest is a net gain to the taxpayer that can actually be used to reduce the debt. Yeah. And so, yeah, I'm done. Summary is, any decision on the Chicago plan, it comes down to a cost-benefit analysis, the benefits we've been through, the costs. Well, the transition might be a little difficult, potentially. The issue of substitute money is important, but what I hope to have demonstrated to you is that the benefits would be so humongous, or let's be more modest, would be so large that at least a reasonable cost-benefit analysis should be done to consider this, and to just reject it out of hand on the basis of, oh, the transition would be difficult, would be just discounting very large benefits, and I don't think that would be wise. So thank you very much.
Is a economics professor. I'll cut this very short at Boston University. Former senior economist with the President's Council of Economic Advisors, has consulted many different places, and will give you his wisdom.
Thanks. It's a great pleasure to be with you all. Well, I'm going to follow up that very interesting, extremely interesting talk, insightful talk by Michael with a discussion of limited purpose banking, how to fix the global financial system and with its all its instabilities. I'm going to look at the problems from a somewhat different angle. I'm going to try and talk about the fundamental problems. I mean, Michael's concerned about banks creating money out of thin air and causing instability from that. I think that's an important concern and issue. But I'm going to talk about two other issues that I think are even more fundamental. I'm going to get to that in a second, but I want to first of all kind of summarize where we are. And I think the big thing to say is that Wall Street, broadly defined, has become a very dangerous place for Main Street. We've had two global financial crises in the last 5 or 6 years, devastating impacts on hundreds of millions of workers and retirees. One was centered in the U.S., one was centered in Europe. Still ongoing in both places, I believe, fair to say. The next one might be centered in China. So what's really going on? Well, some people think it's bad assets. Here's a couple examples: sovereign debt and subprime real estate mortgages, bad assets. Other people think it's just bad banks. The bankers are the bad people, and the bad guys here. And we got all these banks. I should have added a couple Cypriot banks at the end here. Bank of Cyprus and Lycia should be added to this. So that's about 29 bad banks we could list right away. Other people think it's bad regulators, bad financial rules, bad governance, bad politicians, bad bankers again, bad disclosure, bad leverage, bad luck. Regardless of the precise cause, what we do know is that asset prices plunged and banks failed. And the question is, do banks always fail when asset prices plunge? Not true. If you look at the dot-com bubble, the NASDAQ fell 70%, the S&P fell 50%. There were no major bank failures. So why didn't the banks fail when the dot-com bubble burst? Well, they weren't holding the dot-com stocks, which were the bad assets of the day. So maybe the answer is to make the banks hold only good assets. That's one view that some people have. But that would kill the market for the bad assets. So maybe the answer is to have good banks that hold only good assets and have bad banks that hold only bad assets. And what are the good banks? Well, these are good banks, or commercial banks, and have good customers, which are retail customers, and they issue insured deposits, and they run the payment system. And then you've got the bad banks, that are investment banks and the hedge funds and the SIBs and the mortgage companies, and their customers are bad customers. They're corporations, rich foreigners, and other bad banks. So this answer can be refined. This is not my answer, by the way. This is the conventional answer as currently being defined. The good banks are supposed to hold only good assets. The good banks are supposed to behave. They don't do any trading and no derivatives. They don't hold any derivatives. Old banks hold more capital against risky assets. We stress test banks and adjust the asset mix as needed. We let the bad banks fail, and we arrange quick funerals for the bad banks when they fail. But we still let all the banks basically leverage 33-1. This is the new financial architecture. This is Basel III, This is Paul Volcker's view. This is Dodd-Frank's view. This is the Vickers Commission answer. There's a Lincoln solution in Europe, in the Eurozone, that's coming up with the same answer. Good banks, bad banks. It's the wrong answer. Here's why this is the wrong answer. This answer has 4 fatal flaws. First, good assets do bad things. Think about Greek government bonds, Italian government bonds. Excellent, safe, good assets, they did bad things. Bad banks are too big to fail. Remember Lehman Brothers? That was a bad bank. That was allowed to fail. Now, other banks failed, but they didn't fail. They weren't allowed to fail in a kind of clear-cut way like Lehman Brothers. They weren't allowed to go bankrupt. But even short of bankruptcy, Bear Stearns failing, it got rescued. It got, it ended up being sold for, in effect, $2 per share. But it failed. We had 29 banks now have more or less failed. And whether they failed through bankruptcy or just, through some shotgun wedding or some rescue by the FDIC or some similar agency, these are failures. And they're too big to fail in the sense that they psych the economy out. That's the problem with these banks failing. And in addition, they lead to the financial highway system breaking down, financial exchange breaking down. The stress tests, I think, are jokes. Lehman Brothers had a better, would have done better 3 days before it went under. There was a stress test on Lehman Brothers, and Lehman Brothers put out a statement that was approved by the SEC, which is Lehman's regulator, that was inside Lehman Brothers for like 7 months. And Lehman Brothers did better on that stress test than any of the top banks in the U.S. today. Okay, so these things are jokes. And the macro problem is the funeral, not the funeral arrangement. Because think about it. What happened after Lehman failed, which was, at the end of many other banks failing? Well, we had total panic in the financial system, and whether or not this mattered all that much in fundamental terms to the economy, it psyched out, at least in the U.S. case, millions of employers who decided that, gee, if President Bush is saying this sucker is going to blow, and John McCain is canceling his campaign to save the economy, and President-elect Obama, was whispering about the Great Depression, and everybody in the media is saying there's going to have a Great Depression, and Google searches for the Great Depression are going like crazy. If you check Google searches for the Great Depression September 2008, they just spike like crazy. We're going to have a Great Depression. So therefore, do I want to be still employing these people when my customers don't show up? No. I'm going to start firing my customers because I'm sure everybody else is going to fire their customers. And so we had a great pile-on of firing of employees, not customers. I'm going to fire my workers because everybody else, I think, is going to fire theirs. And I don't want to wait to do that. So over the next 17 months, we had 8.5 million Americans fired. It was like pile-on. It was, in some months it was 500,000 people being laid off per month. And had this all happened in one day, had 8.5 million people been fired on September 16th, the day after Lehman failed, we would have all seen this was a coordination failure. This was a collective panic. That everybody at the micro level took actions to make a terrible macro outcome. That this was a mobile equilibrium, as we economists say, that we could have people being confident about the economy and not firing, or people being sure everybody else was firing, and fire, and make that outcome happen, make it a self-fulfilling prophecy. So when the banks go down, they change confidence. They destroy a very important public good, namely confidence, because we have more than one place this economy can go to, and it depends on people's confidence. So the banks are in charge of two public goods, the financial highway system as well as public confidence. That's why we can't let them gamble with it, and that's what they did. So here's examples of good assets have gone bad. Lehman Brothers bonds, AIG stock, these are bad assets. There were good assets, perfectly good assets. Now, what are the next good assets to go bad? Maybe Chinese mortgages, maybe U.S. Treasuries. I think U.S. Treasuries are probably the riskiest asset in the world right now. I wouldn't touch them. 30-year bond, Treasury bond, I wouldn't touch that with a 1,000-foot pole. Now, will we let the big bad banks fail? No. We ran this experiment with Lehman Brothers. It blew up in our faces. So all we're doing is, in saying that we're going to let these big bad banks fail, is we're inviting a run on them, and then we're going to have to come in. So we're making things even more likely, more unstable. So what about the Treasuries no stress test? Well, again, 16 of the 19 top banks have much less Tier 1 capital than Lehman had 3 days before it declared bankruptcy. In 2008, trust took a holiday. No one trusted Lehman's books. No one trusted, not even the Treasury or the Fed, not the SEC, not the banks, not the public, and no one trusted anybody else would trust anybody else who was trusting Lehman's books. So this was, again, a coordination failure. I believe nobody else is trusting this financial institution. I don't want to be the last one to try and get my money out. That's what caused the run. It could well be that Dick Fuld, who ran Lehman, had it right, that Lehman was perfectly solvent in some sense. It had great assets. Lehman had a book of business that was this thick that nobody could understand, not even the SEC, the Treasury. It was too opaque. So I'm trying to get across the point that it wasn't the funeral arrangements, it was the actual funeral, the fact that these entities failed. And we had nationalizations, federal bailouts, one bankruptcy, shotgun weddings. It all psyched the economy out. That's the macroeconomic problem. It caused a massive coordination failure, and overnight we had millions of households and individuals, consumers, taking steps to produce a very bad recession. And it wasn't the flower arrangements that caused it was the funerals themselves. So what's the real problem with the banking system? Okay. The real problem with the banking system are these two things, which are barely mentioned if you look at the most recent British reform, which is the Vickers Commission, the word opacity is hardly even used. I think it might even be used 0 times in that entire document, 250-page document. It's leverage and opacity. So here's the point. Markets don't operate well in the dark. If you can't see what you're buying, and you're buying a promise that you can't really verify, it's a promise that might be fraudulent. So you start, as soon as there's a kind of a whiff of concern about that promise, your tendency is to try and get your money out and get it while you still can. Let's think about the 1982 Tylenol scare as an analogy. This is a good example of opacity. Now, what happened in 1982? How many people remember the Tylenol scare? Okay, most younger people here didn't raise their hands because they're not familiar. So what happened then was that in Chicago, there were 4 bottles of Tylenol that were laced with cyanide, which is a poison. And overnight, around the world, there were 30 million bottles of Tylenol. They became a truly toxic asset overnight. Nobody would buy them. Their price dropped to 0. This was a run on Tylenol. And why did people run on those Tylenol bottles in Frankfurt, even though there were 4 bottles in Chicago that had been tainted? But the people in Frankfurt, Germany, or Istanbul, Turkey, they wouldn't buy the stuff because they didn't trust what was inside it. Because what was the condition of those bottles back then? You could open those bottles. There were no safety seals. and you could stick in some cyanide and close the bottles up. So there was no disclosure of what was inside the bottles. It was all trust. Okay? This was opacity. Nobody knew what was truly in those bottles, whether it was truly cyanide or cyanide plus Tylenol. Tylenol plus cyanide. So there was a huge run. Johnson & Johnson didn't try and bribe people to buy those bottles or reassure them. It just recalled them, threw them out, and repackaged 30 million bottles with safety seal containers. That's why we can no longer open things. Okay? There's a story here, Bob. And in disclosing what's in those bottles, we were able to preserve this market for medications. And we eliminated the concern about Tylenol fraud. So suspicions of fraud can trigger financial runs when you have products which are not being disclosed. So, governments, what do? They try and prevent these runs by promising to keep the bank's promises. And in so doing, governments make promises they can't keep. So that's kind of where we are today. We've got the government having printed lots and lots of money to try and protect these promises, and they're promising that they can actually cover that all this money creation is not going to lead to a lot of inflation, which I think will, and that's in effect a promise that they can't keep. Let me just give you an example with respect to the FDIC. If we had a run today on the banks in the U.S., the FDIC has perhaps $18 billion in reserves. I'm not sure what it is. Okay, it's insured about $6 trillion in deposits. There's another $3 trillion in money market funds that are in effect effectively insured by our government, because the last time there was a run, the government came right in and insured them. And then there's a $3 trillion in cash surrender value policies of life insurance companies that most people don't realize, but they're like checking account deposits, because people can just take their policy into an insurance company and say, life insurance company, say, give me the cash right now. $3 trillion. So that's $12 trillion that if people really ran, they really expected inflation. If they ran, the Federal Reserve would have to print $12 trillion, and then people would expect there to be inflation. And if you expect prices to go up, you're going to want to run, right? Even if you expect the FDIC is going to make good on your money that's in your checking account, you're going to want to get it out before prices go up. In 2002, there was a run on the banks in Argentina after they went off the dollar peg. It wasn't that people didn't trust the banks would pay their pesos. They expected inflation, so they ran. So this guarantee of your deposits, well, it's a guarantee of pieces of paper. It's not a guarantee of canned soups. It's not like the FDIC or the Federal Reserve has cans of soup, Campbell soup. And it's still over there in Camden, right? All it has is these pieces of paper, which I know this is probably an act that's illegal, but this is just paper. And when you rip it up, you will see that it is just paper. And it's worth trying to do that just to get the feel of it. Just remind yourself that it's paper. So we could have a run tomorrow on our banking system, and FDIC insurance would do nothing if we really. And that run could happen because Cyprus had a run, and it's in the middle, and the people in Greece might, from one day to the next, start panicking, have a very public run. It could spread all through Southern Europe into France and Belgium. God knows their banks are underwater too. The Deutsche Bank is leveraged like 55 to 1, I understand, so it could spread there. You could have Rush Limbaugh saying, get your money out of the banks, and people in Alabama start running on their banks in Alabama and start spreading through the country. Bingo. We're off to the races. This is what we call mold equilibrium. You want to prevent this from happening. Anyway, so here's my bottom line. Our trust me banking system is inherently unstable. Managing systemic risk can produce systemic collapse. We have the President of the United States saying the sucker is going to run. You have Treasury Secretary Paulson literally begging Nancy Pelosi to come up with $720 or so billion to bail out the financial system. This causes panic, and it undermines this public good confidence. And guess what? We have a major recession when we're likely we're going to have a depression. We need to have an urgent need to eliminate promises that can't be kept. We need to move from trust me to show me banking. So limited purpose banking does this, and it ends up with a solution that in some ways is similar to Michael's, but in some ways different. But it moves me from trust me to show me banking, and it limits banks to their true purpose, which is not printing money out of thin air, but it's financial intermediation. Think about banks as running think about gas stations. A gas station is intermediating between a refinery and a driver, okay? But they're critical for the highway system. If all our gas stations were going to go out and to gamble with their businesses, for example, they could all sell, they could all take in money and say from their customers and say, look, here's a guarantee. Give us some money now. We guarantee to pump gas for you, to sell you gas at $5 a gallon. Pay us now, and you can pump as much gas as you want at $5 a gallon. And suppose the price of gas goes up to $20 a gallon. Every single gas station in the country, if they all did this, would go broke the same day. They'd all walk away from their gas stations with the keys to their pump. The highway system would break down. We wouldn't be able to use this public good called the highway system. Now, what do you think Congress would do the day after that happened? They would say to the gas stations, you can go gamble on your private account, but you cannot gamble with your business. No gas station can actually do anything but buy gasoline and sell it. You cannot be engaged in gambling with this business because you're running a public good. Collectively, you're running a public. That's what the banks are doing too. They're running the financial exchange system. If you want to see proof of that, go to Cyprus today, and you'll see businesses that cannot pay their suppliers, cannot pay their workers because they can't get more than 3,000 euros out per week from their banks and pay their creditors. So what we need to do is get the banks out of the gambling business, and we need to get them into the disclosure business, and we need to force them just to run the highway system. This is the public good. They're maintaining a public good. They're running a public good. We cannot let them gamble with public goods. It's that simple. But fortunately, I'm not a banking economist or a finance economist per se. I'm just a little young, little old economist who works on other areas like public finance and some macro. And so when I look at this, I think the core problems, because I'm not trapped in a whole literature. I haven't contributed to that literature, so I don't think it's what other people think. I think it's two key things: leverage. A lot of people think leverage is an issue, but I think it's not just leverage. It's the combination of leverage and opacity. These two things. So what we need is full disclosure and zero leverage. And because the intermediaries, the banks, should not be gambling, and that's leverage. And it's fine for households and firms who are not financial firms, non-financial firms, to borrow, but the banks themselves should not be engaged in risk. So here's this proposal. I'm going to give it to you. But I want to show you that we've got a lot of support for this. Here's some pretty interesting names. Mervyn King. These people haven't all formally endorsed this or publicly endorsed it, but most of them have. Mervyn King is really the one exception who hasn't kind of publicly endorsed it, but he's publicly talked about this proposal, including to Parliament, and he said it deserves serious consideration. And he's said this on several occasions. Got 7 Nobel laureates have either formally or publicly or informally endorsed this in talking to me. George Shultz, former Secretary of Treasury, Robert Reich, former Secretary of Labor, Bill Bradley, chairman of the Council of Economic Advisors, very prominent economist. You're going to hear from Jeff Sachs. He wrote the preface to my book, Jimmy Stewart is Dead. That's a book discussing the banking system and how to fix it. And this is not, for me, an ego trip. I mean, it's partly an ego trip, but it's to try and point out that there's a lot of people who have a lot of experience and knowledge, much more than I, about the financial system, who think this is a good idea. And it's not actually just my idea. Good ideas aren't isolated with one person. Other people come up with them. I think the Bank of England was working on this idea before I started talking about it publicly. Mutual fund banking, which is what limited purpose banking is it's equity based, 100% equity finance mutual fund banking. That idea has been around for a while among economists. Tobin talked about it. Jim Tobin, Milton Friedman had some discussion of it. Charles Goodhart. Nobody's taken it to the extreme that I have, but it's been in the air. So this proposal is very simple. It's mutual fund banking with no leverage, a federal financial authority to do the disclosure, and an auction market for the securities that have been disclosed to be bought and sold by the mutual funds. So it draws a line based on limited liability. It's not a good bank, bad bank line. It's not a commercial bank. It's not the Glass-Steagall commercial bank, investment bank. I'm going to have to get rid of my coat here so I don't make another whistle blowing. Oh, jeez. There we go. I did. Okay. So these lines that have been drawn between safety and, they're just crazy. They're not economic lines. So let's draw a line that's economic. Limited liability. You want to be a limited liability financial company, no matter whether you call yourself an insurance company, credit union, a hedge fund, a private equity company, a commercial bank, an investment bank. You're just going to have to be transformed into a mutual fund company to do your business. And they can all be done. All your business can be done as a 100% equity finance mutual fund. If you want to have leverage, you have to have unlimited liability. You have to put your own car and house on the line if you want to, and all your money. If you want to gamble with a financial system, be our guest, risk everything. So Richard Bolt, he would have been penniless under this scheme had he ran his bank the way he did. Okay, so we're going to have regulation based on function, not form. And all financial companies that are working with limited liability have to operate as mutual fund holding companies, issuing 100% equity finance open and closed-end mutual funds. Now, there's going to be one special type of mutual fund that's going to be used for the payment system. And this gets back to Michael's proposal. It's a cash mutual fund. A cash mutual fund would hold cash. So I open up I buy shares of cash mutual fund. I put my money in a cash mutual fund with, let's say, Fidelity Investments. Fidelity Investment holds the cash in the vault. Think about it as dollars being held in the vault. Now, I can write a check against that. I can use a debit card to access that money. I can get cash out of an ATM machine based on my cash mutual fund. That's going to be used for the payment system. That's very much like Mike's deposits being backed by reserves. In my case, the cash are the reserves, and the deposits are the shares of the cash mutual funds. Okay? So now we have a payment system. You can never have a run on it because the money's always there. You always know that your money's there. Everything else is, cash mutual fund shares are shares. I've got an equity position in there. But then we're going to have I'm going to personally be holding other shares in other mutual funds, like equity mutual funds or mortgage mutual funds or Chilean stock mutual funds or real estate mutual funds. Some will be closed and some open-ended. We have a very big mutual fund industry in our country. We have more individual mutual funds, separate mutual funds, than we have banks. We have about 10,000 mutual funds, about 9,500 banks. Most Americans do most of their banking via mutual funds because most of us have most of our assets in 401k plans, which are equity finance mutual funds. All the equity finance mutual funds had no trouble weathering the crisis. The only part of the mutual fund industry that had trouble were the leveraged mutual funds, and they were the money market funds because they had made a promise that couldn't be kept. They made this fraudulent back to the buck promise that couldn't be kept. Those were the ones that got into trouble. So under my proposal, money market funds would exist, but they would not be leveraged. They would be floating, just like all the other mutual funds, and from one day to the next, they would break the buck or make the buck, whatever. They would not ever be allowed to back the buck. So it would be mark to market every day. Now, just to be clear, under this proposal, the money multiplier equals 1, which is something the Chicago guys, the Chicago plan wanted to have, and Milton Friedman was a big advocate of that. So where's your money going to be? It's either going to be sitting in the reserves of it's going to be either held in the vaults of the cash mutual funds, or it's going to be in your pocket. And so that's going to be the money supply. That's going to be M1. The government can make M1 as big as it wants. It can print money and buy lunch for the president with it, and that will put more money in circulation. M1 will be bigger. So this does not mean a reduction in the size of M1. It can be as big as the government wants it to be. Okay, what else? How do insurance companies fit in? Well, let's think about running derivatives. Suppose you're AIG and you want to run a derivatives market, and you want to, for example, sell CDS. You want to ensure that Cypriot bonds will not fail, will not default. So here's how we can set up that market through AIG's Cypriot bond mutual fund. And here's how we do it, which is, I'm just going to give you the analogy of a horse race. Suppose I run a horse race. I've got horse A and horse B, and I'm at the track here. What's the closest track here? Suffolk Downs or something? Is that the closest? What is it? Yeah. Delaware Park. So you guys come to Delaware Park. A third of you guys bet on horse A, and the rest of you bet on horse B. And you give me your money, okay? And I'm behind the window, and I take in your money. I keep your money right here, safe, all of it. This is called a parimutuel bet, okay? This parimutuel betting has been in place since around 1857, okay? And think of the word mutual, okay? So what happens? Whoever wins the race, I've got the pot of money. I take my fee. I'm running a mutual fund. It's a closed-end mutual fund. The money comes in. I close the window. The race is run. Whoever wins, horse A or horse B, I pay out the whole pot less my fee to the the people who won in proportion to their bets. Now, what if we make horse A that Cyprus defaults at the end of the year, and horse B that Cyprus bonds do not default? Now we've got a CDS market. Now we've got a CDS right there, but it's a fully collateralized bet. It's not like AIG promises to pay off and can't actually come up with the money because they've taken in some premiums and then gambled with them. Instead, all the money's right there. This is an equity-based mutual fund that can never leave a liability to the taxpayer. This is a safe way to run derivatives in general. Think about the bet being IBM shares go above $200 over the course of the year. That's an option market right there. And it's a perfectly safe way to have derivatives. So we can have derivatives, we can have modern finance without leveraging the taxpayer, without gambling with the economy. So that's how you can run, how you can allocate aggregate risk, how you can have markets for aggregate risk, financial markets for aggregate risk in an equity-based mutual fund system perfectly safely. And we've never had a horse race where the taxpayer had to come bail out the loser, right? Never happened. What about idiosyncratic risk, like life insurance? Well, right now we have a life insurance industry that is selling two products, life insurance and annuities. And they have about 19 trillion in commitments out there, and they could go broke the next day. The life insurance reserve funds that are run by the states have no money. They're like the FDIC. They're lying. They have like an empty shell. There's no disclosure. Well, there's some disclosure, but basically, now what happens if we had a swine flu breakout? I guess it's breaking out now in China, right? Recently? Okay, swine flu kills young people. Okay? And then we have a cure for cancer developed. That would keep old people alive. So what if that happens simultaneously, maybe in a couple months? So the insurance company is going to lose on both sides of their hedging strategy. They're going to have their annuitants live much longer than expected, and they're going to have their life insurance customers die off in droves. The swine flu produced in the 1920s produced an increase in the worldwide mortality rate. About 2.5% of the world's population died from this. This killed more people than World War I worldwide. So now you've got an insurance company that's losing money on both sides of its hedge, and they go under, and now there's a run on the insurance companies, which kicks off a run on everything else. Okay. Now, because there'd be a $3 trillion run because these cash surrender value policies would start being cashed in right away. So what about running insurance a different way, life insurance? What if we say, let's say you guys are all guys, and you're all, let's say, 50 to 55, and you're in good health, and you want to buy insurance. So you put your money into my mutual fund, and the bet is whoever dies within 3 months gets the pot, less the fee, in proportion to what they put in. All the money's there. If more of you guys die because swine flu breaks out, less is paid out per person who dies. Less is paid out per decedent. This is a way of running a safe, idiosyncratic insurance market, to run life insurance in a way that's not going to threaten the economy. Right? 2 minutes, okay. You can do this with health insurance. You can do this with casualty insurance. You can do this with longevity insurance. The original such insurance market was the tontine, which was established in 1637. How many people have ever heard of the word tontine? How many people in this room have heard of it? We've got 2, 3, 4. Okay, how many people know the first physical location of the New York Stock Exchange? What was the name of that? It wasn't the Buttonwood tree. It was because that was not a physical, they had no roof over it. It was just a tree. People met there, and then they decided it was raining. They wanted to go inside. So they chose a place to stay, to go inside and meet. What was the name of that place? It's called the Tontine Coffee House. Okay? Everybody in that century, in the century before, and the century before that, knew what a tontine was. It was an everyday term. Countries like France and England financed themselves by issuing tontines, by setting up tontine markets. And so we could use ancient finance to fix up our modern financial system. Let me just say a couple last things. There's a federal financial authority that verifies. 1 minute. Okay, I'm going to try and be really quick. We don't need to have Angelo Mazzillo, who ran Countrywide Financial, into the ground, and it's now running Bank of America into the ground, to verify whether George here actually has a job, whether he actually has a credit rating that he says he has, or whether his houses that he's trying to buy is worth what he says it's worth, or some appraisal. We can have the federal government actually verify that he's got a job and what his earnings is. so we can use the federal government to verify things, just like we have an FDA that verifies that our medications are actually not lethal. And this is why the FDA came along, to make sure that we weren't selling snake oil, and that's what people were selling back then. It was eliminating, it was destroying the drug industry, so the FDA was used to do the verification. We need an FDA for the financial sector. That's the FFA, the Federal Financial Authority. They do the verification. And the last little bit of this proposal is that mutual funds would buy and sell their securities at auction. So if I'm a small company, for example, I do have a small company, I want to float my paper, it would be verified by the Federal Financial Authority. They would come and verify my company and my earnings history and put up on the web in real time everything they can reasonably say about my company. Then it would go up, my paper, if I want to borrow money, would go up, or sell shares, go up for auction to the mutual funds that are investing in small company paper. So we could have an efficient means of small companies and large companies, as well as households, getting their paper onto the market, and they'll get the best price for the paper and therefore the lowest interest rate for borrowing. Okay, so very last thing to say is that we have all these problems, the last slide. We have fraud, insider rating, director sweetheart deals, corporate governance problems, political bribes, regulatory capture, moral hazard, non-disclosure, off-balance sheet bookkeeping, government bailouts, failure to mark-to-market. Every single one of these things goes away with limited purpose banking. Every single one. We have a safe financial system, a banking system that can never fail, and therefore a much more stable economy and a much more efficient economy. And this can be done pretty much overnight, and it should be done immediately in Europe for sure, and certainly in the U.S. too. Thank you.
He is currently the director of the Earth Institute at Columbia University. Time magazine twice named him one of the most 100 most important people in the world. And you can read the rest here. I'll let him on because we're already running a little bit late. He was there.
Hello?
Hi.
We're ready for you.
Hi, this is Bill Dunkelberg. We're ready for you to go.
Could you just move the camera closer? At the end of a very long table.
Oh, sure, yeah. Yeah. Just give me a second.
So
Okay.
Can you hear us?
Yeah, maybe we could turn it up a little bit so I can hear better. Yeah. Okay?
Okay, now let me get...
I mostly will be hearing you, of course, until the end. That would be good.
Okay, give me a second.
Okay. All right, we're getting organized.
Let me pan it a little bit.
Now you're bigger.
Good. That's the aim.
That's very good. That's good.
Good. Very good.
Thank you.
More volume?
Yeah, if you turn up the volume for me, that's good.
Okay, that's almost max.
Yeah, that's great. Okay, very good. Thanks. Thanks very much.
Fire away.
Could you give me a little bit of introduction to the conference to this point and how I can be most helpful? So I'm sorry to just jump in like this.
Well, we've had a couple of speakers. David Kotok led off looking at the situation with central banks globally and what's happened to all the reserve creation. And then Michael Kumoff talked to us about the old Chicago view of banking and how we might want to change the way we do our banking. And then we had Mr. Kotlikoff talking about a simple form of banking, and I'm sure you're familiar with his views. So
of course.
Those are our three presentations ahead of you.
Very good. Well, I appreciate it. And I've been asked to talk a little bit about the international implications, especially the development implications of the financial crisis and of the banking sector. And maybe it's useful to just share with you a sense that I received a few days ago in meeting with about 100 UN ambassadors who are discussing the global economy and global policy framework for the period from 2015 to 2030, which is very much the United Nations agenda. What was palpable in the room was a very, very deep sense of anger and grievance at the American financial system. And I think that this is important to state because we have our debates as if we're, sometimes operating in a cocoon in a way. And the rest of the world, especially the developing world, feels that they have been the victims of the U.S. And its mismanagement over the last few years. And I think that it's a geopolitical reality that is a very real and very justified one. In other words, the sense of the 2008 crisis is you did this to us. And the failures of regulation in the United States have contributed markedly to instability and economic stresses in other places. And as several of the ambassadors reflected, the U.S. and the IMF more or less treat the policy discussions as if nothing really has happened. And what several ambassadors said is, why is it that we're taking advice from the people who have mismanaged the financial system so badly? So I think this is not an insignificant context. It's hard for the key currency and the center of the world financial system maybe to hear this very well and to take it as seriously as it should be taken. But the backdrop from the world's point of view is that the United States has failed badly in financial management, and that the implications of that are felt around the world. My feeling about this is actually similar. And I think that it's worth speaking outside of the monetary and macroeconomic framework for just a moment. And that is to reflect on the Fed's role as a regulator and on the real lessons of the financial crisis since 2008. And the angle that I would emphasize in this, again, I think is not typical for us as economists, but it is the massive illegality that has been exposed in the system. I am tracking systematically the news every day of new settlements of the financial markets to SEC and other legal proceedings. We have really a mountain of criminal and fraudulent behavior that is very much part of the 2008 scene. And we don't usually speak in these terms. We usually speak in terms of bubbles and mistakes, misjudgments, and so forth, but the amount of what I would regard as utter criminality and financial fraud is absolutely enormous. And it's almost daily, whether it's the insider trading scandals or whether it's LIBOR scandal or whether it's the Abacus and similar settlements on selling toxic assets by the investment banks. We are, because we're the inside of this, I think we are not actually feeling the full weight of not only regulatory failure and moral failure, but massive legal failure that's implicated in this as well. And today, just as an example, I was, clipped three stories from the news. One was that yesterday a judge approved the settlement with SAC Capital, a $602 million fine for civil insider trading. It's that's a modest fine. The judge expressed his concern that SAC Capital did not have to admit or deny any of the claims that were made in this. So this is a settlement without any resolution of the substantive topic. One asks whether $602 million fine is likely to have much effect. Well, the same day we have the story, of course, that the owner and CEO of SAC Capital took home last year in compensation $1.4 billion personally. So the company is paying a $602 million fine, and at the same time, Stephen A. Cohen takes home in compensation $1.4 billion in personal compensation for his management of the company. And if we just go back a few days, his top trader was arrested in handcuffs and led off from his apartment on Park Avenue. So this is what's called the American financial system at the moment. It's really mind-boggling to me. And it is an unregulated, essentially lawless environment that is not getting any more lawful. So I checked what Stephen A. Cohen, his political engagement this past year, and he gave $217,000 in campaign contributions. Now, this is a pittance from the point of view of his wealth, obviously, as a share of $1.4 billion paycheck. But $217,000 with our cheapskate politicians actually goes a long way to making sure that Mr. Cohen will be very well treated by his senators and by others who are giving ample protection to all of this. So this is where I would start, actually. I think the macroeconomics is important, but I think that the lawlessness and the sense of the world in the complete impunity of the system is absolutely massive. And wherever you look, we see the same thing continuing till today, and that is massive, massive bonuses at the top of the financial markets, massive civil fines being paid for really incredible behavior, and massive campaign contributions going from this financial leadership to the political class. Yesterday's front page story of the New York Times gave 8 salaried figures. David Tepper, $2.2 billion paycheck. Ray Dalio, $1.7 billion. Stephen Cohen, $1.4 billion. By the way, half of these companies didn't even beat the market last year. It doesn't matter. They have a fee structure that is independent of any real performance, and when they fail, of course, they don't have to give back anything in this till today. including last year's billion-dollar compensation holder, John Paulson, whose gold price bet is announced today to have lost $1.5 billion for his shareholders. But I can guarantee you he's not putting $1 billion back into his company. It's only upside, no downside. And when you look at the political linkages of all of this, Daniel Loeb, who gets only $380 million of compensation, gave last year $551,000 in campaign contributions. Ken Griffin, who took $900 million for Citadel, gave $2.7 million of campaign contributions. David Tepper of Appaloosa gave $601,000 of campaign contributions, and so forth. And many of these companies are involved in these civil lawsuits, payments for fraudulent behavior that is neither admitted nor denied. The final thing I would add on all of this that shocks the world is that we have perfected not only this system, but we've perfected the system in which these companies are domiciled in the Cayman Islands, or they're domiciled with partners in the Cayman Islands, taking away any accountability and further not only masking them from tax liabilities on these earnings, but also masking them from many legal liabilities. The latest, of course, as you know, is that they've created reinsurance companies in Bermuda and in the Cayman Islands that allow them to invest in their own firms through a tax-sheltered mechanism that is only a shell from the point of view of insurance. So my question to you, you're part of the Fed. Where is the Fed? Because this is about basic regulatory practice. It seems to me, in truth, that we have a system that is out of control right now, that's politically out of control, regulatorily out of control, out of legal bounds, out of responsibility, and we've invented a system where you get to take home billions of dollars in personal compensation. Your shareholders pay hundreds of millions of dollars in fines. You shelter your money in the Cayman Islands in agreement with the IRS, and nobody seems to control it at all. And, you know, I sit with the diplomats here in New York. I can only tell you that the level of unhappiness has risen to really very, very stark proportion. And I can only agree with them that I don't see any real progress being made in getting this right. So this is my brief message. I think we're beyond the macroeconomics right now. We're beyond the prudential issues. We're to a very gut level of legal accountability, fairness, tax regulation, transparency, and a basic sense of fairness. And my view is we don't have it right now. Wall Street is pretty lawless, and unfortunately, the regulatory system that we have is nearly broken down. That's my take from this end.
Professor Sachs, thank you very much. We'll turn up the lights back here. There are about 80 people here at this conference at the Federal Reserve. I should have introduced myself, Bill Dunkelberg. I was chair of the organization for a long time, stepped down in January, so we have a new chairman. But if you have a few minutes, we would like to open our floor
Absolutely.
for questions to you, and hopefully you'll be able to see us. So I'll look
I can now. Yep.
Okay, and the lights will go up. That'll help, I guess, once we figure out how to do that. So questions for Professor Sachs?
Yeah, I'd like to hear your views about why I've got this wrong, actually.
Thank you very much, especially for what appears to be moral outrage. Some of us are more on the limited government Tea Party side and see this as a failure of government. And just to bring it down to very gut level, if you say, we have a trial in Philadelphia. It's an abortion clinic trial. But the scandal is, for 17 years, this clinic was not investigated or regulated. The law requires a medical facility. It's much the same as what you're talking about. But these are supposed to be regulated. You have SEC, FDIC, et cetera, There's a failure of government from your level, from what you're talking about, all the way down to a medical facility. And there was alerts that the people could have stepped into. And I'm wondering whether you see a failure of government, because now you're telling me that the international community is looking at our country and mainly a failure of government in a very negative way. And this is, I'm an American, this is very upsetting.
Yeah, I think this is a profound failure of government, without question. It is, I think from the Tea Party to, if I could say, the left, which I probably would be classified in, I think we would agree that the symptoms are government failure, massive corruption, massive legalized corruption of large money interests that have taken over the regulatory process, regulatory capture. Probably the diagnosis would be pretty similar on many different points of the spectrum. I think what's interesting for me, and so let me describe two questions on kind of the response to this, because one response is that we ought to make government work, and the other response is we can't make government work. We ought to basically close down another part of government and understand that it can't work. And these are both logically consistent positions, in my view. One thing to add to the evidence base is that when the financial crisis hit on September 14, 2008, the Wall Street Journal, which is normally our voice of libertarian free markets, ran an editorial a few days later saying, "Are you crazy? Don't you understand market failure? Of course we have to bail out the banks. The whole world economy will fail if we don't go in and bail them out," and so forth. You could call that a loss of nerve. You could call that hypocrisy. Or you could call that a diagnosis, whichever one you want. But the point is, very soon after the financial crisis hit, the call even from the free market right for bailouts was there. And another complete example of that is Paul Ryan, who purports to be a voice of libertarian thinking, but he voted for TARP at the same time, and said, of course we have to bail out these institutions, otherwise the markets will collapse. So that, of course, only deepens the puzzle. It doesn't solve the basic conundrum of whether this is irremediably broken or whether this is hypocrisy that needs to be solved. What the hypocritical part, I find, is that the moment that the bailout happened, the Wall Street Journal immediately reverted to form in its language and its claims after this very big bailout had occurred. Then it went back to its free market stance as if nothing had happened. I think that there are at least two parts of a good answer to this. One is to create a situation, maybe along limited purpose banking, maybe along institutions that are not too big to fail, so that you really can let these institutions go under to an important extent, and get away from this compulsion of not only bailouts but the hypocrisy that comes along with it. I think that is certainly part of the answer. I do think that there is a truth, though, to the fact that a fractional banking system, if we're going to keep it, and we probably are, as Milton Friedman rightly said, it is inherently a fragile institution that is subject to self-fulfilling collapse. As he said, the one stone can start the avalanche, and it's the job of the Fed to prevent that from happening. And this means that bailouts, in some sense, in some ways, some lender of last resort fulfillment is going to be inevitable, and in that context, regulation is also going to be inevitable. I don't think we're going to really get around the need for some regulatory performance, and we need to analyze why it is that it has been so completely, such a complete failure. Part of it is technical, no doubt, that markets can deregulate around regulation, but part of it is really political corruption that probably could be addressed in a more straightforward way. I'll personally say, on a word of moral outrage, I don't believe that there is any theory in the world that justifies the incomes that these people are taking. This is, in my view, a prima facie market and political failure. I know a lot of these people. There's no way in the world that their marginal productivity is orders of magnitude close to their income levels. And I find it completely disgusting that they are allowed to make large political contributions. We have the Hatch Act. We have other limits on political contributions. And I think that the Fed should be a lot more serious in pointing out these contradictions and trying to create space for itself to be a decent regulator again.
All right, we have next one of our speakers.
Hey, Jeff, it's Larry. How are you?
Hey, Larry, how are you? I don't see you, but I hear you.
Well, to me...
There you are.
Yeah, to me, I think the banking system is getting a big pass from the judicial system and the politicians because they have this control over this public good, which is the financial exchange system, and also public confidence, business confidence. If these big companies are seen to be engaging in fraud, then suspicion will land on all the other companies like them because nobody can tell what they're actually up to. There's no disclosure. So to me, this thing only ends when we get these entities out of the leverage and opacity game and move to a radically, new and safe system where they can't fail and they can't leverage and they have to disclose what they're actually buying on behalf of their clients.
I think, your point, Larry, is a very powerful one. And at a not a literal level of single-purpose banking, but of a more general level, Glass-Steagall successfully did that for quite a long time, and its removal was a very, very cynical play by Rubin, Summers, Clinton, Graham, and others who all had very strong interests, personal interests in the outcomes of that deregulation, and exploited the gaps that they created, and then to the chagrin of some of us at least, were invited right back into the White House in early 2009 after they had made this calamitous mess to be the ones supposedly to fix it. And I know that Summers, for example, continued to really institute moral hazard policies right and left by fighting against any limits on compensation of these people who had entered into the breach. So this is a case where institutional reform of separating fractional reserve banking and basically the provision of liquidity from gambling should be done. But I would add this other point, which is that a lot of what's happened actually and what's been revealed is, in my view, prima facie criminal behavior. It's financial fraud on a very large extent. There's also a tremendous amount of insider trading, and you can even watch it when you're living in New York, how that works. So it's not so mysterious. But we don't even act. I take John Paulson, for example. Paulson worked together with Goldman Sachs to defraud massively many European banks which bought the toxic mortgages that Paulson had put together. When this Abacus deal was taken up by the SEC, Goldman ended up paying a small fine. The chair of Goldman, of course, continued in his position and continued at White House state dinners. And Paulson wasn't even mentioned once in any of the proceedings. And he took home a $1 billion paycheck the next year, even as Goldman was paying a roughly $700 million fine, if I remember correctly, for the abuse that Paulson was part of. I can't believe, no matter what the financial regulations, we can't do better than that. That's really pathetic.
As a former congressional staff attorney, retired tax lawyer, looking at the possibilities of small steps that might be taken, how affirmative would you think reenactment of Glass-Steagall would be?
I think that it is quite important to recreate a mechanism where liquidity is separated from large-scale financial gambling. It's really, in my opinion, as a macroeconomist, it's the collapse of liquidity that is the real macro danger. The rest is the collapse of confidence, lawlessness, decency, and so on. But what made Lehman so damaging, of course, was how it infected the money markets, the interbank loans, and the complete drying up of commercial paper. This was the devastating effect. It was basically March 1933 replayed. So liquidity is what is the real value here from a macroeconomic point of view. Loss of wealth, I could care less whether they make more or less money. I don't even care whether they make big money particularly, except I think a lot of them are crooks, and that it's based on a lot of nefarious behavior. But the macroeconomic significance is a kind of Diamond Dybvig banking crisis, which we know to be part of a fractional reserve banking system. And it seems to me, analytically, we have basically two levels of decision making. One is separating liquidity in the banking sector from other kinds of speculative financial activity. This I would do for sure. And I would never have put Goldman Sachs back under the Fed's protection as a banking unit so that it could receive direct loans from the Fed. That's ridiculous, but and sad, actually. But the second point then is Larry's point, and this is whether fractional reserve banking itself has value enough to keep it in its current form. I'm not convinced, I have to say, one way or another. I'm kind of, grew up in a fractional reserve banking system. I do believe that it provides liquidity in normal times if regulation is good. I tend to believe that there is value in reserve banking, but it's also highly volatile, as theorists have recognized at least for 150 years. And as Milton Friedman agreed, as Diamond said, as Larry has pointed out, and I think we have the choice, could we really have liquidity without fractional reserve banking? if we could, we might be able to address, another degree of this problem. The final point, of course, is separating the politicians from the crooks. But maybe that's so close together that they can't actually be separated. Maybe it's just the same community.
Yeah, hi, this is Michael Kumhoff. I'm one of the presenters this morning. I presented the paper about the Chicago plan. And I had a different question, but I just wanted to say it is possible to separate liquidity provision from credit provision, and that's what the Chicago plan is all about, and I think that should definitely be tried. My question was, your international experience, you were starting off by saying you're talking to a lot of international decision makers. What is the sense there about the readiness to try different monetary and financial approaches to what we have today? Do they feel that they could start to do that on their own in their own countries, or do they feel that they depend on the center countries like the United States and the Europeans to do something first?
I think in general for most small countries or most developing countries, I'll put aside the very largest ones, there is a sense of almost complete dependency on the international system. Their payments, their lines of credit, interbank markets, the need for swap facilities with the Fed or the ECB, the pervasiveness of tax havens, the extent of flight capital from their countries, the legal structures that where basically very clever U.S. lawyers help to free all of these countries from their tax revenues. They feel very much dependent on a system that they feel is dysfunctional, but they've been well schooled that for the last 25 years their goal is to be part of the international system. They just woke up to a system that they find very destabilizing, and they don't see any clarity of the way forward. And most of the advice that they get is to be part of the system and be quiet, basically. This is how the system is. You join it. You stay in good terms with the Fed, with the IMF, with others, and there is very little sense of autonomous potential among these countries. Really, I can only emphasize the palpable anger and vulnerability that's felt right now is very, very high.
My name is Dennis Peacock, and I represent the faith-based side of macroeconomics. And I just want to congratulate you that you pulled us back to the reality that in spite of all the complexities and theories and mechanics that we deal with in economics, that economics is really about values and the values and ethics of people. Thank you very much.
Well, thank you very much for saying it and practicing it. I do believe, by the way, I'm just going to end here because I've been pulled. I have to run to the UN, in fact, right now. I believe we have a crisis of values that is extremely deep because the regulations and the legal structures need reform, but I meet a lot of these people on Wall Street on a regular basis right now. I'm going to put it very bluntly. I regard the moral environment as pathological. And I'm talking about the human interactions that I have. I've not seen anything like this, not felt it so palpably. These people are out to make billions of dollars, and nothing should stop them from that. They have no responsibility to pay taxes. They have no responsibility to their clients. They have no responsibility to people, counterparties in transactions. They are tough, greedy, aggressive, and feel absolutely out of control in a quite literal sense. and they have gamed the system to a remarkable extent, and they have a docile president, a docile White House, and a docile regulatory system that absolutely can't find its voice. It's terrified of these companies. If you look at the campaign contributions, which I happened to do yesterday for another purpose, the financial markets are the #1 campaign contributors in the U.S. system now. We have a corrupt politics to the core, I'm afraid to say. No party is, I mean, there's not, both parties are up to their necks in this. This has nothing to do with Democrats or Republicans. It really doesn't have anything to do with right wing or left wing, by the way. The corruption is, as far as I can see, everywhere. But what it's led to is this sense of impunity that is really stunning, and you feel it on the individual level right now. And it's very, very unhealthy. I have waited for 4 years, 5 years now, to see one figure on Wall Street speak in a moral language. And I've not seen it once. And that is shocking to me. And if they won't, I've waited for a judge, for our president, for somebody, and it hasn't happened. And by the way, it's not going to happen anytime soon, it seems.
Professor Sachs, thank you so much for this presentation.
Great.
Global
Thanks.
Interdependence Center is very grateful, and good luck to you on your next talk, which I hope
Thank you very much.
will be as well received as you were here. Thank you so much.
Thank you. I appreciate it. Thanks a lot. Bye-bye, everybody.
Am I still on this mic? I am. Okay. That was an exciting morning. Thanks for holding your appetites in tow so we could go a little bit longer and get Professor Sachs involved. So lunch will now be served over on what we call the bridge. So you go out here and kind of go around that open space that's out there in the middle of the building, and you'll see it set up when you look across the bridge. So that's lunch. We'll be back here promptly at 1:30, right? And so thank you for keeping us on time, everybody. It's working well.
You probably don't need to make opening statements. Do we have questions right from the beginning? All right. Thanks.
Gentlemen, thank you for your talks. Sean Hallahan here. I was a Wall Street guy eons ago and then a technology guy. The thing I would like to ask is, what are the possibilities, the real possibilities, and what's the manifestation of real possibilities that we could actually, what are the possibilities that we could actually move away from the fractional reserve banking system that we have to one which I think requires greater capital adequacy? I consider that a possibility. To move all the way to the things that you're suggesting. Since I've been away from this conversation for decades, seems to me like a very far way to travel. Can you tell us what's going on in the Senate, in the House, in academia, and where the best possibilities for reform are?
Okay, I'll start. Is this on? Everybody here? So, so you saw some of the people that endorse limited purpose banking. So that's encouraging. I've been asked to speak about it all over the world, different central banks, and from New Zealand to Sweden. So the word is getting out. There's people in the Federal Reserve who have asked me to speak. So I've spoke at different Federal Reserve banks. And there's people within the Federal Reserve at pretty high levels who are very interested in the proposal. But we don't have any legislation pushing for limited purpose banking at this point. There's a lot of vested interest, obviously, in the status quo. But let me just say how I think if we had a small country that did this, it would be a model that would spread to other countries. But let me say how you could do the transition pretty quickly. So we have right now a huge amount of excess reserves. From day one, the banks could take the deposits, convert them into cash mutual funds, so that a depositor would have to sign an agreement to have his deposit turned into shares of a cash mutual fund. The reserves then could be put into, as cash to back these cash mutual funds, so that the bank now sets up a cash mutual fund and it takes its reserves, and now there's a dollar of cash for every dollar of shares outstanding. Then the short-term the shorter-term liabilities of the banks could be turned into money market funds that the banks would then set up, money market mutual funds that are floating, so they're not back to the buck. And then the longer-term credits of the banks could be transformed into shares of closed-end mutual funds that are holding the liquid bank securities. Now, all this could be done by having the Fed help grease the wheels. It could just, in a limit, buy up all the bank's assets and pay off all the creditors, have the creditors turn around and buy the assets through the mutual funds. Have the creditors invest in mutual funds, and then the mutual funds then buy the assets that from the Fed that it just bought up. So I think all this can be done pretty quickly and safely, and it just takes somebody to try it. Now, in terms of the politicians, right after Dodd-Frank was enacted, well, in the summer after Dodd-Frank was enacted, Barney Frank had me over to his office in Boston, and he said to me, I've met Barney Frank once before, and it wasn't a pleasant meeting. He's a tough SOB. He's not an easy guy to interact with. I stood there for like 15 minutes in his office. He's sitting at the desk, not looking up. I said, hello, Mr. Frank, nothing. 15 minutes later, he looks up and starts yelling at me. That's the typical Barney Frank encounter. It's not special to me. This time, I walk in, I said, do you know anything about limited purpose banking? I know everything about it. It's exactly the way to go, and we're going to do it as soon as I get back to Washington. And, of course, he gets back to Washington, and he's out of office in terms of being the chairman of the House Banking Committee. So he certainly thought, after having just legislated Dodd-Frank, told me point blank that Dodd-Frank was an interim solution, that the real solution was limited purpose banking. This is Barney Frank. Now, whether he'll, remember that conversation, but that's what he told me. So there you go. I don't know what the political legs are, but I know if we get enough people talking about this, it could happen. It at least has a chance of happening.
So I have also presented this work at leading central banks, at the Bank of England twice, at the ECB, at the Fed only 2 weeks ago. There's generally interest, but those presentations are typically in more of a research setting and not in my case at least, with the top people in the institution. But I think the word is spreading. There are various efforts underway around the world to draw attention to this. For example, in the UK, there's the Positive Money campaign, which has a very similar agenda. In the US, there's the American Monetary Institute. In Germany, there's Monetative. In Switzerland, there is an initiative around Professor Binswanger. I forgot the name. In New Zealand and Iceland, there are some sort of embryonic political movements that are trying to push something along these lines. Very little bit in Germany as well. So these ideas are out there, but I think what it would take to take such a drastic step, because it is, to many, even if we don't think it needs to be a drastic step, to many, this is a drastic step. What it would take to get there is some really shocking event whereby, we have our backs against the wall and we need to do something, might as well do the right thing. I think that's what it'll take. For example, the proposal that I presented right at the end, that was like a mini Chicago plan, that was
basically addressing the problems of a banking system in very acute distress, where you need to do something. And once you realize that bailing in, not bond debtors, but ordinary depositors, destroys the money supply and makes the remaining money supply precarious, then you're probably going to think twice or thrice about that. And then once you realize that the option that I presented is painless, clean, has been done before, even though that's more than 50 years ago, then maybe something like that would be considered. And because it would go very painlessly, I think, as it did in history, this would be a perfect example of, where should we go in the long run? Because this would be a mini version of the Chicago plan, where you just then tell the banks, you have these reserves. We're basically essentially bailing you out by doing this, by buying those bad assets from you. But you need to keep those again as reserves for your checking accounts. Once you do that, then people can see that, whoa, this is a solution that does in principle work. But it has one drawback, and the voters are going to see that. The drawback is that what you're bailing out here is essentially just the bad loans of the banking system. So you're basically then just saying, we're helping out those who have taken on more debt than they should have, and nobody else gets a crumb. Or that's not quite right, because you're preventing the economy from tanking by doing this, so everybody else gets an economy that doesn't tank. But if you instead were to say, look, everybody gets the same, it's a citizen's dividend that I was talking about, everybody gets the same amount and gets out of debt by the same amount, which would also help a lot of these non-performing loans. It would also put the banking system right, but there wouldn't be any perceived injustice in this. Right? This could be done in a way where everybody perceives he's being justly treated. So that would then say, look, you can do this partial solution here, but it isn't just, why not go all the way? Maybe I'm hoping for more than what can be achieved, but that's how I look at it now. Thank you.
Hi, my name's Marshall Pagan. My question is isn't the various varieties of QE that we've experienced a form of Chicago Plan Light, in the sense that, if I understand correctly, I mean, if you had a Chicago plan, you would need to have reserves at a level between 12, 15 trillion, perhaps more. And the Fed's balance sheet has gone from 800 billion to 3.2 trillion, with the consequence that you have substantially greater excess reserves. But effectively, it seems to me what the Fed has been doing is sort of moving in a somewhat ad hoc way in the direction toward what would be required if you were, in fact, in a Chicago Plan environment. I guess that's the first question. The observation, it seems to me, is transitionally, if you're moving to a Chicago Plan, one of the first issues you're going to face is whether or not there's adequate collateral to back the Fed's increased balance sheet. And the implication of that would be either you'd have to have substantially all of the federal debt being held by the Federal Reserve, or the Fed holding a greater variety of assets than just Federal Treasury. And I guess the question in that context is, isn't that what the Fed's been doing?
So I guess that was more about the Chicago Plan than about limited purpose banking. Yeah. What the Fed has done is it has put a lot of reserves out there. This is certainly true, but there is a sense that these will eventually be withdrawn, right? Once the economy has normalized, or at least to a significant extent withdrawn. And there is no sense that this is more than a temporary emergency measure, where temporary could be many years, but nevertheless an emergency measure. And what this doesn't really do is to it does not really prevent the banking system from running the fractional reserve banking system the way it has always been run, right? So at the margin, the banks are still fully in control of how much money is in the broad money, what is the broad money supply, and how it is created, because these reserves are not really constraining them in doing that. What they're doing is providing a temporary cushion against lack of liquidity and potentially insolvency of the institutions involved. Right? So this is not really the Chicago plan. It could be turned into that by saying to the bank, look, these are reserves that you have now, and we're now requiring that these are not going to be withdrawn, and you have to hold at least reserves against all checking accounts, for example. All right? Then your second question that's a very common misunderstanding. So you basically said under the Chicago plan, the Fed would have to have adequate collateral to back its balance sheet, its issuance of money. This is a notion that goes back to the gold standard, whereby money has to be backed by something else, which is actually, in my view, excuse the language, it's not personal because this is a very common understanding, but I think this is nonsense. Because the gold standard was a barbarous relic, and this aspect of it was a barbarous relic, that this notion that money has to be backed by something else, under the gold standard by gold, and then later on by some form of debt. Right? Money does not have to be backed by anything. Money is a token that is used in exchange and that can be issued simply as that token, and the government can take in, or whoever that issues that token, can take in the seigniorage revenue that comes along with that. There does not need to be a backing in any sense. So basically what happened in my version of the Chicago plan, when the money is issued, it is treated as a one-off revenue and, as I called it, equity in the commonwealth of the nation. Right? So I hope that addresses that second question. If not, let me know.
Hello. I've got three questions / observations. One is, it's also addressed to Michael Kumhof primarily, so forgive me. If you could just comment on the impact of the rather substantial wealth effect of basically the debt repayment through Commonwealth equity on inflation. Even if the total stock of money is unchanged, presumably if you write off basically 100% of GDPs of debt, mortgages and consumer credit, then that would have some impact on permanent income, consumer spending, and so on. The second is, when you repay / replace mortgage and consumer credit in this transaction, how do you intend to compensate the banks for the loss of excess spread that they would have expected to earn when these assets are replaced with reserves? I mean, presumably if you buy it back basically at market value rather than book value, you would do that. So another way of asking the same question is whether you intend to basically redeem these bank assets at market value rather than book value. And the third question is slightly more technical. Is you mentioned that when you manage your treasury credit supply to investment trusts and the lending institutions in the economy, you would do this by way of managing the cost of treasury credit. Any particular reason why you wouldn't just manage in the same way as you manage money, i.e. you just fix a growth rate and let interest rates set itself?
Excellent questions, all. The wealth effect on inflation, that is a very common misunderstanding. The first time I actually discussed that question was with Adair Turner a few days after the paper came out. And so the answer is the following. start off with the economy before the Chicago Plan, and you have in the model, and I need to talk about it in terms of my model, I basically have some rich and financially unconstrained household holding deposits in the banking system. I'm simplifying here, but the essence is captured in what I'm saying. Holding deposits in the banking system, and the borrowers of that banking system are financially constrained households that need to, for example, have mortgages, et cetera, right? So at that point, basically, there's a flow of interest. The wealth effect is the present discounted value of the interest payments, and how does it change, right? We have a flow of interest from a constrained household to unconstrained household. Now you implement the Chicago Plan, and basically what happens is that the government steps in between the constrained and the unconstrained household. It says to the unconstrained households, the holders of the big deposits, look, you still have your deposits in the bank, but now they are backed. I'm using the word backed, but not in the sense of collateral, but they represent reserves of public money. And so for the unconstrained households, the rich guys, if you wish, they still get the same interest. So for them, there is obviously no wealth effect. They get the same interest from the government. Now, how about the other? And obviously, there's no debt forgiven here because they start off without debt. Now, the other guys are now paying interest not to the rich guys anymore, but to the government instead, right? Because the government now provides treasury credit. That is how credit is now funded to the constrained households, right? You know, the balance sheet that I showed right at the beginning, right after the transition to the Chicago Plan, it was essentially almost only the government lending into the credit system. I mean, I'm abstracting from a lot of the things that come later in order to tell you just the essence of the story, right? Because in the end, the government ends up not funding most of credit. But let's just talk about that case. The government now is lending to these constrained agents. It has stepped in between. Now the government says, I am forgiving you, essentially, a lot of this debt. You could call it that, or you could tell my story of the citizens' dividend. Now this government, in this simulation, has a balanced budget rule, not a balanced budget rule, a structural deficit rule, which is what many governments have these days, which means that in the long run, I'm targeting a certain deficit to GDP ratio, right? So if the government now says, I give up a lot of these interest payments from these guys by forgiving them the debt, the government has to make it up somewhere else by raising taxes or something else. Ceteris paribus, everything else equal, that's what would have to happen, right? And so if those taxes were to fall on those constrained agents whose interest charges have just been forgiven, then they come out plus minus zero. They have really not gained anything. This is really just an accounting issue. The government has forgiven something to people, but it has a balanced budget that it likes to maintain. So if it forgives something to them, it has to get it back somewhere else. And because these people that it has just forgiven the debt to represent the vast majority of people in this economy, it's going to get it back mostly from them. So there is no wealth effect from this. And this actually comes through in the simulations very clearly. Now, in the simulations, there's all sorts of other things going on because this also stimulates the real economy. So there's an increase in demand for money. There's a drop in the interest rate. All of that I've abstracted from. I just told the essential story. There is no positive wealth effect from this debt forgiveness. The next question was, how do we compensate the banks? Essentially, yes, the assets would be bought back at market value. That's what the model simulation assumes. And the shareholders now have far too much capital in the banks because, you know, the capital that was in the banks before the Chicago Plan is no longer needed because the capital adequacy regulations don't call for it. If I have half as much of a balance sheet as before, I can just basically pay a one-off dividend to my shareholders, again at market value, and let that capital be deployed somewhere else, not in the financial system, but somewhere in the real economy, what have you. Nobody needs to lose any money over this. And as far as treasury credit is concerned, that's one of the slides that you asked, you know, I only have a price mechanism, how about a quantity mechanism? I actually have some slides here, but I think I can tell you the story verbally. So there's a number of things you can do with credit. In this, let me put this into perspective first. So there's money and credit now. For money, I want the government to be very firmly in charge. And I am on completely the same page as the Chicago school economists of the 1930s, the laissez-faire economists of the 1930s. They were all about laissez-faire in industry, but not in finance. That laissez-faire everything only started much, much later. So I'm basically about controlling money. As far as credit is concerned, you can think about a whole spectrum of policies. So the policy that I modeled in the paper as the baseline is where there are investment trusts. They are funded by private equity, private debt, and a little slice of treasury credit. And that's sort of like the lender of last resort. If the government wants to stimulate lending by these investment funds, it can inject additional money, lend money into circulation, so to speak, right? And it can set an interest rate for that. That's how I conceptualize it. So it's like now the government also sets an interest rate. It's the federal funds rate. That's on a different asset class. That's actually on a liability of the government. This would be an interest rate on an asset of the government, a rate at which the government lends to the private sector. And if you wish, that could be the end of the story. But I don't think that's a good idea. I think it does make sense to have some influence of regulators and the government also over the aggregate quantity of credit. Not so much over the allocation, although even there's an argument that, maybe you could try to encourage certain types of credit, like for investment and machinery, and discourage other types of credit, like asset speculation or things like this. So there's a scholar at the University of Southampton in the UK, Richard Burnham, who has done extensive research on this policy called quantitative lending guidance or window guidance, which was, some people, when they read my paper, they say, oh, this is communism and things. That's complete nonsense. Because that sort of system was practiced all over the Western world and East Asia in the decades immediately following World War II. Exactly what you were alluding to with your third question, a more direct control over the quantity of credit. Okay? It was actually something that was originally pioneered by Germany prior to World War I. It was then adopted by various East Asian countries, and it was practiced all over Western Europe as well after World War II. And his evidence is, and that's something I would like to work on in the future, is that this was not always, but most of the time, a very successful policy. And actually, if you look at the new Basel III regulations that are now being put out, there is a regulation in there that says there could be counter-cyclical capital buffers, whereby, and typically that buffer would be raised in response to an increase in the credit to GDP ratio.
Let me intervene a little bit.
Yeah.
Because I think you're getting into the weeds a little bit too much on this stuff. Let me try and answer your question slightly differently. Suppose we want to go to limited purpose banking, and I'm the Federal Reserve, and you guys are all the banks, and I just print a whole lot of money and buy up all your assets, and you take the money that I give you, cash, and you pay off your creditors, the depositors, and all the other creditors of your banks, and you shut yourself down, okay? So I've got all your assets, and your creditors have all the cash I just printed. Now, day two, you open yourselves up as mutual funds, equity finance mutual funds, and you sell shares to your mutual funds. And some of you are selling mortgage mutual funds, and some are selling, real estate mutual funds, and some are selling cash mutual funds. Anyway, you take the money back in from the public that you just gave them, and in exchange for shares. And then I, the government, sell these assets back to the mutual funds. You're now mutual funds. Okay? I've pushed the money in, and I've taken it out. No wealth effect. Okay, now we're sitting in a situation where if you look at the mutual funds, there are all these mutual funds out there, and some are cash mutual funds, and some are equity mutual funds, and some are bond mutual funds, and money market mutual funds. They're all floating. None are back to the buck except the cash mutual funds because they're back. They've actually got a buck. And now we've got, if you aggregate all these mutual funds, they've got liabilities, which is equity, and they've got assets, which are all these assets. And that's limited purpose banking. Now, if you go there and you say, how do you go from limited purpose banking to Michael's Chicago plan? Well, it's taking these non-cash mutual funds and allowing them to leverage. And you've got to ask yourself the question, would you want to do that? And my answer would be no. Because the big problem with our financial collapse was not in with the deposits and a run on the deposits in the commercial banks. It was a run on the investment banks. And it's because they were leveraged, and it was their specter of their failing. It wasn't whether or not they hurt the kind of individual household and whether he could get his money out. It was a specter of those big institutions failing and bringing down the financial system and just scaring the public about the in terms of the level of confidence in the economy. So Lehman was not going to be cured by the Chicago plan. Get that out of your minds. That's not an answer. The Chicago plan is not going to fix what happened with Lehman and Bear Stearns and so forth, because they would all be, in effect, leveraged mutual funds under Michael's proposal. What I'm proposing is that these leveraged mutual funds not be leveraged. They have to be 100% equity finance. So if Lehman has invested has sold mutual funds that invest in bad mortgages, then the people that hold these non-leveraged mutual funds, hold the mortgages through those non-leveraged mutual funds, would get hurt. And, and life would go on. So that's what I think you need to be thinking about. What kind of when you're thinking about, do you want leverage in the financial system? Do you want people gambling with a financial highway, with a public good, with two public goods? That's the key question. Do you want them operating with opacity? Do you want them to be able to borrow money and invest in things that nobody can see and have no government oversight and disclosure of what it is that they're investing in? That's the key questions you should be asking, not details about whether there's a wealth effect or exactly how this mechanism is going to work, because that's going to miss the main point. Excuse me.
No, but I think the question about the wealth effect was very relevant, because as a macroeconomist, I have to ask, if I do a reform like the one I'm proposing, is that going to be inflationary? Because that's always the knee-jerk reaction of monetary economists out there, and it's just plain wrong. Now,
and you can see that by the money going out and coming back in. It's not inflationary.
Yeah, and I think Larry and I differ on an aspect of what these mutual funds should look like, where his exclusive type of mutual fund is the equity funded one, where I'm not necessarily convinced that is necessary, that you can still have risky fixed income instruments out there in mutual funds. They can be leveraged, but what is absolutely critical is that when they screw up with their lending decisions, it has no effect, zero effect, on the safety of the means of payment. Because the means of payment will be completely separate from what those guys do. Okay? And by the way, if you have a monetary system where there is no source of funds anywhere in the economy where private agents can just freely print money, then a Lehman or any other type of institution will have a much harder time leveraging up the way they did. It doesn't work so easily, because you have a given money supply that is provided by the government, and you can perhaps affect the velocity of that, but there's policy tools about that too. But otherwise, this is the money supply, and people hold this money supply for transactions. And nobody, if a Lehman wants to leverage up, nobody can create money out of thin air to allow Lehman to leverage up. So this is a very different world that would, it's one thing to talk about how do we resolve Lehman, given that we are where we are. But the Chicago plan is also about how do we never get a Lehman in the first place. Okay?
Bill Poole, I have a comment on this, or question, I guess, on this banking discussion, but I also have a comment on Jeffrey Sachs. The banking system grew up as a market phenomenon over, 300, 400, 500 years, something like that? And so the banking system really, in the scheme of things, historically, is only relatively recently subject to a great deal of government regulation. So the characteristics of the banking system, basic characteristics, have been a market phenomenon. So the question I have is, when we have a redesign, whichever one we were to go to, what happens if the market system produces, call them near banks or whatever organization you want to call it, because there is a demand and a supply for firms with those characteristics? And I think that's an important question, because the system that you're advocating will not be a stable system over time if there are market forces that create a different kind of firms. Now, I have a comment
Can I quickly
about,
just respond to that one?
let me make a comment briefly about Jeffrey Sachs. I reacted very badly to his presentation. Maybe you heard it differently. I heard no economic analysis. I heard no facts. I heard lots of highly charged words that seemed to me not to be appropriate in, I'll say, intellectual discussion. I'll tell you a little story. About 20 years ago, my youngest son married a Romanian woman he met in studying in Switzerland. And I got to know her father a little bit. Most of his life was under communism, including the brutal Ceausescu for the last 20 years, whatever he was in power. And Liviu is his name. Liviu's attitude, even after the fall of communism, his attitude was that anybody who has accumulated any wealth is a crook, has to be a crook. Because, in fact, that's the way it was under communism. The only way you accumulated wealth under communism was to be a crook. And you got it through the state, not following the grand rules of Marxism. So I believe that some of the what we heard on Jeffrey Sachs was exactly like that. These hedge fund managers have to be crooks. They couldn't possibly be providing economic services that are worth anything like that. Now, we know that quite a few hedge funds have, in fact, been closed down. Some hedge funds have not done very well, and their investors have walked away, and they've been shut down. So I think that without an economic analysis of what these funds do, it is simply improper, quite frankly, improper to assume that the wealth that they accumulated was a matter essentially of criminal activity or theft.
Okay. Let me just respond quickly to both points, Bill. So under what I'm proposing, any non-financial corporation like a General Motors that try to get into the banking business like GMAC, that part of that subsidiary would have to be operate as a 100% equity finance mutual fund. So now clearly there's going to be some issues of judgment, and that's where regulation would come in. But in general, there's a whole lot less regulation under what I'm proposing, because you don't have to really, you've got maybe 130 different regulatory bodies in the U.S. To make sure that this leverage, this gambling on the part of the banks doesn't kill the economy, because the banks then invested in risky ways, and then you have to see exactly what the banks are investing in to make sure that they don't go under and therefore kill off the economy, destroy this public good. I'm saying let's have disclosure by a single government agency, not 130, of what the mutual funds are investing in, and then if the investments go poorly, the shareholders lose value and things go on. None of the equity finance mutual funds, and by the way, I don't do any consulting for any of these mutual funds, just so you know. None of these equity finance mutual funds got into any big trouble in 2008. Not a single one of them. They were built out of stone. We had a financial earthquake. All the companies built out of stone. The leverage banks collapsed. Not all of them, but a lot of them, big ones. They collapsed. And what do? We rebuild in straw. They're made in straw, and we rebuild in straw. That's what's going on here. And we can't even see the fact that the non-leveraged mutual fund companies did not collapse. So I think that is an issue, Bill, but a minor one. The big thing is that the companies build out, if there's all these 10,000 mutual funds, 7,500 of them were non-leveraged. None of them collapsed, and we're not even looking at that. And the other thing about Jeff's comments is that I agree with Jeff. I think I would, had the opportunity, I would have said the same thing if I were talking on that topic, to tell you the truth. Because we have documented by the SEC something like 700 cases every year where none of these guys go to jail, where these are, just, it's in the paper day after day. And day after day, this is criminality of some sort that's not being really dealt with in any strong manner. It's being, dealt with by the company just signs a piece of paper, says, admits to nothing, and then goes about its business and pays this fine. These are slapping of the hands. We have a revolving door between Wall Street and Pennsylvania Avenue. I mean, it's obvious. Larry Summers earning $5 million for mismanaging money. Then he goes to work in Washington, and now he's back probably working in Wall Street on the side. Robert Rubin leaves Wall Street. Jack Lew. I mean, it's just endless. We have a corrupt political system in my mind. I think Jeff's trying to lay that out and talk about the need for the Federal Reserve, since he's talking, we're at the Federal Reserve, and there are Federal Reserve people here, the need for the Federal Reserve and other regulatory bodies to actually do their job. It's just not seem to be done. And also changing the structure of the financial system so that we don't have the ability for so much corruption, so much leveraged corruption, I think is the way to go.
I completely agree with you. I would have put it even more strongly than Jeff Sachs. And by the way, there is empirical evidence. There is a paper by Philippon and Reshev who have looked at trying to explain the remuneration of financial sector managers, trying to explain them by marginal product or something or other that has been used in the empirical literature, and found that a lot of their remuneration can only be explained as a rent. In other words, as an unearned income that cannot be explained by their productivity at doing anything. You started off by saying that banks are a market phenomenon. Excuse me, but I do not really agree with that. If you read monetary history, you will see that banks were very often very closely intertwined with government, and there was very, very strong, banking charters needed to be granted first. And think about this. Who would not want a banking charter? You are getting the privilege of having a money printing machine in your backyard. You would not want that? And then I was saying, the markets are going to take care of the fact that of these guys responsibly using their money printing machine. Do you buy that? I think this is an unreasonable assumption, and the Chicago economists of the 1930s were seeing it exactly the way I'm putting it here. Now, you asked one very important question, which is when we redesign this, would we have near banks arising that would produce, essentially, you didn't use the same term, but would they produce substitute monies, and would that therefore interfere with control over the quantity of money and therefore of inflation? This is an important monetary question. It is answered in the paper. So what you could do is the following. First, only government-issued money would be accepted for any dealings with the government, including the payments of taxes. Historically, this has typically been enough to ensure that government-issued money had a complete monopoly. So that might be enough. Second, there cannot be any FDIC, either FDIC-type coverage of non-monetary liabilities of anywhere in the financial system, either explicit or implicit. And you don't need it when your money supply is produced directly by the government in a debt-free fashion, because the reason why we have to have FDIC right now is because this makes sure that bank liabilities really are perceived as safe and therefore money. When you produce them safe in the first place, you no longer need to ensure that the liabilities of the remaining institutions are safe, and therefore their debt liabilities can be risky. The third point is you could rewrite the tax laws to encourage equity instead of debt, where right now we have exactly the opposite. Equity is never going to be treated, or is very unlikely to be treated, as a money-like instrument. Fourth, you could have regulations on maturity mismatches. And fifth, if you really needed to, I don't think you would need to, you could have an outright prohibition of using non-public money for any kinds of transaction. I don't think you need to go there. Let me tell you a little example. I met somebody who right now works at the French Treasury. He tells me the following story. I still have to check into the details, but in the US and one or two small European countries, money market mutual funds basically are regulated in such a way that the redemption value is sort of safe, and it's sort of like money-like, right? So you have basically you can treat this as money. Whereas in France, for example, this was not the case, and these funds basically have a fluctuating asset value. As a consequence, these things never took off in France because they're not perceived as money, because they are perceived as something risky. This is not even a major regulation that was in any way intended to make this money or not money. It just happens to be that way, and you get a major response out of that. If you, in addition, impose all these other measures that I just suggested, I think you would ensure that near monies would not be a prohibitive problem. You would always fight on that front. That's, and Henry Simons in his writing was very clear that this was an issue, but I think you wouldn't have a major problem with it.
Let me interject here to say we had, when you put together a program like this and you get all of these stars and the schedule, times they're available and so on, you end up with little spots, and Dom DeGento, who's on our board, and I were going to fill in for the half hour between now and when Lord Turner is on. But we really like to have you have access to the stars that we have here. So we'll, at this point, if you still have questions, we'll continue to do questions up to the time that Lord Turner is ready to go. If that's all right with you. I see hands up, so I'm going to carry the microphone over. And is that all right with you, gentlemen?
Turner is on at 2:30, right?
Pardon?
Turner is on at 2:30.
2:30, right.
Yes,
So you get
minutes.
another 10 minutes or so, if you
Sure.
take the questions.
More
Wonderful.
Absolutely.
I'm Carol Corin, and I have two questions, one of which is having to do with the relevance of the credit union system to your models and the experience worldwide of the growth and performance of credit unions, which have a moral compass that in some measures is affected by the democratic direction of their members, who in theory elect the managers of the union, and on an annual basis have opportunities to review a transparent report of the performance and holdings of the credit union, and where this fits in your respective models and views of the banking system. And the other is an observation as to the issues of sustainability that we are witnessing in respect to our food system, and the effect that the drive for economies and efficiencies of scale have had on it, that have similarly now been witnessed in our banking system, where we have increasingly moved the banking system from local roots and a commitment to community and an understanding of the role that money plays in a community and the relevance of the depositor's commitment to the bank activities and need for money on a secular basis.
Okay.
So I would welcome your thoughts on those two observations.
Okay. So I read a book called Jimmy Stewart is Dead. You know the movie It's a Wonderful Life? Now here you have the most moral local banker, and you have this movie. This is the Christmas movie that we all watch, It's a Wonderful Life. George Bailey is being played by Jimmy Stewart. It's Christmas Eve, and there's a run on his bank because there's been a rumor that he's lost some money in his bank. And everybody knows George, everybody trusts George, but there's this rumor out there because nobody's able to see what George has done with their money. And that's your local credit union. They're honest, good bankers. Maybe George has just invested in something really, really safe, like Treasury bills or bonds, 30-year Treasury bonds, and inflation has just taken off, and those Treasury bonds have lost 30% of their value. And he was leveraged 25 to 1 or 33 to 1, as Basel II allows. And so this very honest, safe, good banker, reliable banker, has a problem because he's made a promise he can't keep. He's in effect made a fraudulent promise to pay off in all states of nature when in fact he can't do it. So that's the story with credit unions. They've promised also, like any other bank, even though they might be, quote, better people or somehow more transparent, they're engaged in something that's unsafe at any speed. This is a banking system that's set up to fail. And it would not be an issue if this was not a public good that these entities are in charge of. That's the key thing. That's why this is different than another company, than General Electric failing. Banks failing, they've set themselves up so that because they're not disclosing what they're doing with your money, they tell the depositors you can get your money anytime. If you start to see a problem, you can come get it, because they're trying to pay off the people that have a good insight as to whether or not they actually are in trouble. This is a bribe to get people to give them the money because they're not able to show people what they're doing with the money. So they've set themselves up in a way that they will fail at some point. Credit unions will fail at some point, and because they're not safe. So we need to have a system that can't fail. It's a public good. It's a public highway system. It cannot be brought down. It has been brought down. Bill's talking about the history of banking, 600 or so years of private banking. How can we change it to make it? We had 600 or so years of fraudulent medicine being provided before the government decided to put together the FDA, and now we have a drug industry that actually works. If we didn't have the FDA, we'd have no drug industry. People would be marketing pills with arsenic and uranium, which is what they did in 1909. 1905, when the FDA, I think, around that time, came into place. So we need to have something that works. We need to understand that we don't have Jimmy Stewarts, and even if we did have Jimmy Stewarts running the banking system, what they're doing is playing with fire, with our jobs and our retirements, and we've just seen them destroy them. So on that score, that's my answer. On the size, concentration of big banks, yeah, things have gotten more concentrated. Dodd-Frank has made for more concentration because it's going to drive small banks out of business. They can't comply with all these regulations. It may drive out the credit unions, and we've made too big to fail a bigger problem. So it should all be fixed with limited purpose banking. Now, limited purpose banking does not eliminate big banks. You can have a very big mutual fund that has, like Fidelity, that has a lot of small banks within it, which are equity financed mutual funds. So there's no need to have big or small mutual fund holding companies. They can be big as long as they're marketing small banks that are equity financed. Well, Fidelity Investments, I'm not talking about LLC. I'm talking about, take T.I. Craft or T. Rowe Price. Any of these mutual fund holding companies have, each of the mutual funds is a separate little subsidiary, and I'm talking about the ones that are equity financed. They sell shares, they take in money, and they invest in things. And they can't fail. And bingo, it's very simple. You have all the financial entities that are incorporated operate that way. You never have a bank failure again. You never have a correlation of bank failures with economic crises like you see throughout the history of economic business cycles. Just go back in time. You see all these private banks going under, and the economy goes down at the same time. No surprise.
I don't really have much to add to that. I completely agree. The United States in the 19th century had lots and lots of small local banks, and it was a complete mess. You might have had, at most times, not at all times, very many times, you might have had the odd a good bank manager, the equivalent of a credit union perhaps, but it has within it the seeds of great trouble. And you need either the Chicago Plan or limited purpose banking or something along those lines where you take that seed out.
Thank you very, very, very much, you guys. It's been really awesome. I just want to say that in an interchange like this, it's the British Financial Services Authority. He has just recently come on to INET. He's the senior fellow at the Institute for New Economic Thinking. That, if you're not familiar with that, that is to a large extent not totally funded by George Soros, as a research institute, as a think tank, looking at the kind of issues we're talking about, and of course much broader. If I may say so, Lord Turner has been one of the public officials actually, while in that position, being willing to make public statements of a fairly radical nature. As a matter of fact, I think there's a one-page description of his most recent speech, or one of the most recent speeches, in the latest issue of The Economist. Thank you very much.
Good afternoon. I hope you can hear me clearly. Can we get rid of that echo?
They got to turn the noise down.
Sorry, I'm getting an echo here, which we're trying to get rid of.
They have to fix that.
Could you just explain what they've got to do to get rid of the echo?
You have to lower your noise in the room in order to fix the echo.
Okay. Can you hear me now, or has that switched it off completely? Can somebody wave if you can hear me? Okay, good. Right, that's great. Thank you. You can hear me, and there's no longer an echo. First of all, can I say I'm terribly sorry that I couldn't be with you in person this afternoon. I'm actually speaking here from Washington, D.C., where there is a conference on macroeconomics and macroprudential, which is covering some of the issues, and I had to speak here at lunchtime, so I've got to come in by video conference. And it's particularly sad that I haven't been with you, because I've greatly enjoyed and admired reading the works of both Michael Kumhoff, along with Jeremy Benez, and indeed Larry Kotlikovs. And I think they've done a great service in making sure that we think about radical ideas of reform, radical ideas which go beyond the incremental improvements in the stability of the system with which, as a public policy official, I've necessarily been involved over the last 5 years. Now, that doesn't necessarily mean that I agree fully either with Larry or Michael with their precise propositions, but I think that there are some underlying principles which they are setting out, and which, as Michael's paper in particular describes, were set out very clearly by mid-20th century economists like Irving Fisher, like Henry Simons, like early Milton Friedman, and that those principles are very important for us to understand and to guide as best possible a policy action. I'm now out of the official public policy role, and that hopefully enables me to be a bit more radical. I've tried to be relatively radical and straightforward even while I've been in that role. But when you get to the end, as I have, of 4.5 years as a regulator, one of the things that you do is reflect on what we did, reflect on what fundamentally went wrong, and go back to basics to think about do we need to have a more fundamental reform to make a more stable system. What I'd like to do is make 5 points. One, I'd like to set out what I think are some important issues which were ignored before the crisis, the latest financial crisis, and some principles which I think are important. And I'd like to focus on the problems that debt and banks can create in the upswing. I'm then going to, on the second thing, say some words about why that creates particular problems in the downswing as well, and the links between some aspects of monetary policy and macroprudential policy. Third, I'm going to talk about the way that suggests a possible need for radicalism along two dimensions, in macroeconomic policy and in macroprudential. Fourth, I'm going to step back and say that the fundamental issue is, do we believe that maturity transformation is a good thing or not? And fifth, I'm going to suggest a possible way forward, which is not quite as radical as to what Michael and Larry are suggesting, but still I think you'll find a way outside the bounds of what we've debated within the policy space over the last 4 years. So let me begin by, I think there are some very important insights into the nature of financial stability and macroeconomics which were almost entirely ignored before the crisis. Olivier Blanchard, the chief economist of the IMF, said last year that one of the faults that economics had before the crisis is that we thought we could ignore the details of the financial system. And that is largely true. The new Keynesian macroeconomic models largely just didn't have a financial system in it, which is a fairly extraordinary fact, but true. What is also true is that before the crisis, I think that we fell into, and it had been over several decades, a tendency to believe that financial markets are just markets like any other, and that the propositions which, in favour of free markets, which are pretty good in other sections of the economy, apply also in finance. Basically, if we want a good supply of restaurants, of a variety of ambiances and price points with good service, there isn't really a better system than having a free market in which entrepreneurs create a concept, some win, some lose, some go bankrupt, some flourish. The free market works. I think one of the most fundamental things for us to understand is that finance is different. That finance is different because it is linking the present to the future under conditions of inherent irreducible uncertainty, and because it deals with money, which is a very complex and difficult and distinctive element of our economies. And the fact that we thought that the market for money or the market for financial instruments is just like the market for finance was a major mistake. Finance is different. It can create instabilities. It can create rent extraction opportunities. But within finance, debt contracts are even more different. And I think there are 5 reasons why debt contracts, as people like Henry Simons and Irving Fisher described, create risk, and why the bigger the amount of debt contracts within our economy, the higher the level of debt to GDP, the more fragile is likely to be our macroeconomy. First, debt contracts are different because of what Andrei Schleifer has called local thinking, which is a form of sort of partial blindness, a failure to see the world as it really is. If you hold an equity investment, it is obvious to you that you are holding a risky investment because it goes up and down in price day by day. The movement in the price day by day is continually sending you a reinforcing signal that reminds you that you hold something which is risky. When you hold a debt instrument, in the good times, all that you see is the bit of the frequency distribution of possible results, which is the favourable 100% payout result. And what happens in the good times is that there's a systematic tendency for people to believe that the observed bit of the distribution of possible results is the whole of the distribution. They end up believing that some instruments which are inherently risky, because there is real risk out there in the economy, are in fact riskless. And as a result, the free market left to itself has a systematic tendency to create more debt contracts than is optimal, and, as Andrei Schleifer puts it, a tendency to create many debt contracts which, and I quote, owe their very existence to neglected risk. And we saw enormous numbers of such debt contracts before the financial crisis. Debt contracts which people assumed were AAA, were safe, but which owed their very existence to neglected risk, which but for that partial blindness would never have seen the light of day. That's the first difference. The second difference is the impact of bankruptcy and default processes. Ben Bernanke, in his essays on the Great Depression, has a phrase which says, in a complete markets world, bankruptcy would never be observed. In the world described by smooth neoclassical economics functions, what would happen with a debt contract is, as the operating risk of the firm grew, there would be a completely smooth process of renegotiation of the debt contract to have elements of equity. It would be an entirely smooth process because most of neoclassical economics works on the basis of nice, smooth functions. But actually, in the real world, we see processes of bankruptcy and default. What happens when you foreclose on a debt contract is that you go through processes which in themselves destroy value, which tend to produce asset price falls, and which tend to produce knock-on effects of the sort that propagated the Great Depression. Thirdly, debt contracts have to be rolled over. You can imagine a market economy operating for many years, let's say 5 years, with not a single new equity issue. It wouldn't be a perfect market economy. It would slowly get less effective in terms of the allocation of capital. But you can imagine it because at least the equity which had already been invested does not have to be repaid. That is a permanent investment. But debt typically has contractual terms of 1 or 2 or 3 years or so, particularly in the corporate space. So it's being continually repaid, and therefore to maintain the same level of capital support to, for instance, a business, it has to be continually rolled over. And that means that the continued health of the new credit provision process, if you have already allowed large amounts of debt contracts to exist, you need a continual process of rolling those over, otherwise you will have a contraction of the credit and a contraction of the real economy. But fourth, and this is crucial to Michael Kumhoff's paper on the Chicago Plan Revisited and to the work of Irving Fisher and Henry Simons and co., it's not just that debt is different. Banks are even more different than non-bank debt contracts. I think maybe I focus more than maybe Michael or some others on the dangers that you would have even if debt contracts were provided in a non-bank fashion. But where I certainly agree is that fractional reserve banks create a whole new level of danger. Because the fundamental fact is that when people say banks take savings and intermediate it to loans, that's not true. One of the most fundamental insights, and it's very clearly set out in the front of Michael's paper, is that banks simultaneously create new credit and new money de novo, ex nihilo. And that is one of the most fundamental important things for people to be taught, which economics undergraduates should be taught, about the nature of how a monetary economy with banks works. The fifth and final thing is that lending against assets is particularly problematic. That when you have the ability of banks to create new credit and new money, and where that credit is extended against an asset such as a house or commercial real estate, which can increase in value, you have an extraordinarily strong tendency for what Hyman Minsky described, which is credit and asset price cycles. The very extension of credit helps drive up the asset price. The higher asset price makes the borrower think, oh, well, that was a good idea, I'll do that again, I'll borrow some more credit. The fact that the price goes up produces a period of low loan losses. That swells the capital position of the banks, who can then make more loans with more capital, and it also sends a reinforcing cycle to the lending officer, which says, well, I lent some money to commercial real estate and I haven't made much losses on it, so I'll do some more. You have these incredibly strong credit and asset price Minsky cycles, which have an upward spiral and then a downward spiral. That, of course, can occur within banks, but it can also, I think it's crucial to understand, and I think this is a crucial point in the evaluation of these radical options, it can also occur in shadow banks. Indeed, I have a fear that what happened before the crisis in the development of the shadow banking system is that we effectively created a sort of turbocharged and hardwired version of a Minsky cycle. Because what we did in the shadow banking space is that when you put together a money market fund providing a money equivalent instant access account, which takes that and then, say, lends at 30 days to an asset-backed commercial paper issuer, or lends through the repo market, or enters a complicated set of systems of securities lending and secured financing, what happens is that at each step, the totality of that chain is a bank but made up of many chains. But in order to try and make themselves safe, at various steps of that chain, people take security, they mark to market the loans effectively that they've made on a daily basis, and they call collateralized collateral against changed in the mark-to-market value. And that, I think, has the aspects of the Minsky asset and credit cycle, but turbocharged and hardwired, made mathematically absolutely inevitable. So, debt contracts create risks which are not created by equity contracts. Banks create even more risk because they have this limitless ability to create new credit and new money. Shadow banks can create money equivalents and can turbocharge the Minsky cycle. And the net effect of this is that banks, and I would now say shadow banks, have an inherent tendency to create excessive amounts of credit in the upswings and then to destroy it in the downswings. As Henry Simons put it in February 1936, in the very nature of the system, banks will flood the economy with money substitute during booms and precipitate futile effects at general liquidation afterwards. And it's very interesting to think that that's said by Henry Simons, who most people think of, and indeed was, a founding father of the Chicago free market laissez-faire school of economics. So here's somebody who believes passionately in free markets for restaurants or hotels or automobile manufacturers or soap manufacturers or whatever. But he thinks that finance is different. He thinks that we've got here something which is inherently unstable, which will create excessive amounts of money and money substitute during booms and precipitate future effects of liquidation thereafterwards. And therefore, he said, private initiative has been allowed too much freedom in determining the character of our financial structure and in directing changes in the quantity of money and money substitutes. And I think it should be a real pause for people to think about that a set of thoughtful people who in all other aspects of the economy were passionate free marketeers, sitting amid the wreckage which had been produced by the banking crisis of 1929 to 33, end up in a radical position where they believe that finance and debt and banks are so different that we should effectively abolish fractional reserve banks. These insights into the special nature of banks, of debt, of shadow banks, I think fundamentally challenge pre-crisis economic orthodoxy, which tended to assume that increasing financial intensity was limitlessly beneficial, and it assumed that on the basis of market completion theory. So within neoclassical economics, there is a fundamental proposition that the more contracts you have, the more markets you have, the more that we complete markets, and therefore the more that we head towards a sort of nirvana of a free market equilibrium as described by Kenneth Arrow and Gerard Debreu. But in fact, I think we know that the theory of finance, debts and banks tells us that there's no certain mechanism by which the amount of money and credit created is optimal. Indeed, we have a system which is almost certain likely to take it to excess. And increasingly, I think we have empirical evidence supporting the proposition that there are levels of debt to GDP generated by, for instance, free banking systems, above which that level of debt to GDP is harmful to the stability of growth and to the long-term level of growth. I'm thinking here about the empirical analysis done by people like Alan Taylor and Maurice Schullerich, or the BIS document from July last year, in which Steve Cicchetti and Anis Karoubi argue that when you plot debt to GDP, private debt to GDP against long-term growth rates, you end up with a sort of inverse U function where financial deepening, some level of debt to GDP, is positive for the economy up to a certain level, but there is a level which the developed economies are beyond, which is negative for growth. These insights are important. They were ignored pre-crisis. Credit to GDP grew massively over the 50 years pre-crisis, both in the real economy and within the financial system in itself. And the crisis created huge harm. And I think it's very important for us to understand the nature of the huge harm that the crisis created. Some people try to measure that through the costs of taxpayer bank bailouts and say the crucial thing is to end too big to fail. But actually, the cost of taxpayer bank bailouts is either in accounting terms nil. In the US, the Federal Reserve, except in the case of Fannie Mae and Freddie Mac, but in relation to all the other interventions, is highly likely to end up with a net profit at the end of the day. And even in the UK, where we probably face a net loss on our equity investments in RBS and Lloyd's HBOS, the total cost there is just a couple % of GDP. That is the short change. That's the small change. It's the most unimportant element of the total cost of the crisis. The total cost of the crisis is the macroeconomic recession into which we have been tipped. And it's that's the way that extra credit created in the upswing by the banking and shadow banking systems then produces a downswing thereafter. That's what we ought to focus on. So, I think that was my first point. Banks are different, credit is different. Left to itself, the system will produce too many debt contracts, too high leverage. My second point is that when you've done that, when you allow that to occur, you then face a huge problem in the downswing. And the downswing is characterized by what Irving Fisher describes as the debt and deflation cycle in a great and short and very accessible article, and is characterized by what Richard Koo, in his analysis of Japan over the last 20 years, describes as a balance sheet recession. Essentially what happens in this balance sheet recession is that once the crisis occurs, both companies and households, different mix in different economies according to where the leverage developed, but it could be either companies or households, suddenly become convinced that they've got too much debt. And they therefore become determined to pay back that debt, to deleverage. And in that environment, they become almost entirely inelastic to a stimulus provided by low interest rates. You reduce the interest rate to the zero lower bound, but people don't borrow more money because they're basically trying to pay back the debt they have already got. And this is the liquidity trap in which reducing the policy rate, interest rate, the federal funds rate to the zero lower bound just doesn't stimulate the economy. We end up in a trap. Now, of course, in that environment, you can then say, okay, well, we'll go beyond simply reducing the interest rate to the zero lower bound, and we'll do all sorts of unconventional monetary maneuvers, such as quantitative easing, credit easing, direct credit subsidy, central bank liquidity support, forward guidance on interest rates. And what all of those, which are being deployed by central banks across the world, are trying to do is influence a wider set of interest rates than the policy rate alone. They're trying to influence long-term interest rates as well as short, forward expectations of future interest rates as well as current rates, the rates actually paid by borrowers in the real economy, as well as the Fed funds rate which exists in wholesale money markets. But the problem with those sort of policies, which work through those mechanisms or through asset price effects, i.e. the QE pushes up the price of bonds or equities, investors feel richer so they spend more money, or they go out searching for yield. The problem with that is twofold. First, if you're really, because of a debt overhang, in a balance sheet recession, then the fact that you are able to influence a wider set of interest rates still may not make much difference. Borrowers may still be inelastic to changes in the long-term interest rate as well as the short-term interest rate. They may be inelastic in response to the rate that they specifically pay as much as in relation to the policy rate. So that's one danger, that it simply isn't very effective. The other danger is that we are attempting, when we use these unconventional policy levers, to re-stimulate the economy through the mechanism of the famous hangover cure, where you take another shot of alcohol, the hair of the dog that bit you, in the British phrase. And there is a real irony if faced with a crisis which has been clearly produced by too much debt, we end up with a set of policies, the purpose of which is to stimulate people into taking on more debt. And there are very major dangers, as Jeremy Stein of the Federal Reserve Board set out in a lecture in February, that these processes of unconventional monetary stimulus will, long before they have a really powerful effect on the real economy of households and companies, will stimulate all sorts of carry trade and put option writing and leveraged activity in the financial system, which will recreate forms of a financial stability risk. So that's the situation. That's the problem we've got. Too much debt in the upswing and a balance sheet recession deleveraging in the downswing. My third point then is that observing those two problems, that suggests the need to consider greater radicalism of public policy along two dimensions. In macroeconomic policy, it suggests that there might be circumstances of deflation and deleveraging so deep that you have to consider the option which Ben Bernanke proposed for Japan in 2003, which is helicopter money, printing money, financing an increased fiscal deficit. Some people, the moment they hear that, say, oh my God, that's hyperinflationary. That's a terrifying thing to do. But I give you another irony from the history of economic thought, along with my previous one, that Henry Simons, this great laissez-faire free market economist, proposes the complete abolition of banks. The other irony is that Milton Friedman, a man who most people think was absolutely determined to fight against inflation, proposed in 1948 that not only should we sometimes pay for public deficits with new created money, but that we should always do that, that should be the standard form of fiscal deficits in order to produce a steady increase in the money stock, compatible with a slowly, steadily growing low inflation economy. So in macro policy, the observation of this extreme liquidity trap can take you down the radical route of helicopter money, the creation of irredeemable fiat money to create demand. And the observation of the harm which leverage has done takes us to the idea of how do we have a dramatically less leveraged economy for the future? How do we manage to write down existing high levels of debt and or to achieve fundamental changes to the financial system, for instance through the abolition of fractional reserve banks, creating an environment in which the pace of nominal demand growth is no longer dependent on the growth of private leverage. Now, these two elements are closely linked. The idea of money finance of deficits and of radical change to create 100% reserve banks, these are logically linked, and they are logically linked in Michael Kumhoff and Jaromir Benes's paper, and they were logically linked in the writings of Friedman in 1948 and Irving Fisher and Henry Simons. So what do we think about these? Let me give some thoughts. I mean, essentially what Jaromir and Michael have done is propose a revisiting of the Chicago Plan. And this would involve banks being 100% reserved backed, a variety of different possible ways to provide loans in the future, either through treasury loans or essentially equity backed, which would make them somewhat similar to Larry Kotlikoff's idea of limited purpose banking, but equity-backed loan funds, and with credit creation essentially focused on investment in real activities rather than in, as much as it is today, on intertemporal consumption smoothing as between old and young or patient and impatient. And just so you just understand how little of current bank credit is focused, at least in some countries, on investment in real activities, just suggest the following figures. In the UK, the sterling lending of the UK banking system is about £1.8 trillion sterling. Of that, about 1.3 trillion is either house mortgage loans or short-term consumer credit loans. And in the UK, unlike, for instance, in Ireland or Spain or the US, very little of the house mortgage loans have anything to do with the construction of new houses, because we don't construct many new houses in the UK. It's almost entirely to do with the financing of an exchange of pre-existing houses between old and young people, or those who have houses or not. So 1.3 out of the 1.8 has very, very little to do with the real investment process. Of the remaining 500 billion, 280 billion is lending to commercial real estate companies. Now, some of that is real investment in, attractive new commercial real estate investments, but a hell of a lot of that is also simply financing asset plays on existing commercial real estate assets. So you're down to 220 million out of 1.8 trillion, which is actually due lending to the non-real estate companies. And indeed, if you look at the manufacturing sector in the UK, they are net depositors into the banking system, not net borrowers from it. So I think it's very important for us to understand how little of the present banking system actually is the sort of activity that you get iconically described when people are arguing, keep away from the regulation, which is investment going into new companies, etc. It's a very small part of what most banking systems do. So that's the proposition into different ways, Michael and Larry's things. I think there are a set of issues which might make me not fully convinced to say, yes, I'm going to sign up to the Benes-Kumhof Chicago plan. I interchanged quite extensively with Michael by email a couple of months ago. I think the new version of the paper addresses some of the issues, but there are some issues that I'm not absolutely clear that make this in total doable or necessarily desirable. First of all, I think that any system which involves a big write-off of existing debts, however hard you try, is going to somewhere in the system create winners and losers. I think it's almost impossible to do large debt write-offs without some distributional consequences, and I think that's just very difficult politically, as well as creating some simply uncertain consequences which will result from distributional effects on wealth. Secondly, I think there's an open issue about how we should think about lending for intertemporal consumption smoothing. I think there's far too much of it, but I think there could still be an argument that some of it is valuable up to a point. I mean, the basic process of saying we enable younger people to borrow money to buy houses off older people, rather than all houses flowing through an inheritance process or being bought by the accumulation first of enough cash to buy them, I'm not convinced that I think that may have a social welfare optimality. I think one of the most important bits of economic theory that we really haven't thought through is what is the social optimality there, how much is socially optimal, but I think that's an unexplored bit of economic theory. And even some element of lending from patient to impatient people, may be socially welfare optimal, even though it has absolutely nothing to do with creating higher growth. So I do have some concerns about the distributional issues, about how should we think about intertemporal consumption smoothing, and I do have some concerns that any attempt to create an entirely 100% reserve banking system would be likely to create more shadow banking systems, near money substitutes. I'm more doubtful than Michael is about the ability of us to prevent the creation of near money substitutes. And in relation to Larry's proposals, I'm not totally convinced that it would get rid of pro-cyclicality. Given that I think that mark-to-market systems in the shadow banking system were themselves a cause of pro-cyclicality, I can imagine that if we have loan funds, mutual loan funds, in which you hold a mark-to-market investment, and if we can really mark-to-market those on a day-by-day basis or even week-by-week, I think we may see some pretty strong pro-cyclical behavior in response, in self-reinforcing cycles, in response to the mark-to-market of the value of such funds. So I do have some questions about the precise forms of radicalism. And underlying those questions, there is a fundamental issue, which is, what do we think about maturity transforming banks? Is there a useful role for maturity transformation to enable the creation of debt contracts beyond those which would otherwise exist? Now, I think Larry and Michael and others in the really radical camp have convinced themselves that there's no value in that at all, and we should simply abolish it. I don't think I'm in that space, but I'm sort of well aware, I'm convinced that left to itself the system does more maturity transformation and more debt contract and money creation than is optimal, but I'm not quite in the space of believing that we should abolish it entirely. I think it's possible that there is some role for leveraged maturity transforming banks to create a wider set of debt contracts than might otherwise exist. Walter Bagehot in Lombard Street certainly argued that that had played some role in the superior early development of the UK economy versus, for instance, the French economy. And I don't think that's an entirely fanciful a concept, though it could certainly be challenged. But I certainly believe that the amount of debt contracts created by purely free markets is likely to be deeply suboptimal. There'll be too much. I believe that strong reasons to believe that left to itself, the amount of debt contracts will always be suboptimally large. So, I'm therefore attracted to what Jaromir and Michael in their document set out in section I, which is compromise solutions. And I hope I'm not simply being wimpish and going for the compromise solution. And I note that in that section you very carefully, very politely point out that those who go for compromise solutions are sort of intellectual wimps. They're not really going for the absolutely, pure version. But let's talk about what a compromise solution might be. One way forward has been suggested by Anat Admati and Martin Hellweg in their new book on the bankers. What's the title called? The Banker's New Clothes, the fact that bankers are running naked, and we've not admitted that so far. They basically argue, and I entirely agree with them, that as regulators today, as policymakers today, we are the inheritors of a 100-year policy mistake in which we have allowed banks to operate with ludicrously high levels of leverage, which are completely unnecessary for the effective operation of a market economy. And they argue that in a perfect world, we wouldn't be playing around with Basel III, where those of us like me who spent many, many hours in windowless rooms throughout the world negotiating it, were very proud if we managed to get the leverage, the capital ratios up from 5 to 6 to 7. They say, forget all that. The optimal level is something like 25 to 30%. And I believe that. I believe that if one were fortunate enough to be the benevolent dictator of a greenfield economy and able to simply ignore transition problems or political disagreements between different authorities throughout the world, I'd go for something like a 25 to 30% equity ratio. But I think it's then important to realize two potential problems with that Admati and Hellweg approach. First, setting capital ratios, however high, does not actually necessarily constrain the total level of debt contracts in society, because you constrain the ratio of total bank loans to equity, but you don't constrain the amount of equity that people choose to put into the banking system. And if you had equity ratios of 25 to 30%, investments in bank equity would be very low risk. These would be your classic utilities in which widows and orphans, the famous iconic figures, ought to invest for dividend return. And I think you might well find that there was quite a large supply of people willing to invest in bank equity as a not far off deposit equivalent. It wouldn't be money, it wouldn't be usable as money, but in terms of a store of value, it would be seen as a pretty safe store. So I think you could have the Admati-Hellwig very high capital ratios, but still end up with the system generating debt to GDP ratios which were suboptimally high. And the fundamental problem here is that when you constrain banks through the capital ratio, you're constraining a ratio, but you do not directly constrain what the numerator is, how much capital there is. And that is different from when you do it on the reserve asset side of the ratio, where if you have quantitative reserve asset requirements, you not only can impose a ratio, but you ultimately determine how many central bank reserves at the central bank there are. So I suspect that if we really have to wanted to go forward with the Admati-Hellwig compromise radicalism, we might have to combine very high equity ratios with the restoration of quantitative reserve requirements and pretty high reserve requirements, which again is, I'm afraid, yes, a compromise solution that I see that Jaromir and Michael criticize, as indeed did Irving Fisher. It's sort of, well, we proposed 100% reserve requirements, and you're coming back with X, which is quite large, but not 100%. But that's where I might be. Second concern I have with Admati and Hellwig is, how are we going to deal with the transition? The fact is, it would be much better if we had not created all these debt contracts in the economy, but we have. And given that we have, if we simply come along and say, you've got to hit a much higher capital ratio, there is a danger that left to themselves, the banking system will choose to meet those higher capital ratios through a speedy process of deleveraging. And while that deleveraging at one level is required to end up in a more stable overall economy, in the short term, given the starting point that we have, it could be depressive to the economy. Therefore, if you go with the Hellwig-Admati mechanism, I think what you've got to do is demand a higher capital ratio and demand that it is met through an increase in the numerator, not an increase in the denominator. But to do that, you've really got to backstop that requirement for a higher capital ratio with a statement which says, and if you don't manage to get that higher equity in the private equity markets, we, the public authorities, are going to subscribe that new equity. And my third concern, even with the Admati-Hellwig compromise, is shadow banking and arbitrage and avoidance problems. I am very struck. One of the main things that I've looked at over the last 2 years is the development of the pre-crisis shadow banking system. And I've been very struck by the way that it is able to create alternative ways of bank credit equivalents, near money equivalents. I think we're seeing across the world that there are a lot of arbitrage opportunities. Look at China, major developments of a shadow banking system there. And I think essentially the system can produce near money equivalents which are not dependent on the underpin of deposit insurance and lender of last resort, but which are created by the use of collateralization and haircut techniques, which as I said earlier, can be even more unstable and even more pro-cyclical than banking per se. So I'm interested in that intermediate solution of the Admati-Hellwig approach of very high capital ratios combined with the restoration of quantitative reserve requirements, which is heading a bit towards 100% reserve banking, but not the whole way. But I am aware of problems. Let me then end with one possibility of how we might head towards that. One very radical proposal which ties together what I said earlier about radicalism in the monetary space and helicopter money drops, money finance creation, and heading towards a more stable banking system. Suppose we made a policy commitment which required banks to increase their equity ratios to the sort of 25 or 30% that Martin Hellwig and Anat Admati had proposed. We'd combine that probably with a process which said, and if you ever fall below 15%, we'll take you into some sort of central bank conservatorship, tidy you up again, write off the existing equity, and refloat you. Therefore, with very strong incentives for sound bank management, which would never let it get down to those 15% levels. We require that of the banking system. We make it clear that if private equity is not available to meet that higher capital requirement, we will have public funds injections into the banking system. But that fiscal injection would be paid for, if needed, entirely with new central bank reserves. You can think of this as a Bernanke helicopter money drop totally dropped into bank equity rather than into Milton Friedman's famous dollar bills lying around the grounds. The political economy benefit of this is that if the helicopter money drop is limited to this exercise only, the specific exercise of heading us towards a less leveraged banking system, it does not raise the political economy dangers that make people very terrified of the more generalized use of money-financed government deficits, which is the danger that once politicians realize that it's possible to finance deficits with money, they'll want to do it all the time and to excess rather than in an appropriate amount and at the appropriate time. These measures of creating a more liquid and more capitalized banking system would, however, have to be combined with measures which directly control both borrowers and lenders. It would have to be combined with things like LTV and LTI limits in key areas such as residential housing. It would have to be combined with much more aggressive than currently planned use of counter-cyclical capital requirements, particularly in things like commercial real estate. And it would involve the restoration of the policies tool of quantitative unremunerated reserve requirements to ensure that the new reserves created cannot limitlessly create new money constrained only by that imperfect equity ratio constraint. And this policy would have to be contained with very tight control of shadow banking, capital and liquidity requirements on money market funds, minimum haircuts in repo and secured lending and securities financing contracts, and the ability of the regulators to impose leverage and liquidity constraints on any institutions which over time became bank-like in nature. So what I've ended up by doing is agreeing with the analysis of Michael and Larry, who were there, that there's something very fundamental about too much leverage and something very fundamental about fractional reserve banks. But suggesting, yes, a compromise solution which does not abolish fractional reserve banks, nor abolish, as Henry Simons wanted, debt contracts, but which, in a sort of intermediate level of radicalism, though I have to say still radical enough that it'll probably give some of my erstwhile colleagues in the official sector a complete shock when they read it, a process which would end up take us towards a dramatically less leveraged banking system without that costing an increase in fiscal deficit because of the use of money finance credit. So that is taking some of the insights from Michael and Larry and others' analysis, some of their radicalism, but suggesting a way forward which would still be incredibly difficult to get political support for, but which resides in an intermediate radicalism space. So thank you very much for listening, and I'd be happy, if we can, to take questions from the floor and respond to it over the next 15 minutes. Thank you.
Thank you very, very much, Lord Turner.
And I think you now have to switch on the audio, because I can see you clapping silently at the moment, but I can't hear anything.
Can you hear me? Can you
I can hear you now, yes.
Thank you
Yes,
very
I can
much.
hear you.
Really, really appreciate your insightful analysis. I have a question. By the way, you know we're streamed live. Half of our audience is around the world live, and half of it is right here in this room, approximately. Here's a question from Positive Money from the UK. I know you're aware of their work. Here's their question. You agree that we should not prohibit fractional reserve banking because maturity transformation is useful, but if there was a way of allowing maturity transformation without the creation of private money, then would it be worth preventing private money creation via a fractional reserve banking system?
That's interesting. I mean, obviously, you could have the state play the monopoly role as the maturity transformer. I guess I'm a little bit wary of that, and I hope I'm not just being institutionally conservative and accepting the world as it is, because I do have, significant concerns about state direction of investment funds. I think there's a whole set of environments to believe that's not very successful. So I think I'm still in the camp of believing that very tightly controlled by the sort of mechanisms that I have, we can take the benefits, and I think there still are some benefits of a free system of competitive fractional reserve banks. I mean, essentially I'm saying there can be a role for fractional reserve banks, but the fraction never needed to be anything like as small as that which we allowed to develop in the pre-crisis period. So I think we should certainly be open to a range of radical ideas, but I think convinced that with a radical enough set of regulations we can constrain the fractional reserve banking system to prevent it being the dangerous driver of excess credit and money creation which it has been in the past. Another question?
Hi, Adair. It's Larry Kotlikoff. Great presentation. Very much enjoyed your remarks. Agreed with a few of them. So one thing on the maturity transformation, you know, there's this paper by Charles Jacklin that shows that you can achieve the same equilibrium as you would have, the same good equilibrium as you have in the Diamond-Dybvig model with just people buying short and long dated securities without having the bad equilibrium, the bank-run equilibrium. So that's one question for you, and it connects to the question that was just asked, whether there's an alternative mechanism for maturity transformation. You know, after all, it's trying to ensure people that suddenly become impatient. I think that's all fourth order, to tell you the truth, as an issue. But even so, security markets can seem to deal with that. But my other more important question is, in your entire talk, there was no discussion of disclosure, of transparency. If you have financial institutions, no matter how much leverage how much capital they have, if nobody can see what they're actually investing in, then the market can lose faith in the value of those of the capital. And in the case of Lehman, 3 days before it failed, it put out a glossy report that was approved by the SEC. It was in effect a stress test for Lehman Brothers that said that its capital ratio was 11%, which is higher than most U.S. banks now have under our stress test. So I'm not sure that capital ratios are, I don't think you can be kind of a little bit pregnant here. You have to, I think we need to have full disclosure by a government agency of the securities that are being marketed to the public. And I think that as soon as you introduce any leverage potential, you have this entire regulatory structure, huge regulatory structure that you need to have in place. And furthermore, the issue of capital requirements, think about AIG engaging in the sale of CDSs. Now, in effect, that was leveraged because they were committing to pay back in certain states of nature huge amounts of money, and they didn't have it. It wasn't in all states of nature, but in certain states of nature when the company they were insuring was defaulting on its debt. So what is leverage is a kind of an open question, and whether the capital requirements would cover everything that's leveraged and whether the companies would then buy securities are themselves more leveraged. All these problems go away with limited purpose banking, but are there with your compromise.
Okay, let me pick up a couple of points. I think I'm less convinced than you are, Larry, of the mileage that we can make by transparency. And let me try and illustrate this point. That people sometimes say, I remember in the autumn of 2008, when I was right in the middle of the financial crisis, and people said, look, what we've got to do is force the banks to tell us how bad the losses are by telling us about the quality of their assets. The trouble is that there is no answer to that question, because the value of the assets is deeply endogenous to what is about to happen to the economic cycle. If there is confidence in the system and they have enough money to make some more loans, the value of those assets is higher. If the system goes into a downward spiral, the assets are worth less. There is no such thing as the value of the assets in some defined sense. It is, I think, deeply endogenous to the state of the economy, which in itself is a continually evolving process. So I'm more wary, I think, than you, Larry, about disclosure will do it all. And indeed, I'm slightly worried that incredibly wide disclosure, combined with the tendency of financial markets to be subject to herd effects and rumors, can produce continual mark-to-market cycles, which in a sense are self-fulfilling. So my response is, what you've got to do is just have enough capital that in the face equity capital, it's going to be pure equity capital, that you have a high degree of confidence that if the assets turn out to be worth less than you thought they were, the worst that can happen is the equity holders lose. And it's up to them to have a dialogue with the managers of the bank about what they need to do. So as long as you can get yourself to a situation where the level of equity that you run at in the good times is so high that, except in a 1 in a 200-year scenario, the worst that can happen is that the equity write-off is going to take you from 25% to 15%. And as long as you have a defined process at that point of saying, okay, guys, game over, you equity guys, you've ended up, you haven't done your job, you're wiped out, we'll take the asset for free, and we'll tidy it up and we'll sell it off, in which case the state or the central bank will typically make a profit of that. I think that you can have a level of equity which is less than 100%, which makes the likelihood of hitting bank failure, with the consequences that has for new credit supply and macroeconomic instability, so low that you've reduced it to the point where every 150 years, yes, you'll have to bail out the banking system, but as long as it's every 150 years, it's probably socially optimal to just accept that that's what we do. So that's my aim, and I think there can be a ratio which is high enough to achieve that, certainly if we're talking about straight loans. Now, your point is, how do we then deal with this proliferation of derivatives accounts and securities lending and repo, secured financing, etc., all the stuff that the investment bank trading operations did? Where you're quite right, Lehman's had an equity capital ratio of, say, 11%, though, of course, on a simple non-risk-weighted adjusted basis, that was much less than 11%. I don't know what it was, but against the absolute gross value of all the contracts they were in, it was probably just 1 or 2%. And that reflected the fact that the most egregious failure of our capital system before the crisis was the capital system that we applied to trading activities. where we said it's up to you guys, the industry, to model your required capital on value at risk models. You are allowed to run those value at risk models by working out what's the worst loss at the 97% confidence interval that you think you could have over a 10-day period, and allowed them to develop their own models of, how bad could it be? And what they did was develop extraordinarily pro-cyclical models, which said in spring 2007, well, volatility in the markets is way, way low, so we don't need much capital, because given that volatility in the markets is low, the worst loss we can make in a 10-day period is X, so we don't need much capital, which ended up as a total pro-cyclical machine, because the very fact that you didn't then need much capital to trade made a whole load of people trade more, which has a short-term effect of driving down the volatility until you get a crack point, and then the volatility explodes. So I think the lesson of that is that our trading book capital regime was completely wrong. I think we have taken some steps, but not nearly enough to put it right. I think we should still be aiming for dramatic increases in required capital requirements against trading activity. I think the net result of that is probably, as the investment bankers will tell you, that less trading will occur. But I think some of this trading is completely unnecessary and socially useless in any case. It gets justified with iconic statements like market liquidity or the need for price discovery, which I think are rhetorical flourishes rather than things really well-rooted in economic functions that we need. Clearly there is an important process of price discovery, but we don't need as much price discovery as we assert. So maybe I'm too optimistic, Larry, but overall I believe there is a level of equity capital ratio sufficiently high that it would cover losses in all states of the world, provided we roll on, as we are committed to roll on, to a fundamental review and reformation of the trading book capital regime which is required. And on disclosure, I've always been in a camp which is, disclosures like motherhood and apple pie. I mean, nobody can be against it, but I'm not convinced that markets are efficient enough or information processing processes are efficient enough or people are sufficiently rational for disclosure and transparency to be as powerful a lever for stability, which, as I know you do.
One more question.
We want to hold an asset, which we call money, that can be available, used at any time, and it is final satisfaction of a payment. It's not a debt, but it's final satisfaction, a payment for a good or service. It's also inherent in economic life that sometimes households, certainly firms, want to be able to borrow for a certain period, and they want to be able to borrow for a period that is not a demand note. Now, in fact, of course, banks write a lot of demand notes. However, there is the understanding that provided the borrower is in good standing, and provided the bank is not in very deep trouble, that the money will not be demanded with no notice. So it seems to me that maturity transformation is an inherent and useful function of banks, and I see no possibility of any regulation that would effectively control maturity transformation, because it's easy for banks to write the terms of a contract, a note, saying it's a demand note, but in fact the practice is that they don't demand it.
Yeah, well, I think I agree with you. I mean, I'm not suggesting an abolition of maturity transformation, but I think you've highlighted something which I honestly just don't think that economics so far has provided a really good enough analysis of, which is what is the optimal level of both debt contracts and of maturity transforming credit and money creation. And I think this is very fundamental. There's a very lovely short essay written by the mid-20th century Italian economist Luigi Einaudi, and it's called simply Debts, or in Italian Debiti. And Einaudi, reflecting Simons, says, look, it's obvious that if we could create a world in which there were only equity contracts in both a capital finance and in a labour market fashion, we'd have a much more stable economy. So he said if all investments in business were equity investments, and if all labour market contracts took the form of shares in the profit, whatever the profit was, of the firm in question, then we would not have the fluctuations which arise from the inflexibilities of wage contracts and debt contracts, which led to, the Great Depression. And I think there's a reasonable case. But then he goes on to say, but we've got a whole load of debt contracts, and we've got them, and we've got fixed labour contracts, i.e. fixed wages. You're going to pay me, $30,000 a year, whether your company works or not, and you're going to pay me an interest rate of 5%, whether you make a profit or not. These have arisen, he says, because of a fundamentally, naturally arising human desire for certainty. And human beings can't deal with the uncertainty inherent in every contract being an equity contract. And I think that's right, but I still think it leaves open the question, okay, so an element of debt contracts is a good thing, it's welfare maximizing, it responds to some needs of individuals in the way they invest, and the way that the company wants, certainty of what it's going to pay. But you can accept that argument and still believe that there could be too much. And I think maturity transformation is the same. I think the way that you have described it, which says that people in addition want to be able to simultaneously borrow money for 20 years and have some of their wealth invested in an instant access account, you can see why to lots of people and to businesses that's an attractive thing to do that gives all sorts of flexibilities, and you can see why the possibility of that may have been important to businesses making entrepreneurial commitments, which is part of the wealth creation process. So again, I think that maturity transformation it can be both an absolute welfare optimizing function, even if it doesn't drive growth, and I think it also may have contributed to growth. But again, that doesn't tell us that limitless amounts of maturity transformation are good. And I think one of the really missing bits of our understanding of economic theory is once you've accepted that some debt contracts is better than no debt contracts, and once you've accepted that some maturity transformation is better than no maturity transformation, I think we're way short of a good theoretical understanding or an empirical understanding of, but how much is optimal, given that I think there are very good reasons to believing that both of these things, once unleashed, have inverse U functions, that some debt contracts within society, debt to GDP, is good up to a point and bad beyond that point, and some maturity transformation is good up to a point and then bad beyond that point. And I think we have neither good theory nor good empirical analysis so far, though I think it's beginning to help us locate that point. But I think it's one of the most fundamental, missing bits of our basic theoretical understanding of optimality in a monetary economy. And with that, I think I'm going to have to say it's been nice talking to you, and thanks very much.
Thank you very, very much. Ladies and gentlemen, we're a few minutes late, so if you could, have the coffee break. Can we cut it from 15 minutes down to 7 or 8 minutes? I don't know. Can we do that? And then keep on going. Otherwise, we can just sit here till 6 o'clock. No, that doesn't work.
Senior Fellow at the Cato Institute. Thank you very much, Bill.
This reminds me, am I close enough to the mic? This reminds me, because the audience is thinning, I was in New York doing a lecture for the National Bureau of Economic Research on October 19, 1987. And I suspect everybody in here knows that date. And I came down from my hotel room where I was working on my remarks, and the stock market was already down. I don't know what it was. At 10 o'clock in the morning, it was already down by 7 or 8%, and then it kept going down and down, and the crowd, mostly financial people, got thinner and thinner, and by the time I spoke, I think there were probably about 6 people there, something like that. And I also have vivid memory of the taxi ride out to LaGuardia, and the cab driver had the radio on, and every few minutes there was another stock market report. Maybe it was every 5 minutes or something like that, and the Dow was down another 40, and it was an astonishing day. Okay, I'm probably going to sound like a libertarian purist, and if I do, I hope you will think about it as a measure, perhaps, of how far we've come and how far we are away from our founding principles of our country. Now, the original title that I had was Banking Reform, a Libertarian Perspective. Dunkelberg's not here, but he made me change it, so it now reads Free Market Perspective. But I do want to keep in mind the libertarian perspective. I'm trying here, I'm not doing anything new at all. I am trying to restate what I think are some important principles. And I also want to emphasize that the libertarian principle is important, to me anyway, not just because it frees up people to create products like the iPhone and all the other technological advances, but because personal freedom and liberty is valuable in its own right. Our nation is what it is because people have been able to pursue their dreams, and often they don't work out, but we can pursue our dreams in this country to an extent that people can't most other places around the world. So when we get to banking, we ought to want for the banking industry what we ought to want for all industries: the maximum liberty for parties to engage in voluntary exchange, subject to constraint that their activities do not endanger the welfare of third parties. And yes, financial firms do have their special characteristics, but so do auto manufacturers, hospitals, airlines, and so forth. In fact, I was involved in a debate at the University of Delaware last night, and the two, I'll call them opponents, colleagues in the economics department at the University of Delaware, they were insistent that supply and demand does not apply to health care. One of our topics was Social Security and health care. So they were insistent supply and demand does not apply to health care. And there wasn't enough time, and probably wouldn't be enough time over the rest of my life to argue them out of that position. But I just think that's wrong. A sound approach to banking reform requires that we identify the special characteristics of financial firms, and we've been talking a lot about that, legislate rules appropriate to those special characteristics, and beyond that, keep the government role to a minimum. So my approach is informed by two facts. First, there's a long history, certainly, of both petty financial fraud and of course sometimes it gets very large, as in the case of Madoff, and of large financial crises that cause significant economic loss. But secondly, there's also a long history of financial regulatory failures. To understand those failures, we must adopt a public choice perspective, and the public choice perspective insists that regulation in a democracy is not the disinterested process that advocates of regulation presume. How can we trust government when its actions are so often so clearly adverse to consumer interests and protective of producer interests? Now consider the last of these points first. Governments shamelessly promote state lotteries that exploit the poor and uneducated while outlawing the so-called numbers racket of private lotteries that provide much better odds to the players. To protect, another example, to protect funeral directors, a number of states outlaw unlicensed sale of caskets, as discussed in a recent op-ed in the Wall Street Journal. And we could multiply these examples over and over and over again. A free market perspective also emphasizes the importance of the rule of law rather than the rule of persons or regulators. Regulators are persons. The U.S. Congress has delegated vast powers to regulators, and U.S. experience is not unique. Perhaps especially in financial services, much of the delegation is unnecessary from a public policy perspective. Indeed, the delegation is harmful because it strengthens producer interests and gives consumers a false sense of security. Many claim, as in the 2011 documentary film on the financial crisis, Inside Job. I suppose that a number of you have seen it. If you haven't, I would recommend it as picking it up from a library or wherever. The Inside Job claims that the crisis was a failure of regulators and not of regulation. Now, there's some limited truth to that argument. As St. Louis Fed president, 98 to 08, during the years the financial time bomb was being built and was beginning to smolder, I do not recall clear warnings within the Fed about the accumulating dangers. The 2007 FOMC transcript is now available, and no one reviewing it will find, for example, a staff presentation on just how rotten the subprime paper was and how vulnerable were the portfolios of several huge firms. The Fed did miss this problem. The danger was there, we know, for anyone to find if he had looked. And we know that from the very readable book by Michael Lewis, The Big Short. Lewis chronicles the story of several hedge fund managers, especially Steve Eisman and Michael Burry. And those two came to distrust the subprime products well before the financial crisis. And the crisis, of course, then demonstrated that they were absolutely right. The problem they had was to keep their investors on board until the ultimate day of reckoning came. These fund managers did not have anything close to the staff resources available to the financial regulatory agencies. The Fed and the other agencies could have uncovered the same facts that Eisman and Burry did. However, suppose that the Fed had uncovered these facts. Should Alan Greenspan have criticized by name? And it would have been hard to avoid at least the implication. Should Alan Greenspan have criticized by name the two presidents of the United States who's led administrations with an official policy of extending more mortgage credit to marginally qualified borrowers to increase the rate of home ownership? Should Greenspan have criticized by name the congressional leaders who had the same goal as the appointed officials. Is that what he should have done? Now, surely it would seem to me that it's the role of appointed officials to administer the law and not to undercut the elected officials through pointed, highly visible criticism. Greenspan did, in fact, testify on several occasions that reform of Fannie Mae and Freddie Mac was needed, and he worked behind the scenes to help forge new legislation. He failed, but he was not as blind to the risks as his critics claim. Now, that said, the financial firms that accumulated large portfolios of subprime paper bear responsibility for their behavior. Bear Stearns, Lehman, Merrill Lynch, Citigroup, AIG, all the others had ample research resources to uncover the subprime facts. The managements and directors of those firms are responsible for their firm's behavior. The federal government did not make them do it. They did it themselves, and they should have known better. The federal government and regulatory agencies should not have been trusted. They had failed in the past, as with the savings and loan mess, as we know, in the 70s and 80s. And they'll fail again. The rating agencies failed. President Reagan said it best, trust but verify. The large financial firms apparently trusted the rating agencies, but they certainly did not verify. And more than that, major financial firms violated sound banking 101 known from the 19th century. A portfolio of long-duration, risky assets should not be financed by short maturity liabilities with minimal capital. I had a little discussion with Larry, I don't know if he's still here, about Lehman's capital, and he quoted a figure of 11%. I don't think that was correct on a mark-to-market basis. And so the market knew that Lehman assets were going down the tubes and that Lehman was using up whatever margin of capital it had on the statements that the SEC was willing to certify. So my question is, what could they have been thinking? These firms were apparently enamored of a portfolio model based on the assumptions of continuous trading in both asset and liability markets. That model of continuity had broken down in the 1987 stock market crash, when portfolio insurance models collapsed, and again in the 1998 crisis at long-term capital management. A substantial finance literature has emphasized the importance of discrete price jumps, up and down, and fat tails. The firms that failed deserve to fail. Of course, they didn't all fail, unfortunately. And the only regret ought to be that investors in those firms' liabilities lost too little. Now, investors in banks do have an information deficit, and Larry Kotlikoff emphasized that point. Suppose, it's a beautiful day out here, suppose you're walking down the street and a well-dressed man, suit, tie, approaches you and says, I am a bank. Please deposit $100 with me, and I'll keep it safe. And here's a little book, and we'll sign you up. And you can have it back at any time. Well, your reaction, of course, is this guy's a nut. And you don't just hand over $100 to somebody walking down the street. However, if you walk past a building that has impressive pillars, iron grates over the windows, and the word bank in gold letters up there somewhere, you may be quite willing to walk in and deposit your $100 without much investigation at all. And of course, it's FDIC insured. But the fact is that there is no possibility that the average PhD economist, even, I think, the way up in the upper tail trained PhD economist, trained in finance, can determine the safety of a bank. Of course, the reason is that the publicly available information just doesn't tell you what you really need to know about the quality of the assets. Now, consumers rely on a variety of mechanisms to judge the quality and suitability of products in the markets. We cannot engage in destructive testing of toasters, but we can read consumer reports. And we can look for the underwriter's laboratory seal of approval. We rely on the views of friends and experts, brand names, and so forth. And when it comes to money, I believe that the federal government certainly does have a role. Deposit insurance up to some limit, and I'm not opposed to the current limit, does make sense. We can regard deposit insurance as the equivalent of government efforts to maintain the quality of the circulating currency, the hand-to-hand currency, against the risk of counterfeiting. Currency would be far, far less useful if someone receiving payment had to examine every bill, perhaps using a special machine to look for counterfeits. The U.S. government does such a good job maintaining the quality of the currency that it is not necessary to examine bills at all when receiving payment, except possibly for large denomination bills from a questionable source. And similarly, households and small businesses can trust their deposits below the insurance limit without investigating their banks. As I emphasize, even if they investigated their banks, they couldn't determine the safety anyway. Now, the crux of the bank safety problem is to create a structure such that someone has both the incentive and the information necessary to oversee and discipline bank lending activities. Both the incentive and the information. Even large depositors above the deposit insurance limit do not have much incentive to understand a bank. And I include in large depositors here all those who have claims on banks and bank holding companies. I'm just treating that as one grand enterprise. When large depositors come to distrust a bank, it is always cheaper simply to move the funds to another bank than to investigate possible problems with your own bank. Now, given this fact, the only way to, and of course that's a bank run, so given that fact, the only way, and I want to emphasize, only way to create a stable banking system is to require that banks maintain large capital positions. The capital must consist of some combination of equity and long-term debt that cannot run. Long-term debt that cannot run. Capital provides the cushion to absorb losses, and capital owners have the incentive to monitor the bank. It is important to define the capital requirement in simple terms and not on a so-called risk-weighted basis. Our experience with risk-weighted capital makes clear that the proper term is politically weighted capital. For capital to be defined in statute law and not through the uncertain process of regulatory decisions, capital should be assessed against all balance sheet liabilities, off-balance sheet guarantees, and the net value of derivatives positions. The only task for the regulators is the accounting one of adding up the data and monitoring its accuracy. Now, professional investors in a bank's equity and/or its bonds have the incentive and the resources to understand the behavior of the bank in very great detail. If a bank does not provide the disclosures professional investors require, then investors will go elsewhere. That's what we do all across the market economy. As is true for so many aspects of the modern economy, we rely on specialized expertise to uncover and evaluate information. Private providers of capital will routinely do a better job of evaluation than will regulators, provided that they are forced to accept that responsibility by the risk of loss. Keep in mind the regulators don't lose anything when a bank fails, except at most a reputation, at most. The banking regulator views his job as writing rules, interpreting them, enforcing them to control bank behavior as if the regulator were approving each and every transaction. Now, if this seems exaggerated, it is only slightly so. The regulator's job, at least the way we do it now, the regulator's job is to stop what he views as harmful or risky behavior, not to encourage innovation and efficiency. The mindset is illustrated by the guidance regulators offer from time to time, as illustrated by a recent Wall Street Journal headline, "Lenders are warned on risk. Regulators act to pop a potential bubble caused by surge in leveraged credit." This was just a month ago, March 22nd. Of course, at the same time that the FOMC leadership is insisting that there is no bubble in place. Peter Wallison, in his fine new book, Bad History, Worse Policy, makes clear how the regulatory imperative to protect consumers under Dodd-Frank will deny them access to credit from regulated financial firms. Under Dodd-Frank, the Consumer Financial Protection Bureau is to design a, quote, plain vanilla financial products. For all other products, lenders may have to assume responsibility for the suitability of the products for their customers. Lenders, subject to the possibility of expensive suits, will probably forego offering products except those for which suitability is clear and the plain vanilla characteristics are approved by regulators. Dodd-Frank will do wonders for the loan sharking business. Given regulatory experience in the United States and elsewhere, regulation of bank activities is not an adequate substitute for capital. Regulators, and apparently bank senior management as well, can have the same difficulty private investors do in understanding what a bank is doing. And finally, as I've already emphasized, regulators are subject to political constraints to encourage certain activities, such as housing. The actual record of regulation and the constraints we understand through the public choice literature destroy, and I don't think that's too mild a word, destroy the case for regulation as a substitute for adequate capital. The ultimate outcome of the conflict between mandates under the Community Reinvestment Act, which aims to broaden access to credit, and consumer protection under Dodd-Frank is unclear. We don't know where that's going to go. But I would not be surprised if banks make more grants to affordable housing and consumer advocate nonprofit organizations to fulfill their CRA mandates. So the money goes to politically act as nonprofits instead of mortgage borrowers. There are those who will welcome this outcome, but I am not among them. So what is a bank? Certainly a financial firm that wants to offer insured deposits must be a bank and must abide by the regulatory restrictions necessary to protect the Deposit Insurance Fund. The FDIC has a valid interest in examining banks to detect fraud, misstatement of financial accounts. As I have emphasized repeatedly, by far the most important and effective regulation is a hefty capital requirement. I would argue for a base requirement of 10% on liabilities up to $50 billion and 20% on all liabilities in excess of $50 billion. But I'm willing to discuss that. That's not the issue. It has to be hefty, though. Besides deposit insurance, an additional valuable feature of a bank charter should be, of course, access to the central bank's lending facility for liquidity. Central banks should only discount sound paper at a penalty rate of interest. Such paper need not be very marketable, which is why central bank support is necessary in the first place. Marketable paper can be sold into the market to raise funds. Now, many will regard the approach that I have outlined as unworkable and hopelessly old-fashioned. Well, so be it. Putting aside the politics of entrenched interests, which is what economists ought to do, the issue is whether a bank subject to stiff capital constraints will find itself in competition with near banks that forego deposit insurance and access to central bank support. The money market mutual fund is a good example. This industry grew in the early 1970s as a consequence of regulatory avoidance. The regulation was the restriction of interest rates on deposit accounts. And now we have the problem that these firms, which as mutual funds do not require capital, have been permitted to value their liabilities at $1 per share, even if the net asset value of a share differs. The industry has grown to the point that it has the political muscle to maintain this accounting fiction. There's really not much to say about this issue. If a government allows a bakery, for example, to sell a 1-pound loaf of bread that weighs only 15 ounces, and the package label says 1 pound, well, there's not much hope for orderly government in a free society. During the recent crisis, several investment banks converted to bank holding companies to obtain Fed discount window support. To create the correct incentive, a requirement that such conversion remain in force for 10 years, say, might be appropriate. We don't want the bank to convert and then go, the financial firm to convert to get the Fed support and then things quiet down and they go back. That's not going to work in the long run. Nevertheless, there is a valid issue about how to deal with near banks that do not meet the legal requirements and that choose to forego the privileges of firms with bank charters. In a free society, government has an important role in enforcing laws on accurate disclosure and maintaining a legal system that permits citizens to recover damages for fraud. These are traditional functions of government. There is, however, another function of government that we would not have had to discuss 100 years ago. Government must permit bankrupt firms to fail. The liberal market system cannot function properly if firms can use their political power to gain bailouts. My close friend Alan Meltzer puts it this way. Capitalism without failure is like religion without sin. That's the way he puts it. A banking system characterized as containing banks that are too big to fail is a terribly serious problem. The approach in Dodd-Frank is to establish a new agency, the Financial Stability Oversight Council, to designate specific firms as systemically important financial institutions, subject to enhanced oversight and an orderly liquidation procedure. Peter Wallison is convincing, I believe, that this process cannot be effective. Market fears that FDIC might seize a firm and begin the resolution process will create the same sort of run that ultimately and quickly brought down Lehman. Now, much larger capital is part of the solution. But more than that, though, we need to design the proper incentive structure within the capital requirement to force a large but weak bank to shrink. The only device that does what needs to be done, as far as I know, is to require a bank over, say, $50 billion in assets to include subordinated notes in its capital structure. And the subordinated notes with a 10-year original maturity and convertible into equity at the bank's option on maturity would provide the correct market discipline. So if the bank is running short of equity, it forces the bondholders to convert to equity at a rate that is determined at the time the bonds are sold. This idea has been around for a long, long time. It dates back to the early 1980s. With these capital requirements, the mechanism would provide a market-based way of forcing a gradual liquidation of a failing large bank. And we simply must allow a large bank to fail. I like the way Alan Greenspan put it at one point. There are banks that are too large to liquidate quickly, but there must not be any that are too big to fail. Subordinated debt is a mechanism to accomplish what has to be done. It is a market-based mechanism that does not rely on a vision of what financial activities are appropriate for large financial institutions. If there are sound economic reasons for financial institutions to be huge, spread across many activities and many countries, then we should not prevent entrepreneurs from building such institutions, provided, of course, that there are no monopoly concerns, which there rarely are in financial services. But provided there are no monopoly concerns, we do not block the creation of large firms in any other industry. Why should we do so in financial services? Again, we have to set it up in a way that the large firms are stable, and that's what stiff capital requirements would do. The principal alternative to requiring much larger capital is to insist on a narrow bank of some sort, and we've spent a lot of time talking about that. The problem with this approach, from my point of view, is that defining the permissible activities of the narrow bank, as we are currently observing with the so-called Volcker Rule, is extremely difficult for regulators to decide what activities are permitted and what are not. The approach is subject to endless negotiation between regulators and firms, and lots of regulatory avoidance. The rules can be subject to political interference. It's really not that difficult for large financial firms with substantial contributions to political campaigns to persuade some congressman or another to slip a provision in a piece of obscure legislation that goes sailing right through, and the only people who know about it are the ones who are directly interested. A narrow bank is essentially a firm, I believe, a firm designed in Washington rather than through market forces. No one knows what financial services are efficiently provided in a single firm and how that firm should evolve over time. Sandy Weil created Citigroup as a financial supermarket in the late 1990s. Now the firm is shedding activities, perhaps because the firm is too unwieldy to manage and or the anticipated advantages of putting the disparate businesses together did not arrive. In any event, Citi is an instructive example. Although its shrinkage is partly due to regulator pressure, it is mostly a market outcome. Government mistakes are rarely corrected so quickly. Why do we so ignore the incentive to leverage? And I agree with everything we've said today that leverage is the real killer in this whole subject. Why do we ignore the incentive to leverage in the tax system? Economists generally argue for incentives, to change incentives, rather than command and control solutions. There's no reason, I believe, there's no reason not to eliminate the deductibility of interest in both the personal and corporate tax code. And if you did that, of course it would produce a big disadvantage to financial firms, but you would, and incidentally I would do it in a revenue neutral way, and you could lower the statutory corporate tax rate from something like where it is now, 35%. You could lower the statutory corporate tax rate to about 15% in a revenue neutral way. That's just the back of the envelope calculation that I made. Everyone agrees, including those who advocate tighter regulation, that the evidence is overwhelming that Fannie Mae and Freddie Mac captured Congress, and through the capture of their regulator, which was the Office of Federal Housing Enterprise Oversight, or OFEO, Congress made sure that OFEO never had the resources and authority to do the job correctly. This was an egregious case. Advocates of more regulation are silent as to how to correct the inherent tendency in a democracy for regulatory capture. They wish it weren't so, but it is so. When will advocates of regulation face up to the facts of regulatory capture? Why are they so willing to ignore history and economic theory? I wish I knew. Okay.
We have just a few minutes for questions.
I hope I provoked somebody. Well, the guy with the mic is, I guess, going to choose the... Here's one up here, and there's one back there.
And that's going to be it. It'll be just those two. That's going to be it for questions. Here you go.
The movie Inside Job is available from the Free Library Philadelphia. Glad you made reference to it. From a libertarian perspective, the regulators I see are really corporations with the revolving door that was referred to earlier, especially in the FDA. From a libertarian perspective, how do we control the revolving door so that we don't have the problems of regulators regulating their buddies? Thank you.
I think the statement of fact is correct. A lot of regulators move out into the private sector and earn 3 to 4 times the first year out. And so they go to the agency, they get a lot of training, they learn how the agency works, and that's the apprenticeship, and then they go out and earn the big bucks. And that's a fact. What I think we need to do is to put our requirements in the law, in the statute law. The requirements need to go in the statute law. Let me give you, I mean, there's lots of examples here. Think about your property taxes. Your assessor doesn't have the authority just to come around and say, you have to pay this much tax, and this guy has to pay that much tax. There are requirements in the law that determine how your property tax is set. And there's an appeal process. If you leave it to the regulators, the regulatory process, then this problem will continue indefinitely. Now, I know some regulators. I mean, I was employed by the Federal Reserve System for 10 years, my God. I know some regulators. And they're all very nice people. And they are well aware of the pressures that they face. Well aware of that. But they are often caught in a situation that is simply impossible for them to deal with. And they're stuck. They're truly stuck. They do the best job they can, given the authority that they have, and that's where we are. So I don't think there's any way out at all without putting the rules into the statute law.
Okay. So you made a point about regulatory capture several times, and to capture somebody, to capture the regulator takes some money, although deplorably it seems to be that they're pretty cheap. But even so, it takes some money, and for institutions that can print money, essentially, that can create money, that is a hell of a lot easier than for institutions that have to convince somebody to deposit money first before they can do that. And so I think some of the proposals that were floated here would make it at least harder to capture the regulator. But I think your emphasis on regulations was throughout your talk, and I would like to go away from that a little bit, and I would like to make a distinction between regulations and institutions. Because some of what we're proposing here is to create institutions whereby the economy would be on autopilot, and it would not require the regulator to a very
It would be in the law.
It would be in the law.
Exactly.
And for example, if it was true that you had these banks that are basically just administering reserves of public money, that's not very different from holding an account directly at the central bank, right? I mean, it's just somebody intermediating that, essentially. and providing some computers to intermediate that. There's nothing else to regulate that. The money supply, at least in this economy, wouldn't need a lot of regulation because the institutions would be right. There would still be issues in the credit system, but at least the money system would be safe, not because of regulation, but because of institutions.
I don't want to get into a review of what we've already discussed, but I just want to reemphasize, I think I absolutely agree we need to put it in the law. It needs to go into the law. But I also want to emphasize that we should want an end result that allows for creativity and innovation in finance. It should not so constrain financial institutions that we lose the possibility of innovation and creativity. And the dimensions of innovation and creativity in finance run in many, many different directions. I mean, we can think of some that have been important last 25 years. I happen to think that the credit default swaps market is a very, very useful innovation. I think the same thing is true of interest rate swaps. I think that the opening up credit to subprime borrowers was a good idea. Problem was that it went to excess because the underwriting criteria went to pot for a whole variety of reasons. Reed Wallison, and he emphasizes, and I think he's right, he emphasizes the enormous role of the federal government in creating those incentives. The enormous role. And the role was administered through Fannie Mae and Freddie Mac. They were forced to hold an increasing part of their portfolio in these instruments designed to achieve the affordable housing goals, is the way it was put. Moreover, Wallison emphasizes that, I had to go back and look at his book to be sure I've got the dates exactly right, but as their portfolios grew, they systematically concealed the fact that so much of this growth was in the subprime category. So they were out there reporting that they had, sort of AAA conventional mortgages, and they had no such thing. Well, obviously that was an important part of their business, and one of the ways they did it was that they would have mortgages that had an 80% loan to value, but then the originator had given a second mortgage that was the other 20%. That exposed the borrower to default when the borrower couldn't meet those payments, and so Fannie Mae was fully aware of the fact that there were the second mortgages tacked on, but hid that fact. And OFEO did not have the authority to force the disclosure. So these are government-sponsored enterprises. That part of it was not market produced. Where I differ from Wallison is I think that the investment banks also need to be held feet to the fire because they accumulated portfolios of this crap, and they need to be held responsible for the outcome. We should not excuse them because they got sucked in by what the government was doing. The government does all sorts of things, and we need to be suspicious of some of that stuff.
Thanks ever so much.
Okay.
I really
Thank you. Okay.
Thank you. We're almost finished.
Okay, well, let me get out of the way.
Yep. There we go. I think I've got it. Thank you. All right. Let's. All right. I'm going to look at social implications and then wind it down and talk, as Schumacher said, economics as if people mattered. I think we forget in our ivory tower. I live in one of those where I talk charts, graphs, and numbers, etc. And I decided, let's go right brain, because we've had a left brain day all day. I don't know about you, but at the end of the day, I can't handle left brain anymore. Well, I've got to be careful what I say here. But so I decided, initially I started with charts and graphs, and I thought, okay, let's do pictures and movie clips and talk about what is it that we're really talking about. What are the implications of the theories, of the agreements, of the disagreements, of what it is that happens? The world very much is involved in what we're doing. Here's a quote by John Maynard Keynes: "The ideas of economists and political philosophers, both when they are right and, sad to say, when they are wrong, are more powerful than is commonly understood. Indeed, the world is ruled by little else." I wouldn't want to say that, but I think we'll let the past Mr. Keynes say that. That's really ultimately what the implications are all about, right? I think we forget in our discussions the fact that the decisions that we make here in this building, here in this group of people, affect the lives, well, in our case, of 310 or 20 million people, however many we are today. And globally, the effect that the Fed and that the U.S. has on policy all over the world. And Jeff Sachs said that very clearly, where he's saying, look, the decisions that we end up making have huge effects on everybody else. All right? Well, a lot of those effects are hidden. 90% of what we talk about is underwater. We don't tend to see it very easily. Well, I don't know. I speak for myself. I know when I sit down for dinner and I try to explain something to somebody, the first thing I do is get a napkin out and draw some parabolic chart or something, because that's how my brain thinks. But that's not what this is really all about. So, ladies and gentlemen, here we go. Logic will get you from A to B. Some really famous person said that, like Albert Einstein. But imagination will take you everywhere. And that's what I'd like to do for just a few minutes at the end of the day today. All right? Because when we get it wrong, as John Maynard Keynes just said, the implications are phenomenal. Okay? Here's a shot from Greece. I don't think I need to say anything, do I? Here's a shot from Cyprus. These are people withdrawing their, what is it? I think it's 300 euros a day. Wow, can't you live off that forever and ever? How would you like to be a company and meet payroll on 300 euros a day? Thank you, you're bankrupt, just like that. You do realize we now have two, let's not get into the fancy stuff. We now have two different kinds of euros. You know that, don't you? There's the euro that's in what we think is the euro, and then there's the euro that's in Cyprus. It's not a real euro anymore because you can't take it out. Can't go anywhere with it. Anyway, let's not, that's, we've had all day of those kind of things. I'm talking, well, those are the kind of consequences that our decisions and our discussions and what it is that we talk about, that results in bank lines. That results, sad to say, in suicides. That results in riots on the street. So what I did in that great underwater portion of the iceberg that you saw, I decided to take just a few bits and pieces of what could have been handled. I probably left 80% out, all sorts of things that have been mentioned today, and I thought, let's just have a look at a few of them. All right, here's what I would say. Here's our monetary system, our banking system. All right. So what it is, it's this huge monolith, menhir, and it's standing on a point. All right? It's very unstable. Now, you notice we've created some really nice rocks here at the bottom. So these are stability systems that are part of what it is that we've created. That's the FDIC. That's, all sorts of regulatory constructions that we've created that help to stabilize this block. All right? But we've got these big guys. I'd say that this is the Fed here in the United States that is working to stabilize a highly unstable system. And I am in a Fed building, and I want to praise them because I think they've done a phenomenal job for a system that I would consider as inherently unstable. And essentially, everybody has said that today. You have heard that. We may disagree on different policies, systemic issues, whatever. Everybody, I don't think anybody has not agreed with that. We've all agreed the system is highly unstable. So we've got these guys. They've done a good job. I mean, this is the 100th anniversary. Wasn't it 2013 the Fed was created? It's the 100th anniversary. And it's not that we haven't had any problems, but by and large, I can't believe how few problems we've had, considering the essential nature of what the system looks like. Well, let me show you another thing about this picture. Do you see those little, I don't know how well you can see it from where you are, those are all human beings. Those are little people down there. They actually cover everything, but then of course the whole picture wouldn't make any sense. When that big monolith falls down, it crushes those people. It crushes those people. And that's what we're talking about today. It's a very important subject. Let's talk about social inequality. Remember, I'm zipping through this really fast. Here's a paper written by one of our very own, member of the GIC, John Sylvia, chief economist of Wells Fargo. So we don't have to go very far to look at social inequality. Here's the abstract. I know we can read English, but let me read it to you. But by the way, the people that are online around the world, they're not able to see this, sad to say. I've sent a bunch of these out, and they're trying to follow, and hopefully you guys are doing okay as you're trying to work the software. So here's the abstract from the paper. Talking about that paper, we study the effects and historical contribution of monetary policy shocks to consumption and income inequality in the United States. And the same can be said essentially for the whole world. Contractionary monetary policy actions systematically increase inequality in labor earnings, total income, consumption, and total expenditures. Let's see now, what part of the economy is missing here? There must be something missing. No, there isn't anything missing. Furthermore, monetary shocks can account for a significant component of the historical cyclical variation in income and consumption inequality. Using detailed micro-level data on income and consumption, we document the different channels via which monetary policy shocks affect inequality, as well as how these channels depend on the nature of the change in monetary policy. What does this say? Pardon, John, I'm about to tell you what it is that you said in that abstract. What it says is, when people are doing everything correctly, the system, inherently the system itself, creates inequality. I can be the most wonderful, godly, whatever you want to call it, person in the of the human race. And yet the system itself, in the actions that I'm part of, create inequality. We don't think about that, do we? We think it's just evil people, or we think it's just somebody making some wrong decision, or we think it's just, no, that banker, he's not willing to lend me money, or that person, he defaulted on his loan, or no, if everything is done correctly, the system inherent in itself creates inequality. And inequality ultimately is very, very dangerous to our society. Now, I'm not advocating, I'm definitely not a communist, not a socialist, and we have strong elements of our society that are very pushing strong for redistributionism. All right? Why are those elements of society there? Maybe because we have problems with the structure of the system. Let me run you a short clip.
There's a chart I saw recently that I can't get out of my head. A Harvard business professor and economist asked more than 5,000 Americans how they thought wealth was distributed in the United States. This is what they said they thought it was. Dividing the country into 5 rough groups of the top, bottom, and middle 3 20% groups, they asked people how they thought the wealth in this country was divided. Then he asked them what they thought was the ideal distribution. And 92%, that's at least 9 out of 10 of them, said it should be more like this. In other words, more equitable than they think it is. Now that fact is telling, admittedly, the notion that most Americans know that the system is already skewed unfairly. But what's most interesting to me is the reality compared to our perception. The ideal is as far removed from our perception of reality as the actual distribution is from what we think exists in this country. So ignore the ideal for a moment. Here's what we think it is again. And here is the actual distribution. Shockingly skewed. Not only do the bottom 20% and the next 20%, the bottom 40% of Americans barely have any of the wealth. I mean, it's hard to even see them on the chart. But the top 1% has more of the country's wealth than 9 out of 10 Americans believe the entire top 20% should have. Mind-blowing. But let's look at it another way, because I find this chart kind of difficult to wrap my head around. Instead, let's reduce the 311 million Americans to just a representative 100 people. Make it simple. Here they are. Teachers, coaches, firefighters, construction workers, engineers, doctors, lawyers, some investment bankers, a CEO, maybe a celebrity or two. Now let's line them up according to their wealth. Poorest people on the left, wealthiest on the right, just a steady row of folks based on their net worth. We'll color code them like we did before based on which 20% quintile they fall into. Now let's reduce the total wealth of the United States, which was roughly $54 trillion in 2009, to this symbolic pile of cash. And let's distribute it among our 100 Americans. Well, here's socialism, all the wealth of the country distributed equally. We all know that won't work. We need to encourage people to work and work hard to achieve that good old American dream and keep our country moving forward. So, here's that ideal we asked everyone about. Something like this curve. This isn't too bad. We've got some incentive, as the wealthiest folks are now about 10 to 20 times better off than the poorest Americans. But hey, even the poor folks aren't actually poor, since the poverty line has stayed almost entirely off the chart. We have a super healthy middle class with a smooth transition into wealth. And yes, Republicans and Democrats alike chose this curve. 9 out of 10 people, 92%, said this was a nice, ideal distribution of America's wealth. But let's move on. This is what people think America's wealth distribution actually looks like. Not as equitable, clearly, but for me, even this still looks pretty great. Yes, the poorest 20 to 30% are starting to suffer quite a lot compared to the ideal, and the middle class is certainly struggling more than they were, while the rich and wealthy are making roughly 100 times that of the poorest Americans and about 10 times that of the still healthy middle class. Sadly, this isn't even close to the reality. Here is the actual distribution of wealth in America. The poorest Americans don't even register. They're down to pocket change, and the middle class is barely distinguishable from the poor. In fact, even the rich between the top 10 and 20 percentile are worse off. Only the top 10% are better off. And how much better off? So much better off that the top 2 to 5% are actually off the chart at this scale. And the top 1%, this guy, well, his stack of money stretches 10 times higher than we can show. Here's his stack of cash, restacked, all by itself. This is the top 1% we've been hearing so much about. So much green in his pockets that I have to give him a whole new column of his own, because he won't fit on my chart. 1% of America has 40% of all the nation's wealth. The bottom 80%, 8 out of every 10 people, or 80 out of these 100, only has 7% between them. And this has only gotten worse in the last 20 to 30 years. While the richest 1% take home almost a quarter of the national income today, in 1976, they took home only 9%, meaning their share of income has nearly tripled in the last 30 years. The top 1% own half the country's stocks, bonds, and mutual funds. The bottom 50% of Americans own only 0.5% of these investments, which means they aren't investing. They're just scraping by. I'm sure many of these wealthy people have worked very hard for their money, but do you really believe that the CEO is working 380 times harder than his average employee? Not his lowest paid employee, not the janitor, but the average earner in his company. The average worker needs to work more than a month to earn what the CEO makes in 1 hour. We certainly don't have to go all the way to socialism to find something that is fair for hardworking Americans. We don't even have to achieve what most of us consider might be ideal. All we need to do is wake up and realize that the reality in this country is not at all what we think it is.
Now, this is a conference on banking. It's not a conference on social equality. And I'm not going to stand here and tell you that the banking system creates all that inequality. I think that would be patently wrong. All I'm saying is that, like I said, even our very own agrees that the very banking system that we have is a significant part of a social problem that we do need to deal with. There are a whole bunch of other things. We've talked about application of business cycles. We talked about debt, private, government, etc. Let's just leave those. I want to talk about banking complexity and paradigms. Here, I'll entertain you for just a few minutes. Hopefully you'll enjoy this. Let's start with something very shocking. These are clips out of the movie Longitude. If you've not seen it, I strongly suggest you see it. It's a really powerful movie. It's a true story of John Harrison and how he developed a method of determining longitude. I'm giving things away before they even start. That's terrible. What happened is in the 1600s and 1700s, Britain ruled the seas, as you know, and they realized that they were losing hundreds of ships every year and thousands of sailors because they jolly well didn't know where they were. And so latitude is not a problem. North-south, you know, the sun, we can tell. If you know the day of the year it is, you know how high the sun is, you can pretty well tell where you are north-south. Longitude, folks have done work. You haven't got a clue where in the world you are. So sailors died of scurvy. They hit reefs. They just didn't know where they were. And so in 1714, the British Parliament set up what they called the Board of Longitude, and they issued a prize of £20,000. That's, I can't remember, that's about like $5 million today. It's a very significant prize. And they said, can anybody figure out how to do this? All right? And along came all sorts of people. Here's a 1-minute clip, roughly, that shows you how serious they took this and the consequences if you diddled with it.
On the 22nd of October, 1707, Admiral Sir Cloudesley Shovel summoned the captains of the British fleet to his flagship, the Association. That morning, he had ordered the execution of an able seaman.
The navigation of His Majesty's ships is the sole concern of His Majesty's officers.
The crime was keeping a private reckoning of the ship's position and publicly disputing the Admiral's calculation.
All of bloody twine. Every damned instrument in the possession of any seaman on any ship under my command confiscated. Any further questioning of our position will be treated as an act of mutiny and dealt with accordingly. Is that clear?
Well, the nice thing is I don't think we're going to be hung by the Fed or by anybody else by looking at alternatives to the system. That's really what this sailor was attempting to do, and that's why I showed you the little clip. It was pretty deadly in those days. I think we're not quite there. What happened is John Harrison was a simple carpenter who thought he figured this out, which is to create a clock that was accurate to within at least a second a day. And if you could create a clock that would actually work on board of a ship, they couldn't even do that on land, sitting still, but with all the rocking, rolling, twisting, turning, all the yawing that was going on to create a clock that could do that, lo and behold, the ships would know where they were. This was a simple carpenter. What I'm going to do is because we're running late, I'm going to cut the next one really short. He goes before the Naval Board and asks for permission to take his clock on board ship and have it officially tested. Let's do the last 30 seconds here, roughly. Whoops, where are we? There he goes. He's going on board the ship, and there's this tiny little clock. He's not a seaman. He's never been on board. He's not impressed with this at all.
Your first time, Mr. Harrison. Mr. Harrison, request permissions come aboard. Permission granted. Good. I'll fetch you. Ready, sir. Mr. Harrison.
And that, ladies and gentlemen, is the clock. I want to draw an analogy, and I want to say our banking system today is like John Harrison's clock. You know, about a meter cubed, and takes a crane to lift this thing up on board ship, because he had pendula going against springs, going against wheels, going against you name it. And every single motion needed a slightly smaller counter motion, and a counter motion against that, and a counter motion against that, and a counter motion against that. It is said that he made over 200 adjustments. Why do you think this thing weighed like that? How would you like to today walk around with your wristwatch that is 1 cubic meter and weighed, beats me, half a ton? Wouldn't work, would it? So what we needed was a paradigm shift. I want you to listen to the words of what's happening here. This is an analysis done in the 30s, and there's a speech given. Again, it's a very short clip. And what in the world happened? That's his son.
I mean to make another.
This is about 40 years later.
It's almost ready. We cannot afford to be distracted now.
You've seen how the watch has performed in the test. It's not perfect. But what if I could make it so? What if I could make a timepiece no bigger than the span of a man's hand that could be taken to sea? Now, wouldn't that be a practical solution?
Harrison's fourth.
Here's an analysis in the 30s.
Its beauty and its accuracy must take pride of place as the most famous chronometer that ever has been or ever will be made. But the journey from his third machine, which you see behind me, to his fourth, thank you, is one of the most extraordinary mysteries of horology. Faced as he was by a seemingly insuperable problem of centrifugal forces, Harrison took a daring and lateral leap. It is as though an aeronautical engineer suddenly ceased development on a new aircraft and instead adapted the technology to make his bicycle fly to France. H4, as I come to call it, resembles a large silver pear-cased watch, about 5 inches in diameter. Indeed, it seems to have been designed for the daily wear in the pocket of some drop-in Navio. At the moment it's not working, but that is a state of affairs that I hope very shortly to do something about.
We should be finishing working off the machine, not wasting time on this deck watch.
Wasting our time.
The machine is almost ready for its sea trial, and we've not had time to conduct a 28-day test on this watch.
That watch worked, and in a massive paradigm shift, he went from this 1 meter machine to invent the mechanism that you and I have on our wrist today, if it's not electronic. We still use, all mechanical watches today, use the very method that Harrison, this simple country carpenter, invented. Took him 40 years, and you saw the things that he built before. Why am I telling you this? I wanted to take you on a journey of our banking system and the paradigm shift that I believe we need to move from a crane 1-ton machine to a wristwatch. Because, ladies and gentlemen, I believe it's possible. I really do. Oops, that says the wrong thing. It says change is not possible. I've been told that. As I told people what this conference was all about, I had a banker say to me, "Ole, it's impossible." And I go, "Really?" Here's an interesting chart. What this goes, you're going to have trouble reading it, goes from 1780 until essentially today, and maps out the major banking regulatory changes that have occurred over the last 200 years. Okay? It's not like we have not created major changes before. It's not like history has not seen events that demanded significant decisions. Why is today different? Today it's impossible. I know they could do that 50 years ago, or they could do that when we went off the gold standard, or they could do that when we created the Federal Reserve Bank. Oh, we could do all those things, but today that's not possible. Something wrong with us, I guess. Yeah, we're the todayans. Todayans can't do these things anymore. I just want to show you something that's kind of interesting. If we were to draw a graph, where's my pointer here? If you look at the number of changes, it's essentially a parabolic curve. The closer we get today, the more changes have been created. Right? I want to tell you, we can still do it. As you see at the bottom, we have a history of making good corrections. Let's keep it up. Thank you very much. Yes. I guess the batteries are out. Hang on, Bill, hang on, just a minute, because nobody else can hear you. Or certainly not people.
The Harrison story is a wonderful story. But you left out something that I think is very interesting and relevant to our conference. I think it took about 40 years from H1, and these clocks are on display over in the Royal Observatory, except I think for H4, which is in the Clock Museum in downtown London. However, he had some opposition, and much of his prize money was denied him. Yeah. Do you know who led the opposition? Do you remember? I don't remember. You weren't there.
It was the Royal...
One of the people who led the opposition was Isaac Newton. So here you had a person who was a recognized expert in his day, and Isaac Newton thought that the longitude problem, as the Brits would say, the longitude problem should be solved by using observation on sun and moon. And Harrison had the brilliant, much simpler solution. But that sort of feeds into the point. I think that we need to be very careful about academics like myself, and I don't want to insult Larry because I think Larry Kotlikoff has made some great contributions. But we got to be careful about designing a system that doesn't have a lot of market input. Harrison, as you point out, was a simple country carpenter, but obviously a very, very brilliant man to produce this outcome.
Thank you. Yes, and it took ultimately the king's input. Jim, yes. Oh, sorry.
Mike. I'll give you a figure that was given in testimony before Congress last year in the tax committee in 2012. In 2009, 400 people were responsible for paying 85% of all the capital gains paid in America. Wow. Conversely, those same 400 people were also responsible for 3% of the GDP. This is 2009. How do you think they got that money? No, we gave it to them under bailout. The problem with every one of these is the Italian word sui bono. Who is going to benefit from every one of these rule changes? The same people that put the Fed in place in 1913 are the same people that are manipulating the system now. Parado tracked the tax records from Venice from 1650 or something like that. 10% of the population has controlled 90% of the wealth, at least according to the Italian model, for about 800 years. Nothing's changing in the world out there. You've got politics and government involved. As long as you have crooks and thieves, we're working against a system that we can't win.
Amanda? I think Larry actually was next, but then Bob.
I have to disagree. The history of mankind is one of great progress and radical surgery. When you're driving off a cliff, this term radical is kind of pejorative, but it's actually something I think is positive, because when you're driving off a cliff, normally it would be radically stupid to jump out of the door, but that's the thing to do. When you have a heart patient that needs a transplant and is otherwise going to die, you want to engage in radical surgery. We have a financial system that is radically dangerous. We've just seen that. We saw it in the 30s. And we're seeing it throughout Europe. We could have a 20-year crisis the way the bureaucrats are handling it. The only real, I think, hope, given the reluctance of people to think radically, is that enough of what Bill Poole and Adair and others are proposing, enough of the tinkering and the adding all these little, features and encumbrances on banks will lead them to go out of business and have mutual fund banking endogenously take over. Because if you make a big enough tax on these very dangerous entities, you'll end up with something else being innovated. This connects to what you think, Bill, should happen. I think, and then the other thing is, Bill, just to say in response to this question, market tested. In 1757, a guy named Frederick II of Denmark set up the covered bond mortgage system, which is a mutual fund mortgage system that's been operating extremely well for over 200 years. And that's a mutual fund mortgage system. We have a mutual fund system here in the country that's extremely well functioning, has a 70-year history. So I think what I'm proposing is actually tried and true. It has been tried by the market. It works. What's not working is this part of the banking system that has an implicit subsidy that is encouraging gambling with a public good and with two public goods. And we economists know how to deal with public goods, which is you don't screw them up. They take special care, and we need to protect public goods, and there are ways to go ahead, and we need a new watch.
Well, hang on, just wait. Mr. Kumoff spoke about money as being a medium of exchange. It turns out that Visa has a debit card now. I don't know if you're familiar with it, but you can put cash on it, and you can carry it around. And it's useful so you don't have, every time you buy a cup of coffee, you don't have to fool around with it, swipe it. And you can also get one that is automatically loaded. You can also use it to pay salaries. If you have a debit card in my system, pay you at it doesn't go through the bank account, not direct deposit, right onto your little debit card. Supposing you gave, $1 million instead of the banking system, and I got to tell you, Visa and MasterCard make the Fed look like they are bumbling fools. Billions of transactions are going on while we speak, and they track it all. They do everything. You can use it worldwide. I don't know, why isn't this a banking system? I mean, the difference between my debit card is I have to put my cash on there. That's just the deposit I make. The rest of it's all credit. And they do a fine job in deciding who gets credit and who doesn't. The problem is, some people who don't get credit want it, and then you're going to have the politicians and the academics. Well, it's very unfair that somebody. Unfair is the way of life.
Was Michael next, or Carol, or who was next? Go ahead.
But I think the last intervention just now, you have to ask yourself when they offer this service. You can put some cash on there, but what's on the other side? This is still a debt-based system. That doesn't get away from that at all. So don't be distracted by things like this. We have a debt-based system and solutions like that. Don't go away from that.
Just wait.
Sorry. Yuli, if you could blow up your chart again and share with us where, in respect to the information revolution, some of these more heightened incidence of transfers and changes occur. One of the significant roles, of course, that the Federal Reserve had played for many years was managing the transfer of funds among banks. And that role, of course, has altered with the information revolution and the capacity for us with, bits of information to move that electronically and in respect to transfers. So could you just share with us some of the more recent transfers and project perhaps about how the paradigm shift with what our presenters today have addressed could happen? Because I think the point raised with regard to Visa and proprietary money managers and the recommendation that we separate debt management from money management that's being proposed by the two provocative suggestions that we've had for a banking system speak to the fact that we have capacities now that heretofore we have not had.
Yeah, I don't want to. We're already over time. To do a reasonable job it would just take way too long. If that's okay. Anybody else, or we will wind down. Oh, yes. Dennis?
I find it ironic that we're using the word radical, which in Latin means radix, which is root structures, and fundamentals. I find that interesting.
All righty. Thank you very much for coming.